All right, good morning. We'll go back on the record. It is approximately 9 a.m. And before we begin, do the parties have any housekeeping measures they'd like to settle up for this morning?
Yes, good morning. For Hess, we have one minor housekeeping measure. There were two exhibits used yesterday during Hess's examination, HX 116 and HX 36, which were done in excerpt forms, and we have complete copies for the record. I'm happy to hand those up to you.
All right. No
That's
objections to that? Okay, those will be received.
May I approach?
Yes, you may. Okay, Mr. Atala, I'll remind you that you're still under oath.
Yes, sir.
And you may continue with your direct examination.
Thank you. Mr. Attella, when we left off yesterday, we're sort of going through a general overview of things you did, things you looked at, and then we're going to get into the specifics of your report. So I want to pick up on your demonstrative slide 6, which is titled Gathering and Processing. And just generally, what is a tariff rate?
It's basically a fee for service, gathering fee or a processing fee.
And has Hess always charged a tariff with regard to these wells?
Well, they've always charged a fee, I'm sure. I don't know really what happened prior to these contracts. Based on some of their filings, they had POP contracts. It stands for percentage of proceeds. And in that situation, say we'll just use 80-20 as an example, where a producer is going to produce into the system and the gather and processor is going to gather and process the gas, and the producer will take 80% of that sales value and the processor will take 20% of that sales value as consideration for the gathering and processing.
Okay. Would a POP contract guarantee a certain rate of return to the midstream provider?
No, sir.
Now, there is a tariff model in place currently with regard to these wells, right?
Yes.
And how does that tariff model work generally?
It is based on whether it's the gathering and compression contract or processing fractionation contract, and it's a pretty complex calculation that arrives at a rate based on the contract terms. I don't know how much I want to get into the contract terms yet, but it's they call it a cost of service rate. It's not like cost of service rates I've seen before.
Is it designed to guarantee a certain rate of return to the midstream provider?
It is.
Okay. And just a quick summary, we'll go through the reports. What are your problems with the tariff model in this case?
Okay, so there's some clear problems when you apply the actual and reasonable test with the rates, and then there's some other a little bit more complex problems that it's taken a while to understand. First, as far as actual expenses go, the gathering and processing agreement call for a component of the budgeted or estimated operating expenses to go into the calculation to get a return. And I think through 14 through 20, it is an estimated amount, and it clearly states in the contract that is not to be trued up.
For the years 2014 through 2020?
Yes, it either change in 2021 or not. I can look at my report and clear that up for sure. But it's clearly stated in the contract that it's estimated and not to be trued up. Typical cost of service models, you may have an over or under at the end of each year because you don't know the exact volumes. You would probably roll that in component into the next year, so then everybody could be whole based on the contract.
So does the fact they're using estimates concern you with regard to whether it's an actual cost?
Yes, I mean, it states the contract is not an actual cost. I mean, there are the estimated cost is meant to represent actual costs, but we don't know exactly what that actual cost is.
Okay, so that was one problem.
Yes, another problem is and that was changed, I believe, in 2021 to true up in some way, shape, or form. And then as far as the volumes go, the volumes are a component to generate the revenue to generate the return. And
And in this case, you're talking about volumes of gas.
Yes, because that's how you're generating the revenue. You come up with the rate with the calculations, you multiply that by the volumes, and then you get your anticipated revenues. Where there's a scheduled amount of revenues in there at the beginning of the year. And actually, they do it for the whole time period. But for that particular year, there's a scheduled amount of volumes. And in the contract, it states, if we produce into the system more volumes than what are the scheduled volumes, that excess revenue does not factor into the calculations for the next year. So in a simple way, I'm sorry, my mouth's really dry, one sec. If your schedule said you're going to produce 10 MMBTUs going into the system, and it was $1 for 10, you have $10, and you produced 11, well, you get $11, but when you go into the recalculation the next year, the tariff would not get credit for that extra $1.
So the excess would benefit the midstream provider,
Yes,
but it would not reduce the tariff in the next year.
correct.
All right.
And based on the tariff models and the volumes that we have through Discovery, there was 2 years out of, I think, the 7 or 8 that we showed had volumes above the scheduled volumes.
And how would that impact your view on whether the costs were actual?
Well, if the contract says you're recouping a certain return on the actual expenses, now with that excess volumes, you're receiving more than that amount, and you're not reducing the recalculation in the next year.
So overall, setting aside sort of the intricacies of the model, how does the gathering processes charges under the tariff model with Hess here compared to other operators in the Bakken?
Well, I put a table together to show that. That
But just generally,
they seem to be much higher. They're much higher based on the sales that I looked at.
before I forget, Mr. Donovan asked some questions yesterday about applicants having interest in state leases for these wells. Do you remember that?
Vaguely, yes.
Yeah. And I think the point of the questions were that transportation, gathering, and compression costs attributable to the state's share of oil and gas are allocated to the applicants.
So in a normal situation, if you have royalty owners, whether it's a state or a private royalty owner, whoever it is, if those leases that govern the way Hess treats the royalty owners, if they say that there's no deducts, somebody has to pay for those deducts.
Okay.
So that burden is shifted to the working interest owners.
To your knowledge, it has produced royalty statements issued to the state to allow applicants to verify that?
Not to my knowledge.
All right, let's go to the next slide, which is titled Hess's Corporate Structure. Did Hess's corporate structure impact your analysis here?
Yes.
In what ways?
Well, when the agreements were entered into in 2014, they were all wholly owned affiliates from Hess Corporation. So it was one company. So it was basically an intercompany transaction.
And let's talk about Hess Midstream. So historically, you talked about a transaction. Was Hessam ultimately separated from Hess Corporation?
Half of Hessam was sold. So have to think through this a little bit. But
And I have a document that'll probably help you. If you could look at A50.
okay.
If you don't have it,
I
you
do
can
not
make a
have it.
copy. Yeah. And if you look at the first page of A50, if you could identify it for the record, please.
Are we talking page six?
And we'll go back to page
Okay.
60 in a minute.
It's Hess Corporation 2015 Annual Report,
Okay.
Exhibit A50.
And this is a document you looked at in the course of your work.
Yes.
And if you could turn to page 60 of Exhibit A50.
Okay.
And I'll offer A50 now before I forget.
No objection.
Exhibit is received.
Is there a description on page 60 of the midstream transactions?
Yes.
And what is important to you about the description?
Well, let's see here. Give me a second. So Hess Infrastructure Partners, which basically is HESM, I believe. That's the gathering, Tioga plant, the different gathering systems, probably gas and oil systems, so on and so forth. Hess Corporate sold 50% interest in Hess Infrastructure Systems to Global Infrastructure Partners.
And when did that occur?
July 2015, and it was approximately net cash consideration of $2.6 billion.
Did Hess Corp realize a gain from that transaction?
Let's see here. If
you read further down in the paragraph.
so, the fourth paragraph under the Bakken Midstream Joint Venture, the bold heading, it states, as a result of the sale to GIP, we recorded an after-tax gain of $763 million in additional paid capital and $1.298 billion in non-controlling interest, representing GIP's proportional share of our basis in the net assets of HIP.
And that would have been a benefit to Hess Corp?
Yes, the way I read that.
To your knowledge, did applicants receive any of the proceeds from that transaction sale to GIP?
No.
Does that section about the Bakken Midstream joint venture discuss the contracts that are in place here?
It does somewhere. Well, I believe it talks about where they change from percentage of proceeds to tariff-based fees with.
And I was just asking more generally. There is a provision in there, or I think a passage in there that talks about who had the option to renew the contracts at the end of the initial term. Do you remember that?
Yes. Maybe.
Sure.
Sorry.
Let me ask you just generally, because I
Okay.
don't want to get you tied up in the exhibit.
Okay.
Does HESM have an option to terminate the agreements in this case?
They do, and I believe it was after the primary term. I'd have to refer to the contract, but.
Sure. And that's a good segue. Generally, what contracts did you consider when you were doing your work?
Well, all of Hess Bakken's contracts with HESM.
Okay.
Well, actually, excuse me, Hess Trading Corporation are the contracts with HESM because they buy the production.
Right, and we'll just go through them. If you could, I believe you exhibit 42 in your book.
Would you like this one back?
I'll take my book.
Okay. Thank you. A42, gas purchase and sale agreement between Hess Bakken Investments and Hess Trading Corporation.
And generally, what does exhibit A42 do?
It governs the purchasing of the product between Hess Bakken and Hess Trading.
Okay. And how would you describe Hess Trading? What is its main function?
It's Hess's marketing arm. They take production and market it.
I'd offer
Resell.
exhibit A42.
No objection.
Exhibit is received.
If you could turn to A43. What is Exhibit A43?
A43 is the second amended and restated gas gathering agreement, and it's between Hess Trading Corporation, which is HTC, and Hess North Dakota Pipelines, which is Hessum, or Hess Midstream.
So, Hess Bakken Investments 2 LLC and Hess Trading Corp. Are both wholly owned by Hess Corporation, correct?
Yes,
Okay. And North Dakota Pipelines is an entity that's owned by Hessum.
yes.
All right. And then I'll offer Exhibit 43.
No objection to 43.
Exhibit is received.
And then Exhibit A44.
Exhibit 44 is the second amended and restated gas processing and fractionation agreement between Hess Trading Corporation, again, and Hess Bakken Processing.
And Hess Bakken Processing LLC is a Hessum entity.
Yes.
Okay, let's get to your initial report, which is Exhibit 39.
You're fine.
And we'll just go through your report. The first section is an introduction, and there's documents reviewed, which we've talked about generally. So I don't want you to, and we can also skip ahead to the next slide. We've already talked generally about the documents reviewed, so if you could, starting on the bottom of page 2 and continuing on, talk about your methodology. What did you do?
I'll try not to bore with too many details, but there was some cornerstones some foundations I need to lay at the beginning to make sure the data that I received is reflective of the data that truly represented the transactions between Hess and Sinclair and Missouri River. So we take the RAID in this situation with the post-production costs.
You
And
talked about the RAID yesterday.
yes, that's the Revenue Audit Data Exchange line item detail that details what Hess paid Sinclair. It's an electronic format which helps us trend and pivot table and calculate and do a lot of things that a hard copy wouldn't be able to do. It can help you eliminate prior period adjustments. They reverse something and rebook it and then rebook something else. You can get rid of, I think somebody called that noise earlier, I don't remember who. But you can clear to exactly what happened. And so we take that and we sum it up by check month, basically, check date, and then we tie it to the checks. So now we make sure that this truly represents what Hess paid Sinclair. It's just a foundational exercise that you have to do at the beginning of every project.
And then what'd you do?
Once we did that, and we were comfortable that the RAID was representative, which it typically is, the operator pulls them from their system, we went back behind that documentation to the source documentation, which in this case would be the Tioga gas settlement statements. And the RAID, or the Hess to Sinclair checks, have different categories of deductions. But sometimes behind the scenes, there might be more deductions, and systems can only handle so many different deductions. So we start working through that RAID file and all those deductions and sales and agreeing them, if you will, audit term, to gas plant statements. There's a gathering fee. And there's a gathering fee here. There's a gas plant statement that says we pay this much for gathering fee. There may have been a compression fee, an electricity fee, all those things. So our job was to make sure that we're comfortable that all those deductions are supported by a source document. And that was a Tioga gas plant in this case. And
When you say the source document, in this case, what is the source
the
document?
source document is the Tioga gas plant settlement statement.
Okay.
So I did get comfortable, and I proved that all those deductions were, there may have been one not, there was a tax that wasn't. But we materially tied the revenue deductions on the checks by way of RAID to the Tioga gas plant statements. So now at that point, sorry.
And just
I
who's
interrupted.
issuing the check and who's issuing the gas plant statement?
So I believe that checks is Sinclair from Hess Trading Corporation, I believe. I'd have to look at a check to make sure.
But Hess.
Hess,
Right.
yes. And then the Tioga gas plant statement, as a non-operator, you typically don't receive those. But through discovery process, we ask for those to support the deductions.
And who do those come from?
They came from Hess Midstream.
Okay. And then what'd you do?
Okay, so once you establish that foundation, now you can look at the gas plant statement, if everything perfectly tied, which it materially did. Now you can look at all the different deductions and see what they truly are, because fair enough that revenue systems may not be able to exactly present them the way that they are. Sometimes a fee might be by an MMBTU and a check might be an MCF, so it looks a little bit different and things like that. So we went through that process, and then the next process is taking the deductions and agreeing them to each one of those components on the processing statement. Then you take the contract, because you figure it all out. That makes you happy. Sometimes it works, sometimes it doesn't. And it worked, and then we start going back to the contract to see if we can find a source that governs all of those fees,
That would allow those charges.
that allow those charges.
Okay. And what do you do then?
We read the contracts, we see if those things are in compliance with the contracts. Sometimes you might need additional information, because, for instance, the tariff fee for both gathering and processing was a calculated amount, so then you would ask for support for those calculations of the tariff.
And you have a section in your first report called Findings and Conclusions.
Yeah, I got a little bit ahead of myself. We
Okay.
didn't have the plants. No, we did have the plant statements. We didn't have the tariff fees. I'm sorry. Yeah, so that's where it stops at that processing agreement.
Okay. So in your first report on pages 6 through 9, you have your findings and conclusions. Maybe if you could go to page 6 and walk us through, the first section is gas revenues and fees.
Okay, so this little table here, there's an exhibit that breaks this down into more components. This compares the Tioga gas and processing fees against the Robinson and the Palermo gas processing fees. And this is gonna different from Ryan's analysis, because he took the check data, and the check data might have residue volumes instead of inlet volumes or something like that. So there's reasons for differences, even though I haven't looked at it in depth, but it may trend the same way, but I can't say for sure. So in comparing that, like I said, it's an exhibit, one of the exhibits A, B's, and C's. They're showing it in different ways. It simply takes all the fees for gathering and processing and calculates it from the inlet MMBTU and comes up with a rate per MMBTU. We talked about POP contracts a little bit. There was 1 or 2 POP months in there, if you will. And if
What do
that,
you mean by that?
so we talked about the POP contracts a little bit, where, like, say it's 80-20, for instance. That's just a arbitrary example. It's not indicative of any of the things that we looked at. But that 20% is considered a fee for gathering and processing. So you would gross up that net settled amount to a gross amount as 100%, and then you would say this 20% represents a fee in that month. So in that situation, that POP deduction that the plant took in kind would be included in either it's the Robson or Palermo fee per MCF or MMBTU. Does that make sense?
Mm-hmm.
Okay.
What is the takeaway from your 2 tables on page 6 and 7 of your initial report?
That the Tioga fees for gathering and processing overall are much higher than those for Robinson and Palermo.
And if you could look at, I believe it's table or it's Exhibit B to your report. It's at the tab A39-3. Oh, no, I'm sorry, A39-4.
I'm there.
Does the A39-4 relate to what you were just saying about the tables in your report?
Yes. And
Go ahead.
this summarize them at a little bit of a higher level than some of the other tables, just for the fact that gets difficult to read if you throw every, electricity fee, compression fee, all the different things in there. But it does account for both residue and liquids, because gas goes in, but then it comes out as residue and NGLs. So it accounts the revenues for both of those. And then it sums all the deductions. And you can see the little B note at the bottom. It explains how, if there was a POP deduction, how that was handled.
I want to go back to page 7 of your report. There's been testimony, or at least maybe it was in our opening statement, about the superiority of services and capabilities of Tioga compared to Robinson Lake and Palermo. Do you discuss that on page 7 of your report? At least generally?
Oh, I discussed that it's a pretty similar molecule of gas going in with the BTUs, I believe.
I'm just looking at the sentence that says, while the Hess Tioga system may be a much larger system.
Okay. Yeah, I recognize that.
Okay. But how does that impact your analysis of the costs? We talked about if Tioga is bigger and faster and stronger, but it's consistently producing higher costs and less revenue to working interest owners, is that a good thing?
Yeah, if that's when you kind of have to look at it from an upstream and a midstream perspective. If you're at an upstream and a midstream perspective, I clearly believe that your objectives might be different. If you are only a producer and you don't have any midstream ownership, you're looking for the best economic deal. If they can take your gas and they can give you lower fees, you don't know what happens after that tailgate of that plant. So from a purely upstream perspective, you would look for the best deal. If a plant took 100,000 a day and another plant took 1,000,000 a day, but they're going to take your gas, and the 100,000 plant gave you $1 more an MMBTU after deductions, if you're an upstream producer, you're going to take the $1 more.
When we were talking about your general views, you discussed a couple problems. One of them was regard to estimates versus actuals.
Yes.
Do you discuss that on page 7 of your report?
Yes. Page 8. Yes, at the top of page 8.
Okay. And generally, what is the issue?
That I want to just be clear, when I say it's not actual cost, the costs in there are costs that are incurred, and the estimated costs reflect, or meant to reflect the costs that were actually incurred. But they budget, and they don't know how much that is. So they do their best job, that progress that Mr. Fraley talked about, where Hetsbakken and Hessam, they get together and they make that budget. I don't know if you've ever budgeted before, but sometimes you go over, sometimes you go under.
And there's a sentence On page 9, that's actually the first sentence on page 9. Does that address sort of your view?
At the time, yes, because I didn't have the tariff calculation, so there was no way for me to opine if it was accurate or not.
Okay. So let's switch from the tariff rate to producing overhead, which is on page, we discussed on page 10. And we discussed yesterday that you obtained additional information regarding background on changes in producing overhead. But at the time of your initial report, what was your view on the producing overhead?
With the circumstances where we saw the rate go up for 2 months, no. It stayed constant for January and February. It went up very high in March, and then it went down in April. It just seemed very odd. We didn't know because all we had was the charges. Mr. Adair explained what happened at that time, where they came up with a new rate for 2017. They didn't have that rate yet, I believe, for January and February, but they wanted to implement it for 2017. So the March rate included the rate that was, plus the incremental increase for the new rate, plus the incremental increase for January and February. So it just seemed much higher. And then it dropped back down to April. And that didn't make any sense because usually it raises in April because, well, if COPUS escalation is positive, it would have raised in April. So you'd expect to see a rate change from March to April, but you don't expect to see a rate change any other time.
And we'll talk about the additional information you received and your thoughts on that. But was Ms. Adair's explanation consistent with COPUS guidelines?
No, it accurately explained what happened, but no. Unilaterally changing an overhead rate after the rate's already been initially set is not consistent at all.
In Exhibit D to your initial report, did you do an analysis of the impact of that change in overhead rate?
Exhibit D, can you give me a?
It's 39-5.
Yes, so what this is, it took the applicant wells, of which I think there's 8. I think Sinclair has more around 70 or 80, but these are the wells that they chose for the application. And it compares what the rate was based on the COPUS escalation, and then it compared to the new rate that has calculated for 2017. And it calculated the excess difference. I mean, if you can notice, though, each year Hess goes back and escalates according to COPUS. So they've been following COPUS all along except that one time where they did their internal review and calculated a higher rate.
So is this calculating for each of the wells what the overhead would be had it been consistently escalated to COPUS as opposed to having an adjustment in 2017?
Yes. it does.
And maybe you can just pick a well in a few months and talk about the difference.
Well, yeah, I mean, we can, let's say, January, February, March aren't good because they were still adjusting and doing prior period adjustments. But, I mean, if we take April 2017 in the first page, I think hopefully it's pretty clear. If not, we didn't do a very good job. It shows for the NKMJ Iran, I don't know if I'm pronouncing that right, sorry, rate that Hess charge is $2,132.15. If it would have been escalated based on the COPUS guidelines that Hess followed before, it would have been $1,150.29. So the difference in that case is $981.86. So they increase it almost $1,000 each month, and it goes across for each well. You want to just continue going through it? It goes across for each well, and it calculates January 17th through September 21st. That's the latest, the data that we had. And if you go,
Clear this issue would continue today, correct?
oh yes, it's definitely continuing today.
Okay, I'm sorry, keep going.
That's all right. So at the end of the day, if you will, on September 21st, if you go to the bottom right corner of page 3 of 3, the gross difference. Now granted, we only have a working interest of around 25 or 26%, so this is the gross difference. It would be an overcharge of $468,536. And that's just, yeah, that's gross. And like I said, we have 25%, but I don't know how many other non-operators have and how many other working interest owners there are, but this is some serious money that Hess is recouping because of this increase.
In other words, this issue wouldn't just affect SOGC and Missouri River.
It would affect, my understanding, I haven't looked at other JIBs, but that every well that does not have a JOA is using this rate. And you know, if they drilled a well in 2023 and they had a non-operator and an operator and they negotiated an overhead rate to be charged, it could be higher. It could be this. I don't know. But once that rate is initially set and escalated per COPUS, that COPUS rate is designed to increase your labor index. So, because, you know, inflation, other things increase. You know, during those 21 and 22, I believe the COPUS escalation was much higher, costs got higher. So it kind of tracks that way. But just by midstream doing that, I mean, what would stop any operator without a JOA just, oh, I'm just going to change my overhead rate?
Would there be anything?
I don't know. I mean, I think that's for the commission to decide if any operator can do that.
Let's go to your first supplemental report, which is Exhibit A40.
Sorry. Okay.
We talked yesterday generally about additional information and documents you had, but they're spelled out on page 3, correct?
Yes, I believe I had a section that called for additional documents.
And what else did you have to look at for your first supplemental?
Okay. We did receive the tariff spreadsheets that we didn't have before. I don't believe we got every year, but we did get tariff spreadsheets in Excel. We received a producing well overhead rate calculation that is the spreadsheet, although we just got it in PDF, that showed how Hess calculated the new overhead rate. We obviously had Ms. Adair's report, a couple depositions from Hess people. We reviewed some more Hess websites. And, well, I've already reviewed Accounting Guideline 23 plenty of times, but I took a closer look for the purposes of this.
Okay. I'd like to direct your attention to page 4, where you discuss the relationship between the Hess Corporation and affiliates. What are you discussing here?
I think the gist of it is Mr. Fraley talked about their separate shareholders and separate board members and things of that nature. So
With which entities?
Hessam and or Hebic and HTC.
Okay.
So you know, we're always about trust and verify, trust but verify. So we went to public information sources like Hess website and filings and looked to see if there was control or not, or who controlled. And I think it was pretty clearly stated that Hess Corporation controls everything.
And there's a bolded sentence there. Can you just read that on page 5?
Hess retains operational control of the midstream business to support its upstream growth.
And where does that sentence come from?
According to the Hess Corporation website.
And why did you choose to bold that sentence? Why was it important to you?
It shows that they're working as for the greater good of the whole and not necessarily one individual segment. However, if you're an upstream only provider, you would have different objectives.
And when you say greater good of the whole, which whole are you referring to?
Hess Corporation.
Not the working interest owners?
No.
Did you also learn more about the tariffs?
Yes.
Okay.
Because yeah, we received the calculations for the first time.
And before we get there, I just wanted to go back to page 6 with regard to who's controlling Hess Corporation, Hessam, so forth and so on. Did you obtain additional information about that?
Yes. So the Hess Midstream LP 10K, under the management of the Hess Midstream LP section, at the end of it, well, I can read it. It says, "We are managed by the directors and officers of Hess Midstream GP LLC, the general partner of our general partner. We sometimes refer to the directors and officers of GP LLC in this annual report on Form 10K as our directors and officers. Because our general partner is a limited partnership, we are managed by the director and executive officers of its general partner, GP LLC, a wholly owned subsidiary of HIP, Hef Infrastructure Partners. Our shareholders are not entitled to elect our general partner, the general partner of our general partner, or the directors on its board of directors, or directly or indirectly participate in management of operations." So,
When you're reading, can you read a little bit slower so the court reporter can get everything down?
I'm sorry. Yeah, we thought that was important to show because Mr. Fraley talked about different shareholders and different board of directors. So we thought that was important to demonstrate, yes, they do have different shareholders, but those shareholders don't have any say in the management or decisions of the company.
And for instance, who is the CEO of Hess Corporation?
John B. Hess.
Who is the CEO of Hess Midstream?
John B. Hess.
Now let's go back to the tariffs. And on page 7, you start discussing that in your second report, your first supplemental report. What additional information and work did you do with regard to the tariffs?
I'll call it, we processed it. Myself and Cody Empson, we analyzed, looked in agreeing the actual calculations to the contract and the model.
Was the tariff model easy to work with?
No, it's very counterintuitive. Each spreadsheet, I want to say, probably has maybe 20 plus tabs in it, and I mean it's automated very nicely. It's pretty impressive whoever put it together. It's links and NPVs and a lot of really cool Excel formulas.
Okay. Could you look at Exhibit A46, please? 46-1.
A46 1A.
Yep.
Okay.
What is that?
This is a hard copy printout of the Hess Red Sky Gathering System. I believe this is one second here. I'm sorry. I pulled one of these out so I could get to it sooner.
If you have one that you're more familiar with, we can certainly use that one.
So, yeah, this is the spreadsheet, but it's lower in the spreadsheet. 46 6A kind of is the substantive part.
Okay, so you're at 46.6A.
Yes, sir.
Okay. There's a lot of very small numbers on here.
There are.
Could you just sort of walk us through what this gathering tariff calculation, how the model works?
Yes, so. Is everybody there? Are we good? Okay. The top section below where it says discounting date, IRR 20 or 12% and tariff escalation 2.4%, there's cost estimates. And column D is the initial capital for the system. And then it goes on, D through I are the certain types of costs.
What is item H?
That's operating expenses.
Okay, and what is the importance of including operating expenses in that place?
Well, this top section simply sums up all of the expenses that are going to be recouped or gain a return on investment, except for some of the items that are pass-through costs or offsets that are in the section below. For instance, compression revenues, they receive those because it's a 25 cents an M. They offset the operating expenses. And also there is power and utility pass-through. So then you come up with row P, which is the net or required cost of recovery, they call that. So you have the 277,909 million. That's the capital expenses.
That's in line I.
Well, it is. It's in line I and P.
Okay.
It came down, sorry, because there's no reductions of the capital expenses. And then, so for instance, in 2014, you see the 60,121,000. And that's a result of basically I minus O, even though the little red formula is take all the components. But that's the result of the sum of the cost required and then the add backs. So the 60,121,000 is the cost that the formula is going to use when it calculates the net present value at 12% discount.
Okay. And what is net present value?
So it's basically the value, kind of an abstract concept. So the formula below, if I could explain what the formula below does, and then it might be
Yeah,
easier.
sure. Go ahead.
The formula below, where it says 208,584 in row Q, what that does is that takes all of P all the way through the end of the spreadsheet, and those are the anticipated dollars. Actually, this is 2019, so it's historical data for 14, 15, 16, 17, and 18. And it says, discounted at 12% rate, the 208,584 is how much that money in the future is worth now. I may have said that backwards. Let's see here. Yeah, because $1 now is, in this time period, is worth less later on because of inflation. So $1 buys you less now than it does later.
Okay. And you use the term NPV and then XNPV. What is the difference?
Yes, so net present value is you have even time periods, even years through. NPVs are used in valuation models. If you're assessing you're going to buy an asset, you want like an NPV 12, NPV 14 or something like that. That shows you what your return is going to be. And XNPV means you have an uneven year. So that first year, it didn't start. It started in December, then the next years were June, 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 which is, we'll call it the fiscal year for the tariff calculation, I guess. So if you have different time periods, you have to X and PV in there, and Excel uses that and knows the difference.
And you also mentioned 12% a few times. Why do you do that?
That is the return on capital rate and the gathering agreement, and then the Tioga processing plant has 14%. But the tariff calculations are literally identical. It's the same math going through, obviously different source numbers, but
Okay.
yeah.
And you use the phrase return on capital. Is that a defined term in the agreements?
No, it's not. Well, define, I suppose.
Okay.
It says return on capital is 12%.
Does it explain why 12%?
It doesn't say what return on capital is. And it's capitalized, but it's nowhere in the agreement to say what return on capital is.
It's just a number.
Well, the way, I mean, when you say return on capital, kind of a standard definition I would think is return on your capital expenses to build something. It's return on your capital. But in this sense, it's the calculations, as I talked about a second ago, it adds capital and operating and everything into one homogeneous dollar amount. And then the formula takes that dollar amount, says we need this much revenue to return 12%, internal rate of return. So I think there's been some testimony that we're only getting a return on capital, but that is absolutely not what this spreadsheet does. It takes a return on all of the money spent.
Okay, including operating expenses?
Yes,
All right.
the estimated operating expenses.
And you use the term, I think, IIR, internal rate of return.
Yes.
Why do you think, is that mentioned in the tariff model?
It's mentioned in the actual tariff models themselves, the calculations, and the exemplar that's included, but it's not mentioned in the contract. It says return on capital. But that's a standard way to measure what your return on an investment is, or return on it. IRR is very standard.
And where is it mentioned in the tariff model? We're in 46-6A.
Well, up top left, it's a done cell. In other words, that cell doesn't link or tie to anywhere, I believe, but it just says IRR 12%.
Okay, so where on 46-6A does it say what the tariff rate actually is? What it ends up being?
So this is 2019. So the rates prior have already been calculated, and they're not on here. All that's important is what the cash flow is, really, for the earlier years, the net cash flow. So if you go to line Z, for instance, that is the tariff rate that was used in 2019.
So you have to go to line Z, go to the right, and then come down from 2019 on the top?
Yes. Basically, line Z, the calculation is, I'm going to do my best here because I've been looking at this in Excel, and you can trace the formulas better. But it takes the line Q, the 28,584, and line Y, which is 78,581. I haven't talked about line Y, but it does the same thing as Q does, but it does it for the volumes. So it takes the net present value of the dollars for the whole time period divided by the net present value of the volumes, which is a little bit odd. I haven't seen NPV applied to volumes before, but the math still works. And then it also takes into account row C. I haven't talked about that yet, but that's meant to represent the CPI. The Consumer Price Index is kind of, I guess you would call it an inflation factor. And then it comes up with the $2.87 for tariff rate for Hess equity gas, or all of Hess Bakken gas going through.
So in other words, the tariff charged for gathering services on the subject wells, the tariff rate for 2019 was $2.87.
Yes.
In 2019, did the Hess midstream assets accept gas from third parties?
Well, in 2019, just to be clear, 2019 is projected. So I can't say that they accepted any gas yet in this model because this is all estimated in 2019.
Okay.
But
Does
they,
this model come up with a rate if they did
yeah,
take the gas?
they do project 5,780,000 MMBTUs going through the system at 62 cents.
So third parties would be charged 62 cents, and the applicants are being charged $2.87?
Yes, and I think there's been prior testimony where that's going to be interruptible. Maybe it has been, but the Hess rate, let's see, 4 times 60, is over 4 times the third-party rate.
I want to go back to your first supplemental report, which is Exhibit 41. On page 12, you discuss some of Hessam's statements regarding these contracts.
I'm sorry, give me one second.
Sure.
Is that mine, or is that yours? No, that's yours, sorry. You said the second Exhibit A 40?
41.
Okay.
Oh, which actually is yours. I'm getting ahead of myself.
Sorry.
Oh, no, I am on 40. Sorry. I just misspoke.
You're on 40?
40, yes.
Okay, bear with me. It's here. Oh. Found it.
There was testimony yesterday about, and everyone's aware of it, varying oil prices, varying oil production. It's just a fact of the industry. Did Hessam's 2020 10K discuss the impact of those vagaries on these transactions?
Yes.
And what did it say? I'm on page 12.
Okay. Well, this was from their investor relations presentation. And they highlight long-term commercial contracts with Hess, parentheses, Hess-Bakken. And it says 100% fee-based contracts minimize commodity price exposure. Absolutely. That's why people like to be in midstream. You're going to get your tariff rate whether prices are high or low. Granted, production can sometimes drop when prices are low because people aren't producing as much, so you may have a less price per commodity, but the commodity price doesn't affect you as far as the price that goes through there. They have minimum volume commitments, which
And what is that again?
it's basically says you're in those scheduled volumes in the contract, it's going to say how many volumes that you dedicate to it. But if something happens where you drop below that, you're still going to have to pay a fee for, and it's 80% in this case. So if they said we're going to put through 100,000 in the estimate, they have to put 80,000 through. If they put 70,000 through, they're still going to pay for 80,000.
And who does that protect?
Well, it protects the bid stream, but there's reasons. I mean, you see them in most contracts.
Okay, and I interrupted you. I think you're on the second or third bullet there.
Annual fee recalculation supports cash flow, stability, and gross visibility. So, yeah, it does recalculate every year. The
tariff recalculation.
The tariff fee, and I think it's an option by either the producer or the gatherer to recalculate every year, but it definitely has been recalculated every year, which is typical for cost of service. Oftentimes you do, even though you do it in a different way, but cost of service, it's not abnormal for them to be calculated every year.
And then continue on. You have a bold with some additional bullets.
Okay. Yes, 95% of revenue is protected by MVCs through end of 2022. I think about that. I thought it was 80%. I really feel like the contract's at 80%. I'm not sure.
Let me just ask this question. Whose revenues are being protected?
Midstream, Hessam. I can,
Going on to the page 13, the section titled Fee Recalculation Mechanisms Deliver Cash Flow Stability. What does that first bullet say? If just remember to read a little more slowly.
okay. Annual fee recalculation to maintain targeted return on capital deployed. So if they spend more money to build more pipeline, improve it, do whatever, it's going to be guaranteed that you're going to get that 12% as they calculate rate of return.
And who is going to get that 12%?
Hessam,
Who's going to pay for it?
everybody that goes into it. Working interest, op, non-op, everybody. Well, everybody except maybe third parties, because they got that 62-cent rate.
How about the second bullet? Why is that important?
This is one thing that I noted. It's interesting that they've touted it, but it says if they brag, I mean, if we take more gas than we think we are, we get that revenue, and we don't include that in the next recalculation. So if you're an investor, you're going to love that. Absolutely.
An investor in?
Hessam.
How about that third bullet? Capital above forecast increases adjusted EBITDA. What does that mean?
Let's see here. That means if you go over budget, you make more money.
If who goes over budget?
If Hessam, because I mean it's pretty clear they schedule that amount, but whatever they spend is going to go into that tariff rate, and they're going to get the return.
The next heading is contract structure supports continued revenue growth. Whose revenue growth does it support?
Hessam. I mean it's a Hessam Investor Relations.
In the second bullet, is that essentially the same as capital above forecast increases adjusted EBITDA? Same
Yeah,
concept?
incremental capital drives additional revenues. Yeah, we spend more, we make more. And this is Hess. This is on Hess's documents.
Yeah, and you're familiar with investors' relations presentations generally?
Yeah,
What is the point of them?
gain investors.
On page 14 and 15, you do some analysis. Did you later come to rethink this?
Yes. Yes.
And just generally, we'll get into it in the second supplemental, but what's the issue here?
I went into some kind of reputable websites, academic definitions of how the net present value works, and how the consumer price index worked. Like I mentioned, the formulas are very complex, and I kind of pride myself in I'm being good at Excel and figuring these types of things out, and I use a lot of these things. But I think I missed the mark on a couple of these items, and we were still trying to figure that out, and that was the point where we sought additional expertise on the NPV and the tariff rate calculations, and we reached out to Dr. Mark Cronshaw.
And is that addressed in your second supplemental report?
Yes.
On page 16, there's a heading, producing overhead charges. By the time of your first supplemental report, had you learned about Hess's unilateral recalculation of producing overhead?
I did, and I stated that in my report, how Ms. Adair explained it to me.
Did her explanation, and I think I may have asked this earlier, does her explanation make you think that what Hess did is reasonable?
No, it makes me understand what Hess did. It was very clear after she explained it, and it makes sense. But no, I do not think it's reasonable.
Okay. And on page 23, You have a chart dealing with, I believe that's producing overhead. And what is the point of that chart on page 23, Exhibit 40?
This was a comparison of other wells that Sinclair, well, either they operated or had other operators, and they provided me some jibs. I asked for some sample jibs to see what other rates were in the area. And the top rate is the recalculated new rate from Hess without a JOA. If you notice, I put whether they had a JOA or not a JOA in there. Any of the other analysis that Hess provided didn't say if it did or it didn't.
Why is that important?
Well, because if it's a JOA, I mean, you're definitely stipulated to use that rate plus your COPUS escalation. So the top one was,
This may be obvious, but is it
Sorry.
a JOA the result of a negotiation?
yes,
Okay. Between parties with different interests?
yes.
All right. Keep going.
Second one was Hess, the Kivankara. I'm probably butchering names again, I apologize. It shows what the rate is for that well, and that's also a Sinclair well. And then a couple Sinclair operated wells, what those overhead rates are. I think Mr. Macbeth talked about how they go about that. And if you notice, the Sinclair State 136 has a JOA. The Nelson 126 doesn't. And
Do the rates differ?
they happen to be the same. Not that they have to be the same, but they happen to be the same in this case. You know, if you spud a well at a different time, it's a different time and place, you might have a different negotiated rate, or you have a different operator that may have power and the non-operator has power. There's all sorts of things that go into the rate negotiation. But negotiation is a key thing. Then we have an EOG one with a JOA, and then we have an Oasis and a Whiting without JOAs in those rates. And it just compared all those rates.
And how does the Hess rate for the Uran well compare to the others?
It was much higher.
All right, let's turn to Exhibit 41-1, which is your second supplemental report. What additional work did you do? And maybe let's just get into it. We'll just go through each item. On page 6, there's a Roman 3 that's titled Gathering and Processing Tariff Rate Comparison. What additional analysis did you do there?
So, on my first deposition, I was asked why I chose June in every year. And
Chose June for what?
June for my rate analysis for my sample. So when you're looking at massive amounts of data, large time periods, you pick some sample months. And based on whatever document availability I had, I could find, there was thousands and thousands of pages, what I could find for the applicant wells in the time periods, I chose June of every year. June 2017, 2018, 2019. I wanted to go through the whole time period to see what that looked like if it changed over time. And I was asked why I didn't choose winter months instead of just summer months when commodity prices might be lower, so it might magnify the fees were higher under low commodity months. So I was asked about that.
So initially, did you choose June to avoid winter months?
I chose it totally. It was, well, it's the start of the fiscal year on their tariff. And it was just, there was a lot of documents, and we went through to find as many as we could, and we found June for all the years at that time. Not saying there wasn't other documents, but those are the ones that we found. And so we used June through the 5 years or 6 years, 4 years, 5 years. So I asked about that. Thought it was a good point. So I went back and we picked another month. We picked winter months. Sometimes we may not have been able to perfectly find that month for the particular wells. So like 1, 2, 3, the fourth line down, I say November or December 2018 because I may have not been able to find a statement whether it was a Robinson Palermo or a Tioga. Lots of statements, lots of data. So I did pick winter months though for all the time period, and there really isn't any change in results.
And that's reflected in Table 1 and Table 2 in your report, pages 6 and 7.
Yes, yes.
I also see the acronym VRU in there.
Let me stand corrected. I'm sorry. On Table 2, in January 2018, there was 1 month where the revenues actually were higher than the expenses going through the Tioga plant. There was 1 month.
But overall, did selecting different months in this report change your overall conclusion?
No. I mean, from time to time, revenues won't exceed expenses. It happens. But I haven't seen it where consistently over a 5 or 6 year period, every single month for gas revenues, where expenses exceeded revenues.
Okay. Did changing different months change your conclusion that the deductions at Tioga are significantly higher than the ones at Robinson and Palermo?
No, it did not. And I mean, it's really not my opinion. It's in these tables. I mean, these are straight from the plant statements. I guess it is my opinion also, but it's not like I'm opining whether 480 is higher than 240.
Right.
It is.
It's not an issue of whether you like the color blue or red better. It just is what it is.
Yes.
Okay. Vapor recovery units, what are those?
So, thank you for reminding me. That was one thing that I left out in my initial analysis. When you have oil in a tank, it can be volatile and it'll have vapors, and you want to capture that. Well, it can be unstable for one reason, but you want to also capture it because it has value. And so those were accounted for in different plant statements from Tioga. I didn't catch that in our initial analysis, and that was pointed out to me. So in this analysis...
When was it pointed out?
It was pointed out when I was deposed, asked why I didn't include them. I said, because it didn't occur to me or I didn't realize.
You thought that was a good question?
Yeah, because sometimes the VRU might go back into the gathering system, then you get one plant statement. In this particular situation, that they accounted for those on separate plant statements. So I added those into my analysis to be fair.
And did that change the outcome of your analysis?
No, I mean, it added a little bit of incremental value, but some of the VRUs were also negative too. So some of them, I think there may have been a few positive. I don't know. I have a more in-depth schedule that shows, but it didn't materially affect it.
Okay. I want to turn to page 8, which talks about gathering and processing tariff rate calculations. But before we go through your report itself, did you consult with Dr. Cronshaw in the time between your first supplemental report and your second supplemental report?
Yes.
About what topics and why?
About the tariff model. It was a tariff model. We didn't really ask for any help on the overhead issues. It was the tariff model.
Okay. And just starting on page 8, if you could sort of run through your report and what the highlights are that the commission should consider.
Let's see here. At the end of the day, the models return based on all of Hess's projections and Hess's actuals. There's no new numbers. They return a higher amount than the return on capital that's stated in the contract.
And when you say that, are you opining that the return on capital of the contract would be reasonable?
No, I'm just saying we got 12%. Does this model calculate 12%? And it calculates higher.
So in other words, the tariff model was designed to guarantee a return of 12% for gathering and 14% for processing.
Yes.
And the actual application of the model overachieves that result?
Yes.
Okay. We'll talk, well, we can talk about it right now. So we talked a little bit about primary and secondary terms. Mm-hmm. How does that interplay with the overachieving?
So the primary term is for the first 10 years, and it has been recalculated every single year. So the way the formula works, the NPV formula, which again, I really haven't seen much in those in cost of service models, but it takes the whole time period, all those 10 years, and calculates a net present value of that dollars in at the beginning of the Tioga gas plant. And then it also does the same thing for the volumes. But it doesn't take into account the secondary term or the next 10 years. But to do that, the formula uses, and it's a defined term in the contract, it's called residual value. I haven't seen residual value necessarily used in that way. It's the undepreciated capital costs is what that is. And so that undepreciated capital cost gets included into the net value presentation, if you will, to represent the next 10 years. And by doing so, it gives credit, it calculates those costs that a return needs to be a rate. It creates a cost where there needs to be revenue to create a return on those costs. But the problem with that residual value that's used and defined, and it's doing what the contract says, the tariff is, but that is not a real value of the next 10 years of the asset. The next 10 years of the asset is much higher based on Hess's projections. Hess includes those second 10-year projections in all of the models. They don't use them because they go by the way the contract says on the recalculation. I have to look to see if the contract says, but yes. But
And what's the effect of that?
what we did is we took Hess's projected cash flow for the next 10 years, which is much higher than that residual value. So when you do that, and when you calculate the rate of return, that takes the net cash flow for that whole time period, and that resulted in a much higher rate of return than the models. And it really can't be corrected. Granted, if the plant blew up and it was shut in 2024, they wouldn't receive more than 12%. But if it continues to
Nobody's
go,
planning on the plant blowing up?
I
in
don't think so.
2020?
I hope not. If you keep going forward, you'll receive a much higher. And like I said, that's based on Hess's projections.
You mentioned residual value, and the definition of residual value is actually is from the contract and is in your report, right? Page 8?
Yes.
Okay. And you mentioned that you've never seen another definition of residual value like this?
I want to see what I said before I answer that. It's not how I've seen residual value used. That's just your undepreciated amount of your capital cost. This is a net present value model. It's almost like a valuation model used to calculate a rate through the whole time period. And I guess we've used apples and oranges once or twice. It's kind of an apples and oranges using that type of residual value in this type of net present value model.
Does the definition of residual value in the contract have anything to do with what the asset will actually be worth at the end of either the primary term or the secondary term?
No.
And the asset being Tioga Gas Plant and the gathering
Yes,
system?
or the gathering system, yes.
Sure. If you could turn to pages 10 and 11. And there's a table 3 on page 11. What is that?
It's, if anybody would like, it's somewhat explained in table 3 as best that I could. But I can talk through it a little bit.
Sure.
It shows how, as the contract says, between Hessum and Hess Trading Company, based on the residual value that they use and the schedule that they have, that it returns an internal rate of return at 12%,
And we talked about
based on the
this-
cash flows. I'm sorry, I
Sure.
spoke over you.
We talked about this a little bit with regard to the A46-6B. That spreadsheet.
Yes.
Okay. So your report is sort of summarizing some of that analysis, right?
Yes, that's a formula there where it says IRR 12%. It paints all the cash flows, and you can see at the end in 2024, that 278,412 is the residual value. It's the unamortized or undepreciated amount of the gathering system.
And what is table 4 on pages 12 and 13?
Okay, so this one, it's stacked, if you will, where the table 3, it just used 10 years and it went all the way across. This is stacked, and the top of it's
When
20.
you say stacked, what do you mean?
It means the page isn't wide enough to put 2013 through 2033 landscaped.
And you're referring to page 13.
Yes.
Okay,
Yes.
cool.
So the top of it is the cash flows from the actual cash flows from Hess's tariff statements and from reality from 2013 through 2023. Granted, the blues on the top are actuals because that's happened. 19 through 2023 are Hess projections. And this takes the costs, the revenues, and calculates a true actual cash flow before tax for this time period. Through 2018, it's real. And then through 2019 and 2023, it's projected based on Hess's projections. Then if you go to the bottom, 2024 through 2033, these are based on Hess's projections. But the difference is in Hess's model, they use that they use 278,412 to stand for the value for the whole second term for 2024 through 2033. But as you can see at the very bottom above table 4.2, this is the before tax cash flow based on Hess's projections for the next 10 years. It's much higher than the 278.
And if you could turn to slide, I forgot about the demonstrative, slide 12.
Can I go down to the bottom? I'm sorry.
Oh, sure.
Or,
sure.
or finish?
Oh, sorry, keep going.
Yeah, I mean, well, I was kind of in there. I figured
Sorry,
I'd just-
I don't want to disrupt your flow.
Sorry. Then 2.4, or table 4.2 at the bottom in blue, those are calculating the net present value of the cash flows. So similar to the net present value, excuse me. I'm getting ahead of myself. The bottom of this uses the net present value for the next 10 years, and then in doing so calculates the internal rate of return of 15.8% instead of the 12%. And the formula can't be adjusted in the second term because it's recalculated in the first years of the first 10 years by either party, and it was recalculated every year. In the second term, it's stipulated in the contract that it's somewhat of an average of the last 3 years. Then that's locked in for the second term. There's some nuances where it's the second to the last year times the consumer price index for the 2 years. Then it's the next year times the consumer price index for 1 year. Then it's the next year. So the average of those three is the average rate that you kick into the second term. And then it's just escalated by the consumer price index from there on out. It's kind of locked in, if you will. Well, yeah, I'm going to stop there for now.
Okay, let's go to demonstrative 12, page 12.
Okay.
That's your
Oh,
report,
Sorry.
right there.
Okay. Okay.
And this is sort of a summary of what you've just been discussing, correct?
Yes. Short-winded.
Yes. And we talked about, for gathering, return on capital is divided to be 12%, and the IRR is 15.8. I don't think we've talked about processing. Can you discuss that?
Yes. I mean, it's exactly the same, except the numbers are different, the input, the plant had a 14% rate of return in that contract, where the gathering system had a 12. Modeling through the life of the contract using Hess's projections. For Red Sky Gathering, it would achieve a 15.8% rate of return and processing of 18.1%. And Hess is going to say, well, the contract says return on capital. Well, return on capital is not defined. It just says 12% and 4%. And their model gives a return on all money spent. So I suppose if capital meant all money, that would work, but the way they tie that return on capital and use the residual value, it's only the capital expenses. So I just don't think if there was, well, there's a few things where I think if this is a true third-party contract that wouldn't have worked.
Such as?
Well, not truing up the operating expenses, for one. Not allowing additional revenues and not getting credit for it, number two. I think we'll probably talk about the 12%, 14% later. And then that second term, well, I can't say for sure on that, what a third party, because everybody has different objectives and goals when negotiating contracts.
So the end result of the analysis you just talked about is tariffs larger than they should be, even under the terms of the agreement, right?
Yes.
And if you could look at page, I'm going back to your report now, which is Exhibit 41, page 16, Table 6.
Okay.
And what does Table 6 show?
It shows, so we're using table 19 as an example. It shows if we modeled that through the whole time period and calculated a true 12% by using goal-seek if-then formulas in Excel, it shows what the rate would be for each year and then what the excess rate would be. But there's one caveat here, is it's a living model and it changes from each year to each year to each year. So this,
When you say it's a living model, what do you mean?
well, because it's recalculated each year. It's at least it's living through the primary term. So the calculation takes into account all years when calculating the tariff, the net present value for that whole time period. So in this case, we just took the models as they are, standalone, and each year ran that goal-seek function on Excel. So
What is a goal-seek function?
it's, you can put in parameters in Excel and say, if you change this and you change this, what or if I want this to achieve 16%, you put that in there in that formula, and it'll change all the numbers to do that. So this is just an example. Of each year standalone as is what that fee would be. But say if 2014 we ran that model and we only charged 63 cents instead of 74 cents, that would affect the next year's model. This table does not take that into account. It's just an example from one year to the other. So this isn't how a damage would be calculated if we arrived at a rate. This is just an example of how it would affect each particular year.
Let's talk a little bit about reasonable returns. And I think you mentioned this earlier. You're not opining that 12 and 14% would be reasonable rates of return, correct?
Correct.
What are some ways to think about reasonable rates of return?
This is also another area that Dr. Cronshaw helped. FERC, and I think the NDIC has even heard some cases where the WACC, stands for weighted average cost of capital, where how much is your cost? If we consider cost of capital and actual cost, that would be a cost that would go into the calculation. In some of the earlier Hess models, we saw 9%, and we took that and used it, knowing that it may or may not be what Hessam's WACC was.
And that was in, I think, a box on the model called
Kind of-
assumptions.
Yeah, kind of in the top left of some of the earlier models.
Okay. Are you familiar with any previous determinations made by the NDIC of a reasonable rate of return?
Yes, there was an order.
I think it's on page 16 of your report.
Yes, it discusses an operator was using a operator-owned equipment. It may have been an affiliate. Sometimes we use those terms interchangeably, where they had a return on component, not return of capital, but return on capital. And they were using different rates, but they never were able to come up with their WACC was. So the commission compared it to what the prime rate was at the time and figured out a ratio to, I'm paraphrasing, but it's pretty explained there in bottom page 16. And do we have that order as an exhibit?
I don't think so, but the order number is there,
Okay.
3789. And could that method be applied here?
I mean, the NDIC has used that method in an earlier thing.
Okay. What is Hessam's WACC?
I don't know.
Okay. Has Hessam ever said?
No, they have not. I think they've had every opportunity to. They provided a comptroller data from 2014, 2015 that showed what Hess Corp's WACC was, but not Hessam. And, we don't know what we don't really know anything about what Hessam's WACC is.
Okay. Would Hessam's WACC, weighted average cost of capital, be the same as Hess Corp's WACC?
No.
Why not?
It's just a different entity. Hess Corporation has upstream, midstream, downstream. Heck, in 2015, they were in the Gulf, I think, operating. I can't say for sure, but they were, I believe, still in other places at that time. I don't think it was just in North Dakota, but I could be mistaken.
Following issuing your second supplemental report, did you obtain any additional information about appropriate WACCs for midstream companies?
Yes.
If you could turn to A65, and I'll just give you my copy.
I think I have that.
Do you have it?
Yes.
There it is.
Okay. This is,
Just wait 1 second. I think people are turning.
okay,
still.
sorry.
And hearings
Council,
at
we've been going for quite a while now. What's your timeline to finish up?
Probably have another 20 minutes. We can take a break if that would work.
Take a break right now, right now?
10:30, sure, that works for me, if that works for the commission.
Okay, yeah, let's take a break for about 15 minutes and we'll come back on in 15. All right, thanks. All right, it's 10:50. We'll come back on the record. I'll just remind you, you're under oath, and you may continue with your direct examination.
Thank you. Mr. Attella, have you obtained information regarding wax for midstream companies during the relevant period of time?
Yes, this Exhibit 65, it's an article from Deloitte. They're one of the big four accounting firms. In my opinion, very reputable source. And they did an analysis on midstream companies. Let's see, this was dated copyright 2018, I think. And it talks about the weighted average cost of capital for midstream companies. Page 5 of the document. It says, an analysis of 122 midstream companies highlights that the sector's weighted average cost of capital, WACC, reached a 7-year high of 7.9% in 2017.
Do you consider this a reasonable and reliable source?
Deloitte, yes, they're very reliable. And
And Hessam has never disclosed what they believe their WACC to be.
they have not. They state here 122 midstreams, and it's sourced from Bloomberg, Capital IQ, and Deloitte Analysis. So I think Bloomberg would be very reputable as well. And 122 is a big basket for sure of midstream companies, but we haven't seen Hessam's.
I'd offer Exhibit 65.
I object to the admission as an exhibit. I don't object to the testimony, and I'll cross-examine the witness on it, but this is just hearsay that was not disclosed in any of the expert reports.
Counsel, was this previously disclosed?
Yeah, we used it at Miss Adair's deposition. They've had it since June 1st at least.
Okay, your objection is noted, and the exhibit is received.
You used the term FERC earlier.
I'm sorry, you mentioned, okay, we're still on 65.
Oh, no,
Oh, no,
you can put that away.
okay, my apologies.
You used the term FERC earlier, and I want to skip to our next demonstrative. You can just flip it over there. It's titled Comparison of FERC COS Approach and Hess Tariff Model. What is FERC?
FERC is the Federal Energy Regulatory Commission.
And does FERC regulate transmission systems?
Yes,
What type of transmission systems?
interstate, going from one state to the next where it's a,
Does for instance, in this case, the Red Sky Gathering System, is that regulated by FERC?
no.
And the slide title is, and uses the term FERC cost of service model. What is a cost of service model?
Cost of service model is something that you use to calculate a rate to transport or process similar to the tariff model.
And we've heard Mr. Donovan, I think, in his opening refer to the tariff model here as a cost of service model.
I believe so.
Do you agree with that as characterization?
In the broad sense, I mean, it is a cost of service.
Okay.
Haven't seen one like that used in my experience.
Okay. Does FERC also deal with cost of service models?
Yes.
Okay. Do you think the tariff model here is akin to a FERC cost of service model?
Is akin.
That's a bad word. Is it?
Maybe cousins.
Okay.
No. Using the term. I mean, it calculates a rate per MMBTU, a rate for service, which a cost of service also does. But it's not like one I've seen.
Okay. If you could turn to the next demonstrative slide, 14. And there's a number of bullets there, and maybe you could just walk us through there and compare and contrast the Hess tariff model with a FERC cost of service model.
Let's see, the first one, Hess tariff model uses historical costs and projections for the remainder of the primary term. Usually you see cost of service models can be or annual, and then they're going to recalculate each year. There'll be probably get ahead of myself and explain exactly what it is, but there's usually a capital component where you're going to, whatever that return on your investment is, there's going to be a figure, whether it's 2%, 10%, 100%. That's going to be a component. There's going to be a return of capital, and that is your amortization for that particular year.
Second bullet deals with residual value. Why is that important?
Because that stands for the whole secondary period, the whole 10 years. And it used that 278 million, where based on Hess's projections, that number is much higher, which is the reason for the higher rate of returns based on Hess's projections.
Okay. I want to skip down because we talked about some of these. Again, the only definition of return on capital in the agreements is just the numbers, right?
Yes.
And the next bullet talks about the Hess Excel spreadsheets. Why is that important?
Well, the spreadsheet does what's supposed to. It designs a return of 12 based on those rates, based on all those components. And it does go by the contract. But I think if you had two parties negotiating a contract and there was something as substantial as return on capital listed, it would probably be defined.
Okay. If it was a negotiation between third parties
Yes.
or non-related parties, is the specific definition of residual value in the Hess contracts necessary to achieve the guaranteed rates of return?
In Hess's model, yes.
So now there's some bullets that talk about some of the differences. Does a FERC cost of service model use MPV?
No. And neither does any cost service model that I've seen in a lot of my work, even doing some of those for our other operators.
So not just FERC models, you haven't seen that MPV in any cost of service model
Correct.
other than this one.
Correct.
Does the cost of service approach use depreciation?
Yes.
Okay. Depreciation of what?
The capital asset.
Okay. Does the Hess model do that?
It doesn't use depreciation. It does use a unit of production depreciation method to come up with the residual value,
Okay.
which stands for the last 10 years of the secondary term.
Okay. I want to skip to the bottom here. And this is sort of what we've been talking about. Do you think the Hess model tariffs are accurate reflections of actual costs?
Well, I know for a fact for the first through 2020 it's not, because it says it in the contract. It says it's estimates. So it's based on the contract. Unless I didn't go by the contract, it wouldn't be actual costs. And they're recouping more than actual costs based on, I'm retouching again, the volumes if they're in excess, which we demonstrated they were twice in a 7 or 8 year period, so 25% of the time, based on Hess documents. And then reasonableness as far as comparing to other providers in the area, it doesn't look reasonable either.
Okay. If you could flip to the next demonstrative, which we're almost done here. You talked about your view that post-production costs are not actual and reasonable. How about producing overhead charged by Hess? Is that actual and reasonable?
So overhead's kind of a strange thing where it's deemed to recoup indirect costs. So you have three types of costs that we look at, and this is based on COPUS, joint operating agreements, accounting procedures. But there's still three types of costs. There's direct costs, section 2 of the accounting procedure. There's indirect cost. Example of direct cost would be you rent a rig to drill a well. You have a pumper to gauge the tanks. You buy chemicals so you don't have scale problems. That's a direct cost. It can be labor. It can be a tangible thing, pipe that goes in the well. Then you have indirect costs, and those are things that are addressed in section 3 of the accounting procedure. Excuse me one second. Indirect costs are deemed to be covered by either the drilling or the producing overhead rate. And those are things, they call it supervision above the first level for E&P operations, regulatory reporting for the well, reports to the North Dakota Industrial Commission, maybe field offices depending on which accounting procedure it is. Then there's a third bucket, and it's called corporate costs, or costs that aren't intended to be recouped. And AG 23 specifically talks about that type of cost as well.
And do you discuss this in your first supplemental report? I believe Exhibit 40 on page 20? We can go there.
I'm sorry. I
Actually, page 18, continuing on.
Actually, I think I talk about that earlier when I talk about the producing operator, the producing overhead calculation. It might be in my second report, not my third.
Yeah, I think it is in your second
Oh, I'm
report,
sorry. I
which is,
missed.
Exhibit 40.
Okay. My apologies. Yes, I did talk about that. There's items like North Dakota executive management. That would be considered a corporate cost, not supervision or first level supervision or levels above the first level for E&P. If you want to go to accounting guideline 23, which Hess used.
And it's already been admitted,
I'm
so
sorry.
maybe you can just talk about it.
Okay, it's Exhibit A66. When it talks about items to consider and overhead negotiation, it talks about executive management, corporate, downstream, and then states corporate and downstream generally not recoverable through direct charges or overhead, unless parties agree otherwise. Obviously, no parties agreed to this. They did that without contacting any of their non-operators.
And I just want to make clear how we describe your concern here. Obviously, we've talked about your belief that COPUS guidelines, and you've never seen in your industry practice a situation where an overhead rate was set, escalated according to COPUS, recalculated, and then began escalating again, correct?
Yes.
You don't think that was reasonable?
No. Well, and there's a reason that COPUS set the standards to do this. For instance, this spreadsheet, Exhibit 57, has $215 million of costs after 1, 2, 3, 4, 5 columns of adjustments categorized in maybe 10, 11, 12 rows and categories. Then it has another amount for 17 million that's just called Bakken Upstream.
And what is Exhibit 57?
It's the Hess's overhead recalculation.
Okay.
Okay,
I'd offer Exhibit 57.
No objection.
sorry, I got ahead of myself.
No worries, keep going.
Okay,
Exhibit is received.
so the point I'm making though is if we were able to audit, we haven't been allowed to, but if we were, this would be an extremely complex audit.
Because?
There is lots of dollars, there's allocations. You know, we would have to get executive management salaries to verify that the labor is accurate or stuff. It's a lot, it would be a lot. And
How would you
COPUS,
even go about verifying that?
well, you'd get W-2s and, I mean, you'd have to get source documents that shows that 12,910,000, for instance, is ND executive management. But that's probably something that would be
You're referring
considered.
just to line 5 of Exhibit A57.
Yes, sorry. But that would probably, actually, it increases to 16 million over at the end on, to the end of that first section. But my point is, you'd have to audit this, and you'd have to get source documents, and it would be a very involved process. Well, in 1962, and from this point forward, COPUS realized this is too complex to audit. It's too much of an administrative burden for all these companies, so they came up with a combined fixed rate overhead, and they escalated every year. So you negotiated at that time, and then you escalated each year, because they knew operators didn't want to open up their books and show all this stuff, and it would be very time-consuming on both the operator and the non-operator. So just a general principle, that's why we have the combined fixed rate producing overhead, because the complexities it would be to validate all that stuff.
Let's go back to, sorry for jumping around, Exhibit 41, which is your second supplemental, and there's a Table 8 that has a comparison of producing overhead rates. It's on page 19 of Exhibit 41.
Sorry, I'm looking for that. Page what? I'm sorry.
19. What information is included in the Table 8 on page 19?
It is, I broadened my scope of overhead analysis. In my deposition, asked why I didn't include Continental as an operator or an XTO. I think they named 2 or 3 or 4 different big operators. That's why I didn't include those. Similar to the vapor recovery unit on post-production costs in the winter months, I followed up and I requested jibs from Sinclair to include those in my analysis.
And what does that show? What does the table show?
It shows that they're predominantly lower, but Continental had a couple higher rates. I believe one of these, the 2001-14, was also included in Ms. Adair's sample. Yeah, I believe the Quail was. And it showed that the same rate, but I don't really know when these were drilled. I don't know if Continental just recalculated a new rate and changed midstream, or if this is just a rate that they started with and then escalated as per COPUS guidelines.
Okay. Are you offering an opinion as to whether the Continental rate is reasonable?
I don't know what goes all into this, so I really can't.
Okay. So to sum up the Table 8 on page 19, there's 2 producing overhead rates that are pretty close to what Hess is charging, and the rest are all hundreds, if not more than $1,000 higher.
Yes, it's a nice broad sample with wells with JOAs and without JOAs.
All right. Yesterday, I think you heard the commission express a desire for some sort of specific requests from applicants. Remember that?
Yes.
And I want to start with request with producing overhead. What would be a specific request to remedy what you perceive as overcharging and producing overhead?
Escalate like they always did before, based on the COPUS standards.
And we went through Exhibit D to your first report, which is Exhibit A39-5, which does that, correct?
Yes, through September of 2021.
And-
just for the applicant wells.
And the gross number there was $468,536.69.
Yes.
That sound right?
Yeah, and we have about a 25% working interest, so just Sinclair's, or maybe Missouri River's, share, that would, be 100, 110, 115,000 for that time period,
Right. And going
Net.
forward, you would want it to be calculated
the same way.
the same way. With regard to post-production costs, do you believe that the Hess tariff model results in a reasonable tariff?
No.
What do you think would be reasonable?
Well, I mean, that's a tough question. We could compare it to the other gatherers and processors in the area, to come up with a reasonable rate. We could use a more traditional cost of service method, say like FERC uses, to come up with a different tariff rate. We could at least shore up the expenses to actual expenses and not budget and get credit for the volumes that weren't counted in the calculations.
So for instance, in your first report, Exhibit 39 rather, on page 6, you had deductions per MMBTU between Tioga, Robinson, and Palermo, correct?
Yes.
So could you take those and take an average of those three? Would that be something more approaching reasonable in your view?
I could. Tioga is the one that we're challenging, so that would obviously bring the rate up. But looking for a market rate for some protection against the affiliate transactions, that would be one way to do it.
Okay. And I think you mentioned you could create a FERC-style cost of service model.
We could. I believe that there is enough data on the tariff models to do that. Granted, we don't have actual expenses on the operating for the first 5 or 6 years. But, yeah, I mean, I think there's data there, and I'm sure Hess could validate some of the costs or provide us actuals to
Yeah.
come up with a cost of service, like a FERC cost of service.
Has FERC promulgated a cost of service rates manual?
Yes, that's where we pulled our data from.
Okay. And that's marked as, it's many pages long, and I don't want to go through it, but it's marked as Exhibit A61.
Yes, yes.
I'd offer Exhibit A61.
No objection.
Exhibit is received.
Is there a way to use the data in the existing Hess tariff model that would make a rate that would be something not reasonable, but closer to reasonable?
Can you rephrase?
Yeah,
I don't know, I had a
it's horrible
positive and a
It's
negative.
a horrible
and-
question. Is there a way that you can take the tariff model and make it result in a lower tariff than what you're being charged?
Well,
what applicants
I
need
could
to do.
use it, traditional cost of service model, and I feel be more accurate. Like I said, we still don't have actual operating expenses, at least for the first 5 or 6 years. It could be 4 years, I'm not sure. I'd have to look. But, yeah, I mean, I think the components are there. If everybody could agree on a whack for the return on capital.
And even if, in Exhibit 41, your third report, you had your tables calculating the excess tariffs, right?
Yes, those are standalone though. It's not a cascade or rolling where it changes each year. We did not go through all of them and recalculate all the next 5 or 6 each year. I mean, if we end up having to, we can do that, but we didn't want to go through all that exercise.
I'll pass the witness.
Just, I'm handing the witness and opposing counsel just a binder. It contains Mr. Atala's reports as well as his deposition transcripts.
Okay.
I'm happy to provide one to the hearing examiner if you'd like one.
Sure.
Okay. Mr. Talla, nice to see you. How are you?
I'm good, how are you?
I'm well. Now, you just went through a series of tables and charts with Mr. Vivian, and right at the end there, you threw out some ideas on how to get to reasonable rates, but I just want to make sure we're clear on a couple things. I took your deposition back in September of last year, right?
Yes,
At that time, you had issued 2 reports, right?
yes,
And I asked you at that deposition if you were offering any damages opinion, and you said no. True?
true,
Okay. And then after your deposition, you issued your 3rd and final report, right?
yes,
And I took your deposition last month, right?
yes,
And at that time, I asked you again, are you offering any sort of damages calculation? And you said no, right?
yes.
Okay.
Can I clarify one thing?
Sure, go for it.
We did have damages calculated in the producing overhead in the first report based on the COPUS escalation. And we have talked about this because the commission asked us if there was anything that we were asking for or ways to what we're asking for. So that's why we talked about that.
Sure, and you can look at your deposition if you'd like, but your first deposition, page 48, line 13 to 15, I asked you specifically on the topic of producing overhead question, you are not offering any sort of damages opinion here today. True? Answer right. Right?
Yeah, I did have it in my report though, so I guess I misspoke then.
Okay, fair enough. And even in your report, and we'll talk about this, in that report, you're not allocating that to any particular applicant interest. True?
No, it's gross.
Right. So even looking at the exhibits to your initial report, it wouldn't tell the commission anything about a number on even the producing overhead piece, assuming all your opinions are
Multiply
accepted.
by 26%. I just did that.
It's nowhere in the record right now.
Well, it is now.
Okay, all right. Now, you were asked yesterday if Martindale had asked for an audit of Hess before filing this lawsuit on behalf of applicants. Do you remember that?
Yes,
And you mentioned today something about that as well in response to Mr. Vivian's questions, right?
yeah. I think I said, if the way I recall, I would have probably asked Mia Downing to contact Hess and schedule that.
And who is Mia Downing?
She's our revenue audit manager.
She's worked quite a bit on Hess audits, right?
Yeah, she has familiarity with Hess.
Okay. Now, when Mr. Vivian asked you if Martindale had asked for an audit of Hess before filing this lawsuit, I think what you said was you were pretty sure the answer was yes, but you weren't 100%, right?
Yes.
Before applicants filed this petition in November of 2020, no one from Hess ever said no to an audit, did they?
I don't know.
I heard you testify a couple times, both yesterday and today, about the lack of information you've had for purposes of your analysis, right?
Can you give me specifics?
Sure. You said, for example, you didn't know anything about the Sinclair state wells, right? The state leases,
I have not looked at those leases, no.
right? Now, you've served as an expert in litigation before, right?
Yes,
You know what discovery is, right?
yes.
And were you aware that the commission in this particular matter has allowed years of discovery of Hess?
We haven't contested of sharing royalty owners' burdens on working interest.
Just if you would listen to my question, please. My question was, were you aware that the commission in this matter has allowed years of discovery of Hess?
Years? 2 years? Yes.
Okay. And did you know that applicants served discovery requests on Hess in this case?
Yes,
And did you have any input in those requests?
I believe so.
And are you aware that based on applicants' requests, Hess had produced something like 2,000 documents as of last summer of 2022?
Probably, yeah.
Now, that was before I ever took a deposition of you in this case, right?
I believe so.
Okay. Now, after Hess produces the documents, that's up to you and your lawyers and your clients to decide what you're going to look at, right?
Yes,
And you listed a number of documents in your reports that you had reviewed, right?
yes,
And you discussed some of those with Mr. Vivian yesterday and today, right?
yes.
You would agree with me that you studied a fraction of the 2,000 documents that Hess produced in this case, right?
Studied?
Studied,
Can you define study?
analyzed.
I analyzed quite a bit. I can't tell you how many. I would say it's probably more than a fraction. I mean,
Okay.
1,500 of them may have been gas plant statements. Well, I looked at 6 years, a month in the sample well, so I'm not gonna look at an extra $1,000 or 1,000 gas plant statements if it's not necessary for our sample.
Well, let's give some examples, right? Do you remember me asking you at your deposition, I showed you, at your deposition, I put a laptop in front of you. Do you remember that?
Yes,
Because a lot of the documents that Hess produced to you are in Microsoft Excel format, right?
yes,
Easier to look at those in Excel format, right?
yes.
Now, I put a laptop in front of you and I pulled up a document that Hess had produced to your lawyers at their request, and it contained 250 million lines of data from Hess's accounting system. Do you remember that?
Was it the capital costs?
I'm just asking if you remember that.
Yes, I believe so.
And you hadn't seen that 250 million line spreadsheet before, true?
Oh, no, I think I said, and it's in there, I don't recall, but then that jogged my memory where I have seen it.
Well, you're free to look at it. First deposition, page 277, line 14 to 18, question. My question is whether you've seen this document before. Answer, I do not believe we've seen that. I've seen this. Let's see here. Well, we got WBS project management. May I ask what this is? That was your answer to that question.
Okay?
Now, I tried to bring that document out today and bring it with me to remind you of it. Turns out that printing an Excel with 250 million rows is 18,000 pages long, right?
Killed enough paper, I
Okay.
think, already.
But I also showed you other documents that Hess had produced to your lawyers reflecting capital investments that Hess had made in North Dakota. Do you remember that?
Yes,
And I showed you another document and I asked you, had you seen this before? Do you remember that?
yes.
And you said, no, I can't recall. I can't say that I've seen this, right?
Okay?
And each of those two documents that I just described were from a single year, 2018. Do you remember that?
If that's what you're telling me.
Sure, I specifically asked you if I showed you any of the documents that mirrored those documents from other years, 2014, 2015, 2016, 2017, 2018, whether your answer would be the same, that you hadn't analyzed them. Do you remember that question?
I believe so.
And you answered, yes, your answer would be the same. You hadn't studied them.
The capital expenses?
That's right.
Yes.
Okay. Were you aware that Hess produced data extracts from its SAP accounting database for the years 2014 through 2020?
Yes.
All the materials that I just discussed with you just now, and also at your deposition, you've had an opportunity since then to study those, right?
I suppose?
And you still haven't, right?
Correct.
Okay. Now, you covered a lot of topics with Mr. Vivian over the last 3 hours or so between yesterday and today, and so I'd like to just define for the commission the outer limits of what you are and you aren't testifying about. Okay?
Okay?
All right. You're not an engineer, true?
Correct.
You've never personally been involved in drilling a well, true?
Correct.
You're not offering any opinion in this case about the actual drilling of any of the subject wells, true?
True.
You are not offering any opinion in this case about how Hess extracted hydrocarbons from any of the subject wells, true?
True.
You have never personally been involved in developing any midstream infrastructure of any kind, true?
Define developing.
Have you been involved in developing any infrastructure to be able to take gas in kind?
I have not been on the ground engineering something like that. I've helped with accounting.
Take a look at your first deposition, page 52, line 3 to 5. Question, have you been involved in developing any infrastructure to be able to take gas in kind? Answer, no.
Fair?
You're not offering any opinion about the actual build-out of the midstream infrastructure at issue in this case, like whether Hess should have built something, true?
True.
You're not offering any opinion that Hess overbuilt the midstream infrastructure in North Dakota, true?
True.
You're not offering any opinion about the materials or design of any of the midstream infrastructure at issue here, true?
True.
You're not offering any testimony that there was anything wrong about how the Red Sky gathering system or the Tioga gas plant was designed or run, true?
True.
You personally have never been employed by an oil and gas company, true?
Martindale Consultants owns interest in oil and gas wells, and I have too.
Listen to my question, please. You personally Todd Atala have never been employed by an oil and gas company. True?
Martindale Consultants has oil and gas interests. That would make us oil and gas company, I suppose.
First deposition, page 51, line 7 to line 9, question, but you personally, Todd Atala, have never been employed by an oil and gas company. True? Answer, true. You personally have never been employed by a company that gathers or processes hydrocarbons. True?
True.
You have never been directly involved in negotiating any midstream or marketing contracts. True?
We have reviewed them for people, but I haven't been sitting at the table negotiating, no.
Fair to say that you've never directly been involved in negotiating any midstream or marketing contract.
True.
You never personally have been involved in marketing oil or gas. True?
True.
You personally have never been involved in managing a midstream business. True?
True.
You personally have never been involved in setting budgets for a midstream business. True?
True.
You're an accountant, right?
Yes.
You are not an economist, right?
True.
You are not an expert in finance. True?
True.
You are not offering any opinions in this case about oil-related post-production costs. Is that true?
True.
You are not offering any opinion in this case about water-related post-production costs. Is that true?
True.
You are not offering any opinion in this case about whether various charges on the jibs sent to applicants for the subject wells of Hess personnel are actual and reasonable. True?
True. Well, producing overheads on the jibs. I just want to clarify.
Let me clarify the question.
Okay.
You are not offering any opinion in this case about whether the various charges on the jibs sent to applicants for the subject wells for the salaries and wages of Hess personnel are actual and reasonable. True?
True.
When I last took your depo about a month ago, at that point you'd served as an expert in about 19 cases. Does that sound about right?
Yes.
And you're getting paid $350 an hour here for your time, right?
Yes.
And your rate goes up and down depending on what you're working on, right?
It can, depending on each client.
That $350 is the highest rate you've charged to a client, right?
I think I'm higher on some things.
First deposition, page 18, lines 6 through 8. What's the highest rate you've ever charged a client to answer $350?
Okay, then I'll go with that. I may have been at 400 on one engagement.
Let's talk about producing overhead. In those 19 or so cases that we talked about, where you've testified, you have never testified about producing overhead rates. True?
I have not testified.
You've never issued an expert opinion about producing overhead rates. True?
True, because it's always escalated by COPUS. There hasn't been a need to.
First deposition, page 37, line 20 to 22. Have you ever issued an expert opinion about producing overhead rates? Answer, no.
Haven't needed to.
Let's go to your slides, please, that you looked at with Mr. Vivian. Look at slide 4, please. In slide 4, you asked the question, did Hess change methodology? Do you see that?
You getting there?
Take your time, just let me know when you're there.
Okay. All right. What was the question?
The question was, I'm just pointing you to the second last bullet on that page where it says, did Hess change methodology, right?
Oh, okay, yes.
And I think the answer was, you don't actually know much about Hess's pre-2017 methodology for setting the producing overhead rate in any given year. Is that right?
Well, we actually know they escalated according to COPUS.
You don't know how the base rate was set, do you?
No.
That's not something you studied.
Well, I didn't have anything, so no.
Is it fair to say that what you studied for purposes of your producing overhead rate was the 2017 recalculation and the escalation rates?
Well, that was the scope of the application. So yes, but I did see earlier rates where they escalated according to COPUS.
And sitting here today, do you know if before 2017, a calculation had been done to ensure that Hess was neither over-recovering nor under-recovering its actual expenses for producing overhead?
You're asking if I know, if Hess knows if they're over or under
No,
recovering?
I'm asking, do you know if a calculation was ever done before 2017?
No.
You're based in Oklahoma, right?
Yes.
You do audits all over the country, right?
Yes.
In most parts of the country, relationships between operating and non-operating working interests are governed by a joint operating agreement, right?
Yes. In Oklahoma, they also have non-JOA wells as well.
Okay.
So,
In most parts of the country, you typically see a JOA as part of the governing the relationship between operators and non-operators. Is that right?
typically, but we see them where there isn't also.
And when a relationship is governed by a JOA, JOAs usually attach what's called an accounting procedure, right?
Yes.
And typically, that accounting procedure is from COPUS, right?
Yes.
COPUS has model forms, right?
Yes.
And COPUS, I think you talked about this on direct, that's the Council of Petroleum Accountant Societies, right?
Yes.
You're a member of it?
Yes.
COPUS is an organization that issues accounting procedures and MFIs, right?
Yes, accounting procedure is an MFI, just usually modified to a particular, between two parties.
Okay.
Yeah.
COPUS provides guidelines on how to interpret those accounting procedures, right?
Yes, like guidelines, how to escalate overhead every year, like Hess did.
Now, when there's a JOA or an accounting procedure in place, COPUS says you can't change a negotiated overhead rate without the agreement of the parties, right?
That's a standard in the industry, yes.
COPUS doesn't say anything about needing to negotiate an overhead rate if there's no JOA or accounting procedure in place. Is that true?
If there's not a JOA, what was the question?
Sure. COPUS doesn't say anything about needing to negotiate an overhead rate if there's no JOA or accounting procedure in place. True?
But every company in North Dakota uses COPUS standards to charge and escalate overhead
If
rate,
you would,
every
please-
single one.
Please just listen to my question, okay? My question was different. My question is, COPUS doesn't say anything about needing to negotiate an overhead rate if there's no JOA or accounting procedure in place. Is that true?
COPUS doesn't specifically say that you shouldn't negotiate an overhead rate if there's no JOA.
COPUS itself does not impose a legal obligation, right?
Object to the extent it calls for a legal conclusion.
Could you restate your question, please?
Sure. You're offering an opinion in this case that Hess did not comply with COPUS, right?
I'm offering an opinion that it's not reasonable and actual because they didn't follow industry standards,
And you're using COPUS as the industry standard, right?
as everybody else does.
And can we agree that COPUS, in your view, it applies an industry standard, right?
Yes.
COPUS does not, in your view, impose a legal obligation, right?
Are you going to renew the objection?
Yes.
Sustained.
Okay? Now, there's no JOA or accounting procedure between applicants and Hess in this case. Is that true?
There are in some wells, but not on these applicant wells.
The subject wells have no JOA.
Correct.
There was never a contract or accounting procedure that, in your opinion, required Hess to negotiate a producing overhead rate with other working interest owners. True?
Will you repeat that?
Sure. Can you point me to a contract or accounting procedure that required Hess to negotiate a producing overhead rate with respect to the subject wells?
No, they can do whatever they want, I guess.
You discussed, actually, I don't think you did this, so let's skip that. You discussed with Mr. Vivian a number of comparisons of the Hess producing overhead rate for the subject wells as opposed to other producers producing overhead rates,
Yes.
right? The first time you actually did that comparison was in your second report, your first supplemental report, right?
Yes.
And if you would, you could look at your report, and I'll just orient you to it. It's in either the big binder or little binder. It's Exhibit A40. Look at page 23, please. And the top right there is the table that you put together, right?
Yes,
And at that time, you looked specifically at 4 other operators and compared them to Hess's rate for the subject wells, right?
yes,
You looked at Sinclair, you looked at EOG, you looked at Oasis, and you looked at Whiting, right?
yes,
And you selected those 4 because that's what Sinclair chose for you, right?
yes. I asked for jibs, and those are the jibs they gave me.
Now, you heard yesterday that Sinclair participates in hundreds of wells in North Dakota, right?
Yes.
And they gave you these 7, right?
They gave me more the second time around, but yes,
First time around, they gave you these 7.
yes,
Okay. And you heard yesterday that Missouri River participates in thousands of wells in North Dakota, right?
yes.
They didn't give you any producing overhead rates to consider at all.
I don't believe so.
Okay. Now, of the 7 that you looked at originally, 3 of them had JOAs and 4 of them, well, 3 of them did and 3 of them didn't, right?
Yes, it looks like 3 did and 3 didn't.
One of the ones, so for Sinclair, they included 1 with a JOA and 1 without a JOA, right?
Yes,
And you were here yesterday, right?
yes,
And you heard Mr. Macbeth testify, right?
yes.
And he told you that all Sinclair operated wells have JOAs, right?
Object, misstates his testimony.
Testimony speaks for itself.
I believe he said,
He's gonna rule.
sorry,
Could you repeat the question, please?
Did you hear Mr. Macbeth's testimony about the JOAs?
yes.
And he testified that they send out JOAs for every well that they operate, right?
Sent out JOAs, yes.
So, in your view, when you say Sinclair yes and Sinclair no, what's the distinction that you're drawing there?
I'm going to say that the one that yes has a JOA and the one that's no didn't have a JOA.
Did you actually study any of the JOAs?
Yeah, I looked at some of them.
First deposition, page 266, line 7 to 8. Question, did you study the actual underlying JOAs? Answer, no.
I didn't study. I looked at them and escalated the overhead rates. I mean,
Are you
study?
changing your testimony?
no, I'm clarifying study.
My question for you, I'll ask the same question again. Did you study any of the actual underlying JOAs for any of the wells included on page 23?
I did not study them.
Do you know when any of those JOAs were signed?
I have 2 of them, but I can't say for sure.
Do you know when any of those wells were drilled?
Oh, I should,
If
but I'm not
Go ahead.
positive.
If I went through all the wells here, would it be true that you would not know what year they were drilled in?
I can't positively say when they were drilled, no, I cannot.
Well, second deposition, page 183, 23, 184, 1. If I went through all the wells here, would it be true that you would not know what year they were drilled in? Answer, that would
Objection.
be true.
The impeachment is improper. The statement of the witness has to be inconsistent with his previous testimony, and it was completely consistent.
It was not. I'm happy to
think-
move on. I'm happy to
think you-
move on.
Go ahead.
I'm happy to move on.
Okay.
Page 23 of your report, at the time, you didn't include Continental as a point of comparison, true?
True,
At the time, Sinclair had never told you that it actually had interests in the Continental wells, true?
true,
But you knew that Continental was a big producer here in North Dakota, true?
true,
And you agreed with me at your first deposition that it would be reasonable to look at what some of the largest operators in North Dakota were charging in terms of their overhead rate, right?
true.
So after your first deposition, you provided us with a second supplemental report, and that included 8 Continental wells, right?
Yes,
And we could look at your second supplemental report, which is Exhibit A41. And take a look at page 19, please. And there you list 8 Continental wells, right?
yes,
And two of them had a rate of $2,114.97, right?
I'm sorry, I was looking, I didn't quite catch it.
Sure, I'll ask it again. Two of the 8 continental wells that you included had a producing overhead rate of $2,114.97, right?
Yes, in McKenzie County and in Dunn County, yes.
And that rate, I think we did the math last time, that rate is $17 less than what Hess is charging for the subject wells, right?
Yes,
And I think we also did the math last time, but that's about 99% the same as the producing overhead rate for the subject wells, right?
for those 2 wells,
Right.
outliers, if you will.
Well, you said that in your deposition too, but you also agreed with me that you didn't actually study the whole universe of continental wells, right?
I think I grabbed all the rates with, well, no, I did not study and put in this exhibit all the continental wells.
Well, do you have any understanding of what percentage of Continental's wells have a producing overhead rate of $2,114.97?
Well, based on Ms. Adair's table, I think 47 of them did out of 165, I think.
Okay, that's information you learned after your deposition, right?
Yes, and those are Hess wells.
Okay, and
That's
say
not
that
up
percentage
wells.
one more time. I wasn't quite sure I caught it.
Oh, was it 47 maybe out of 165, I think?
Okay, so your best estimate today is based on the information you've seen since your last report, is it about just under half of Continental's wells
I think
have a
that's more
producing
like
overhead?
25%. 40 divided by 160 is 25%.
You think it's 25%?
Well, 25,
Okay,
40 goes into 164 times.
so you, let me ask this one last question about Continental. I think you were asked this, but let me just make sure I have it right. You're not offering an opinion one way or another that Continental's $2,114 rate is unreasonable, right?
I haven't been asked to offer opinion on Continental's overhead rates.
You're not offering an opinion one way or another on that.
I'm not.
EOG is another one that you included in your table, right?
Yes.
And you included one well from EOG in your analysis, right?
Yes.
And if we look at that, it was actually, you included it both in your first supplemental report and your second supplemental report, right?
Yes, I just added. I don't believe I took any out.
Sure, fair enough. Now, the EOG one that you included was one that included a JOA, right?
Yes.
And that JOA rate was about $1,353, right?
Yes.
You did not include the EOG rate without a JOA, right?
Yes.
Why not?
I don't know. Early on, I just looked for representative samples and put them in here. I can't say for sure.
Do you have applicants' exhibits with you? Those are all the big black binders?
I have some.
Can you see if you can find A38?
Do I have it there? All right.
I'm glad to see that you have your reading glasses with you. I may ask to borrow them too.
All right. I got another pair.
Look, this is an exhibit that Sinclair introduced yesterday, right?
I believe so.
Had you ever seen this before?
No, I have not.
Okay. We just got it last week too. And I just want to ask you one question about it. If you look down at the bottom, there's a table of operators, right?
Yes.
And there's an EOG, there's two EOG ones, right?
Yes.
And there's one with, EOG one with a JOA and one without a JOA, right?
Yes.
And it looks like there's a table going left to right by year. And the EOG one with a JOA, depending on the year you look at, ranges from about $1,000 all the way from April 2011 to, if you carry it all the way through to the right, it ends up this year around $1,400 based on COPUS escalation, right?
Yes.
Okay. Now, the one below that, it says NA under JOA date, right?
Yes.
And did you hear Mr. Macbeth testify about what that means?
I'm assuming it means there's not a JOA.
That's what I heard too. And if you look, it looks like the first few columns are blank, and the first one that's populated is April 1, 2018, right?
Yes.
And it ranges from April 1, 2018, the rate there is, looks like $2,073.12, right?
Yes.
And then, based on escalation, it ends up at $2,300 and change, right?
In 2023, yes.
Yeah. And so, that's in the same ballpark as some of the Hess and Continental wells without a JOA, right?
Yeah, I didn't have that in 2017. I looked at 2017 JIBs, so that didn't exist. And they may have negotiated a rate, or they may have, that was their initial rate, but they didn't just go change everything and recalculate an overhead rate. That was already set.
Right, and I'm focused more, for the purpose of that question, on the substance than the process. And so the actual dollar amount, right? I understand.
The
you have-
process is that you escalate by COPUS, not recalculate.
I understand, but I'm asking about the outcome of the process, right? The outcome is that the wells from A38, on A38, the well from A38 from EOG, and several of the Continental ones that you included, and the subject wells for Hess, the producing overhead rate is in the same ballpark.
We don't have any idea how that was derived, but yes.
Okay.
Do you have any examples where it, oh, I can't ask questions, can I? No, sorry.
I've got what you've got on A38, so. Let's talk about Robinson Lake and Palermo. The commission's heard quite a bit about the Robinson Lake and Palermo plants in North Dakota. And there's been some terminology. Andover is sometimes, and I don't know if I'm pronouncing it rightly, the right way, but Andover, is that the same as Robinson Lake as far as you understand it?
It's Endeavor.
Endeavor?
Yes, I believe so,
Okay, and that was at one point run by Whiting? Is that your understanding too?
as my understanding.
And so Robinson Lake, Endeavor, and Whiting, when talking about that plant, it's all the same plant as far as you understand?
Endeavor and Lake Robinson,
Yes.
same? Okay,
Is that your understanding? That's my
Yeah.
understanding.
okay, yes.
Okay. Now, you would agree that you're not intimately familiar with all the processing plants in North Dakota, right?
Yes,
And in each of your reports, you compare the cost of gathering and processing at Tioga to those same costs at Palermo and Robinson Lake, right?
Yeah.
That was your intent?
the settlement statements that document the transaction between the producer and the midstream provider, yes.
And again, like the JOAs, you relied on Sinclair to give you points of comparison, right?
Yes,
And they pointed you to Palermo and Robinson Lake, right?
yes,
Nobody from Sinclair pointed you to One Oak, for example, right?
right.
And did you hear Mr. Copsing talk yesterday about some other plants like XTO, Nesson, and Liberty?
I did,
You didn't do any comparison against those plants either, right?
correct.
You didn't do any analysis comparing the amount of deductions that Hess incurs against the amount of deductions that other operators like Oasis incur on a per MCF or per MMBTU basis, true?
Yes, the midstream deductions?
Yes.
Okay, yes.
Okay. And
Other than these three.
other than these three. And I'm looking, these are the plants, I'm looking at from a check detail perspective. You didn't do the kind of analysis that Mr. Copsing described yesterday, right?
Correct.
Okay. And was yesterday the first time that you'd heard Mr. Copsing's description of his analysis?
First time I heard the, yes, the description, yes.
And you haven't done any sort of in-depth analysis of Mr. Copsing's analysis, true?
True,
And you haven't tried to replicate it, true?
true.
Let's look at, we could look at any of the reports. Why don't we just take which one do you have in front of you?
I have all of them. I mean,
Okay. Why don't we look at your final one?
3?
Sure.
Okay, yeah.
Yep.
Sorry.
And take a look at page 6 of your final report, which is Exhibit A41.
Okay. Page 6, yes.
Yes, sir. Page 6 is kind of the final of your versions comparing Tioga costs against the Robinson Lake and Palermo costs, right?
Yes,
And this was a calculation that you did with your team, right?
yes,
And these were folks that you rely upon, right?
yes,
You stand by the analysis here, right?
yes,
And this section is called Gathering and Processing Tariff Rate Comparison, right?
yes,
And so this includes both gathering and processing, right?
yes,
And that's the point you were making earlier about the settlement statements, right?
yes,
And so, based on your calculations, the average cost for gas that's gathered and then processed at Tioga from 2017 to summer of 2017 to summer of 2021 is about $5.33 per MMBTU, right?
yes,
Right at the end of your direct testimony, you were asked about ideas that the commission might consider in evaluating a reasonable rate. Do you remember that?
yes,
And I think what I heard you say is that one way to come up with a reasonable rate is by comparing essentially bringing the Tioga gathering and processing rate in line with what you see at Robinson Lake and Palermo, right?
I think Mr. Vivian asked if I thought averaging the rates would be something as thinking out loud to come up with a reasonable rate. I said yes.
Okay. You said it better than I did. That's what I was trying to get at. Now, you explained to me last month that you are not offering an opinion in this case that Robinson Lake and Palermo provide services that are comparable to the services provided at Tioga.
I have not, but again, from an upstream perspective, once you make that transaction, you don't know what happens after that. You get settled, and there might be T&F, there might be a lot of stuff that happens, but that doesn't affect your transaction.
And I'm not trying to be a bully on this, but my question is not calling for all that. And Mr. Vivian's going to have plenty of time for redirect if he wants to ask questions. My question was just, you are not offering an opinion in this case that Robinson Lake and Palermo provide services that are comparable to the services provided at Tioga. True?
I'm not offering that opinion.
Okay. You've never been to Tioga, right?
Correct.
You've never been to Robinson Lake or Palermo, right?
Correct.
You didn't do any sort of in-depth study of the processing services that Robinson Lake and Palermo provide. True?
No, I just looked at the transactions and the resultant effect of those.
You didn't study how dry the residue gas is after it's been processed at Robinson Lake and Palermo and compare that to Tioga. True?
Upstream provider, I don't care. I already got my transaction.
If you would please, it's going to go much faster if you just answer my question, okay? My question is, you didn't study how dry the residue gas is after it's been processed at Robinson Lake or Palermo. True?
I didn't study the tailgate gas on those wells, no.
You didn't study any of the NGL connections available at Robinson Lake or Palermo. True?
No,
I asked true. Was it true or not true?
I'm sorry. I did not, I'm sorry, restate the
I'll ask it
question,
again.
so
You didn't study any of the NGL connections available at Robinson Lake or Palermo, correct?
correct.
All right. You don't know what gathering systems Robinson Lake or Palermo are connected to, right?
Correct.
You didn't study curtailment or restriction rates at Tioga, Robinson Lake, or Palermo, correct?
Correct.
And you heard Mr. Macbeth's testimony yesterday that Robinson Lake has restrictions all the time, right?
I'm just thinking through restrictions and curtailment that Mr. Macbeth made the point of. I don't know all the time. I don't know. I think they have restrictions.
Not something that you studied, right?
Correct.
You would agree with me that to get gas out of the Bakken, you have to process it, right?
Yes.
It's too wet with too high of a BTU content to get it on an interstate pipeline, right?
Yes.
You talked with Mr. Vivian about it being a similar molecule of gas that goes into Tioga compared to Palermo and Robinson Lake.
I did compare the MMBTUs going inlet to the plant, and they were similar. They're, yeah.
And let's just talk about what happens to the molecule that comes out of those plants, okay?
Okay.
You would agree with me that Tioga extracts more liquids than Robinson Lake or Palermo does, right?
Which can be a good thing or a bad thing depending on the market. If residue prices are higher, you'd rather sell a residue molecule than an NGL, but yes.
Okay, and again, if you would just listen to my question, please, and answer my question. Tioga gets the gas drier, the residue gas, drier than Robinson Lake or Palermo does, right?
Yes.
The BTU.
I believe. I don't know categorically, but I've been
Generally
told by Ms. Adair and by you.
Okay. The BTU content of the gas, as you understand it, after it's been processed at Tioga, is low enough to meet interstate pipeline spec. Were you aware of that?
Yes.
You didn't study what happens to the gas after it's been processed at Robinson Lake or Palermo, right?
Right.
And for all you know, the gas needs to be processed a second time after being processed at Robinson Lake or Palermo to meet interstate pipeline spec, true?
Yes, but I don't care because I've already had my transaction. I don't have custody of that gas anymore.
That's something you don't care about, right?
As an upstream provider,
Would it be news to you if gas that's processed at Robinson Lake needs to be reprocessed
no.
at Tioga?
I'm sorry, I interrupted. No,
You know that?
I believe so.
And so based on your understanding, gas that gets processed at Robinson Lake needs to go through processing a second time at Tioga, right?
I don't categorically know that, but I've been told.
Okay. We talked about the services, and you're not offering an opinion on the services being comparable. Let me ask you about the contracts. You are not offering an opinion in this case that the contracts for the services being provided at Tioga, Robinson Lake, and Palermo are comparable. Is that true?
I'm definitely not offering that opinion.
Okay. In fact, you didn't review any of the contracts for processing gas at Robinson Lake or Palermo, true?
I believe I had a whiting contract that you may have pointed out. But I did not study them.
Okay, fair enough. You don't know when they were entered into, right?
We may have talked about that yesterday. I think one was in 2008 and then renegotiated at a later time, but I can't specifically say.
Do you know what they say about capacity restrictions?
Whether it's firm or interruptible?
What happens if there's a capacity restriction? Did you study that? At Robinson Lake or Palermo?
Well, I believe it could be flared within the statutory limits and still produce the oil.
That's something that the contract says?
Well, no, I wouldn't say the contract would govern what the upstream Bakken or Sinclair, whoever, it would just restrict some of the gas from going into the pipeline. Is that what you're after?
Well, I'm just asking, did you study what the contracts say about capacity restrictions?
I can't speak specifically on that, so I guess not.
Do you know what the contracts say about NGL recovery?
No.
Do you know what the contracts say about the pricing terms for residue gas?
No, we have not challenged any of the pricing, but no, I do not.
Do you know, well, you do know that the Robinson Lake and Palermo contracts are for interruptible service, right?
Yes,
And you know that the Tioga contracts are for firm service, right?
yes,
You also know that both the Robinson Lake and Palermo contracts are POP contracts, right?
I don't believe they all are. I think there might be some mixed in there, but I don't think they're all pop.
And I'll just point you to your first deposition.
Well, yeah, I noted that they were, but I didn't say they all were. I said if that was the case, that's how that was handled. It was saying that if it was a POP contract, that POP percentage was treated as a deduction.
And I'm not trying to argue with you. You would agree with me that at least some of the contracts for services at Robinson Lake and Palomar are POP contracts, right?
Yes.
Okay.
I stated that in my report.
Now, you saw Mr. Copsing's analysis yesterday, which I think you described as comparing the deductions from Hess against other operators by looking at the check detail, right?
I'm sorry. I missed part of the question.
Yeah, I'll say it again. You heard Mr. Copsing's testimony yesterday,
Okay.
right?
Yes.
And you heard him describe the analysis that he did last week, right?
Yes.
Okay. And there, as I understood it, it was comparing deductions from Hess against other operators based on check detail. Did you hear
Yes.
that too?
Yes, I heard
Okay.
that.
Now, if fees at Robinson Lake are performed pursuant to a POP contract, the midstream costs would not show up as fees on the check detail. True?
It depends. I mean, you could have a gathering fee and then a POP processing. If that was the case, it might show up on the checks.
Whatever.
If it's all
Go ahead.
POP, depending on how taxes work, some operators will report only the net POP proceeds in the checks. Sometimes, where if you get a deduction from those in some way, shape, or form, whether you unbundle and things like that, they might gross it up to be a gross 8/8, but then show the POP as a deduction, but I did not see that in this situation.
Okay. And I don't think we're in disagreement on this. The aspect that is done pursuant to a POP typically would not show up as a fee on a check detail.
Typically, but not categorically. But we accounted for that in our analysis. I just want to be clear.
I have one page of questioning, then I'm changing topics. Would that be a good time for a break?
How long do you think the questioning might last?
Less than 5 minutes. And then I switch topics. to
Famous
something.
last words.
Yeah.
It's one
Well,
page.
I'm gonna hold you to
Yeah.
that.
This one should be pretty quick. It's my last questions about Palomar and Robinson Lake, and then we'll switch topics. You've never studied the rates for firm service versus interruptible service in North Dakota, true?
I have not studied those.
You would agree with me that firm transportation agreements are generally mutually beneficial to both the producer and the shipper/processor because the producer secures capacity on the shipper system and the shipper or processor is guaranteed a certain fixed amount for the use of its system.
Yes, usually by the reservation fees that they might pay even if they don't travel through.
Okay. And in your view, the rate for firm services is not based on vastly different rates than the rates for interruptible service contracts, right?
Can you repeat that question?
In your view, the rate for firm services is not based on vastly different rates than the rates for interruptible contracts, right?
It can be.
You haven't done any analysis of the difference of firm service contracts versus interruptible service contracts in North Dakota, right?
Not in this specific case, no.
You've also never studied gas to oil ratios in North Dakota, right?
Correct.
And were you aware before yesterday that the field here is getting gassier every year?
I'm sorry, that the what?
That the basin is getting gassier, that the gas to oil ratios are increasing?
I was not aware of that.
Okay. You haven't analyzed whether the existing gas infrastructure in the Bakken is able to handle anticipated gas production in North Dakota, true?
True.
And if the gas infrastructure is unable to gather and process all the gas that's being produced, there's going to be a capacity issue unless wells are shut in or flaring goes up, right?
You just said a little cause and effect there. If capacity, or if production increases, capacity, wells will be shut in or flared?
Yeah, let me ask you this
I
way.
would agree.
Yeah, if all the plants are full, then you either got to shut in or flare, right?
Yes.
And just as a matter of Econ 101, laws of supply and demand, if the demand for gas infrastructure goes up, right, but the supply of that gas infrastructure, those processing services, stays the same, then the value or the price of that firm service is going to go up, right?
Hold on. I think you said if the supply stays the same and the demand goes up?
If the demand for gas infrastructure goes up, more
Okay.
people need more processing
Okay,
plants.
the demand for, sorry, it's a lot of words, so I almost want to write it down, but try one more time. So I want to make sure I answer correctly.
The demand for gas infrastructure goes up.
Okay,
The supply of that gas infrastructure stays the same. No more plants, right?
but the demand for, you mean, you're saying demand goes up, but supply stays the same. I think you're using the words incorrectly. I don't know, but supply would have to increase for the demand to go up for capacity. So I'm not sure, I'm not reconciling your words.
Sure, maybe ask it a different way. No more plants get built in North Dakota.
Okay,
The basin gets gassier and gassier.
okay,
More and more gas being produced every year.
okay,
But all the plants are full.
okay.
The value of firm service goes up, right?
Well, if it costs more than the actual gas gets, you might want to flare if you can.
Yeah, so the answer is either flare, shut in, or pay more, right?
Or maybe re-inject to keep the pressure up, but I'm not an engineer.
Any other things you can think of?
No.
Okay, that's my last one on this page.
We kept it under 5.
All right, let's go off the record and we'll try to be back probably around 1:15. 1:15. All right, we'll go back on the record. It's 1:15. Council, are you ready to continue?
Yes, thank
And I'll
you.
just remind you that you continue to be under oath.
Yes, sir.
Thank you.
Mr. Atala, I'd like to turn to the post-production side of your opinions. And let me start with this. You offered some testimony on direct that Hess's midstream costs are unreasonable, right?
Yes.
This is the first time that you've offered expert testimony or opinion about the reasonableness of processing costs, right?
First time I've offered testimony, yes.
Or expert opinion.
Yes.
I wanted to ask you about the point that you made with Mr. Vivian. You identified two areas where you thought that actuals aren't being used in the tariff model. One was on maintenance and CapEx, maintenance, capital, and OpEx, and the other was on volumes. Do you remember that?
Yes.
So let me ask about the first one first, and then I'll ask about the second one. I think you testified that maintenance, capital, and OpEx are not actual and potentially results in an over-recovery because they rely on estimates or projections, right?
OpEx, 100% sure. I believe maintenance capital was in there also. Do you mind if I look to see?
I don't mind at all.
Okay. It's just operating expenses.
Operating
Sorry
expenses.
about that.
Okay. Now, are you looking at your second report?
Well, I looked at my first report and I looked at the contract quote that talked about operating expenses.
Okay, and you introduced your council introduced your report as evidence, and there's some tables in there that show what impact that could have on a potential over-recovery in your view, right?
Is that in the first report or the supplemental
The
report?
second report. It's
Okay,
the-
sorry, yes. Second report.
And my question is just, and I don't think you talked about this on direct, so I just want to make sure everybody understands. The illustrations that you give in your report, and in particular on page 10 of your first supplemental report, are based on the statement that most budgeting techniques have a 10% factor built in, right?
I'm not sure if I used the word most,
Well,
but I said if these budgeted numbers were within a reasonable 10% threshold.
Look on page 10, first paragraph.
Okay.
It's in the middle of it, there's a parentheses. It says most budgeting techniques.
Got
are
it,
10%.
yes.
Okay. And so for purposes of your report, what you're doing is you're illustrating what an over-recovery might look like if there's a 10% difference between an estimate and an actual, right?
Yes.
Okay. Now, you don't have any basis to believe that Hess's budgeted numbers were in fact 10% above actual expenditures, true?
I don't know what the actual expenditures are.
Right. And nobody from Hess has testified that it used a 10% budgeting factor, true?
True.
And you didn't do any sort of analysis to evaluate how such a hypothetical 10% factor would have impacted the tariffs charged to Sinclair or Missouri River, true?
Can you repeat that?
Sure. You say in your report, you talk about if you assume a 10% overage, it would result in a possible $62.8 million recovery in excess of actual expenses, right?
Okay, yeah, 628 million, yes.
And that's not talking about the subject wells or applicants or anything like that.
No, that would be the gross costs.
Right? And you haven't
That's
tried,
the HESM as a whole.
and you haven't tried to tie that to applicants of the subject wells, true?
No, I did not run models of changing all those, no.
Okay, and then the other one that you talked about with Mr. Vivian was volumes over dedicated production.
Yes.
And you also, on the very next page of that same report, you have a couple of tables in which you show that in I think you said on direct, in about a quarter of the years is where you spotted that issue, right?
Actually, more. It's 3 out of 1, 2, 3, 4, 5, 6. 3 out of 8 for gathering and 2 out of 8 for Tioga.
Right. And then you have some numbers represented there on page 11.
Yes.
And just so that we're all clear, those in your view would calculate a system-wide,
Yes, Hess would get that much more
right? And so
from
again,
everybody.
and just to make sure that we're all on the same page, that's not representing anything tied to the subject wells or to applicant's interests.
No, it's just showing that Hess would be over recouping more than actual expenses.
Okay. Let's talk about the tariff model. And you mentioned earlier that when the Hess tariff model was first provided to you, you realized you need to consult with an outside expert, right?
Maybe not immediately, but after some time we did.
And that's because you realized your shop didn't have the expertise to fully understand and analyze the tariff model, right?
Fair?
So after your first supplemental report, you or your colleague did some research to find somebody schooled in economics and finance, right?
Yes.
And one of the people you came across was Dr. Mark Cronshaw in
Yes.
Colorado. How did you come across Dr. Cronshaw?
Cody reached out to people that might have that expertise, and we called them and talked to them on the phone and asked what their expertise was. And he also had energy expertise as well, so he was a good fit.
Did he was not somebody that you had been familiar with previously, true?
True.
Was he a referral?
No. As in, did somebody refer him to us?
Yes.
No.
Okay. Internet search?
I would have to ask Cody. He did the initial search.
You'd never spoken with Dr. Cronshaw before this case, right?
Correct.
And he'd never worked in Martindale, right?
Correct.
Do you know what the name of his consulting shop is?
I think he has a organization, I don't know if it's him or if it's more, called Resource Economics, maybe?
Okay. Not positive on that.
No, I know he still teaches at the University of Tulsa because I get emails of continuing education for classes that he puts on in University of Tulsa.
And those teaching opportunities that he does, you don't know if he's an adjunct or teaching like 1 week seminar courses or something like
I
that,
think
right?
it's like, now I think it's like the 1 week seminar courses, I believe, something like that.
Yeah, it's not like a tenured professor of economics or anything like
I
that.
think he was at some point, but he is not now.
Okay. You don't know if he's ever served as a testifying expert in a case, is that right?
I do know he has.
Okay, and how much testifying experience does he have?
I can't say, but I know he has.
Has he ever been excluded or limited in his testimony?
Not that I'm aware of.
Has he testified in any cases here in North Dakota?
Not that I'm aware of.
What's his hourly rate?
I don't know.
Do you know if he's getting paid?
Yes, I'm sure he is.
It's not a pro bono project for him?
I doubt it very seriously.
Fair to say that you needed Dr. Cronshaw to be able to offer the opinions you're giving about Hess's tariff model?
I think that's fair.
Fair to say that you wouldn't be able to give the opinions in your second supplemental report without him?
Yes, he definitely helped us in understanding the tariff model.
And I think we talked about this in your depot. If you look at your third report, which you talked about with Mr. Vivian, and I think the first substantive page is on page 6, and this is Exhibit A41. Pages 6 and 7, that was, your team did that in-house, right?
Yes.
Okay. And then pages 8, 9, 10, 11, 12, 13, 14, 15, 16, and 17, those were all put together based on the work that Dr. Cronshaw did?
Mostly, I don't know if categorically all of that was based on the work that Dr. Cronshaw did, but he's definitely an integral part of that, yes.
He did all the calculations that are based on those pages that we just discussed?
I'm trying to recall, because we did we both were doing some work. He definitely developed the model to do it.
he supported you with the tariff calculations and you put the table together, right?
That's fair.
And then if you look at the end, the final pages, so 18, 19, and 20, that's your work, right?
Yeah, yeah.
Okay, and then you had a number of exhibits to your second supplemental, which I believe are in the big binder that your council provided. And I'll ask it to you just generally, and if you need to consult the exhibits, that's fine too. But there are a number of Excels, and for the record, it was exhibits 3, 4, 5, 6, 7, 8, 9, 10, and 11 attached to your second supplemental report. Those were all put together by Dr. Cronshaw. Those are the spreadsheets, right?
Just give me 1 second. I want to make sure I answer correctly.
I'm happy to repeat the numbers again too, if you'd like.
Okay, you said numbers what through what?
Exhibits 3, 4, 5, 6, 7, 8, 9, 10, and 11 were all Dr. Cronshaw's, right?
I have exhibits 3 like as it has different reports, so hold on. Aren't those like exhibits in the 40s?
Yeah, it's a little confusing the way it's.
No, hold on, that's annual reports. Hold on. That's Corp. I
Take
mean,
a
I
look
think
at-
you're talking about the tariff models, but I'm trying to put my eyes on those tariff models.
Yeah, not quite. Look at your black binder. Do you have the black binders with applicants' exhibits?
Oh. Okay, can we try again? Sorry.
Sure, and flip to exhibit 41-1, A41-1.
Yes, that's the 41's my second supplemental.
Right,
Okay.
and if you look at 41, A41-3, A41-4, A41-5,
Well, I did A41-3 is me. Hold on. Yeah, A41-3 is me adding the vapor recovery unit in additional months in the deductions. Just want to make sure we're clear.
sure, okay.
And then,
Oh, go ahead.
maybe I can help. Let's see here. Are you talking
Maybe
about,
ask another question. I sort of feel like you're just saying stuff.
Yeah,
in
let me,
response to anything.
that's fair enough.
I'm sorry.
A41-4, A and B is Dr. Cronshaw, right?
Yes.
A41-5, A and B is Dr. Cronshaw.
Yes.
A41-6, A and B is Dr. Cronshaw.
Yes.
Same for A41-7, A and B.
Yes.
Same for 41-8, A and B.
Yes.
Same for A41-9, A and B.
Yes.
Same for A41-10, A and B.
Yes.
Same for A41-11, A and B.
Yes.
Same for A41-12, A and B.
Yes.
Okay. I asked you if, so Dr. Cronshaw's getting paid. Do you know who's paying him?
I would assume the applicants.
He has not submitted an expert report in this case, true? As far as you know.
True.
And as far as you know, he hasn't testified either, right?
True.
And I think I asked you at your depot why we were talking to you about the tariff model instead of him, and you said you don't know, right?
Fair.
The tariff rate that Hess calculates is based on a cost of service model, right?
Yes.
And I know it's one that you said that you're not familiar with and haven't seen before, but the general concept of it is cost of service, and that's something.
It's calculating a rate per M, yes,
And you've seen cost of service models used in other situations, right?
yes,
Happens all the time, right?
yes,
And there's nothing inherently wrong with using a cost of service model, right?
right.
And cost of service models often have a return of capital built in, right? Or rate of return.
Well, return of capital is not a rate of return. Return of capital is the actual capital expense rate on, return on.
You're right.
Return on,
I typo in my outline.
sorry,
You've seen that cost of service models often have a return on capital built in, right?
yes,
The whole point of a cost of service model is to recover your costs and make some money out of it, right?
reasonable profit,
And there really needs to be some sort of return on the investment in order to attract that investment, right?
if you're attracting investment, yes, if you're if you have the money, you wouldn't need a return on investment, I suppose, but,
Well, anybody with money, whether it's a person or a company, can choose whether or not to make an investment of that money and take it out of their hands and put it into something else, right?
yes,
And the reason you invest in something, whether it's stocks, bonds, infrastructure, is to make money out of it, right?
fair.
Now, I think you testified earlier that, well, did you testify earlier that Hess earns a rate of return on its operating expenses?
Yes,
Okay. Now, let's just kind of get some concepts straight. In your mind, is a capital investment different than an operating expense?
yes,
Okay. And is that because, in your mind, a capital investment is something related to a use of money put into an asset that that yields returns over time, like longer than a year? Is that a fair way to say
I
it?
mean, they kind of classify capital as cost spent to install or expand a fixed asset,
Okay.
if you will.
Would you agree with this definition? As it relates to gathering and processing assets, a capital investment is associated with volumes that occur over time, like longer than a year. Is that a fair way of putting it?
I don't even know what that means.
Well, let's do it the other way. Would you agree that operating expenses in a given year, operating expenses in your mind are more like day-to-day expenses, right?
Yeah, their expenses incurred as we're, real time as we're going.
So kind of like,
Capital's up front, operating is through time.
well, capital is upfront, but there's also investments you make in capital, like actual infrastructure over time, right? You keep investing
Yes,
more capital,
yes.
right?
You don't lose your opportunity to build something once you didn't do it the first time.
Right.
So you could expand, I said installation and expand capital or fixed assets. So, yes, you can incur capital costs other than the first initial spending of building the plant or building the system.
And kind of in a caveman way of thinking about it, is it fair to think of capital as something that is long-term and operating expenses is something that's short-term?
Well, I mean, capital, you spent the money right then. So, I mean, the expense is spent when it's spent. So, because you're going to incur operating expenses over that whole time period.
Okay. Well, let me ask it this way. So the way that the tariff works is that tariff revenues go toward paying down input costs, right?
And capital.
Right. Capital is an input.
Yes, I'm sorry, yes.
And the tariff revenues go towards paying down all input costs, right?
Yes, in the model, capital and operating are added into one dollar amount. Then the net present value is calculated over all that. And then the 12% internal rate of return is part of that net present value. So it's calculating a net present value with a 12% discounted rate for both capital, operating. Every expense is in there except the pass-through costs. Then it has the net present value of the volumes, and then that's divided in that net present value of the cost, both capital and operating, to come up with the rate.
Right.
So it's
And
achieving a rate of return on both the capital and the operating. It does.
I think we're on the same page, but essentially the idea of the tariff revenues is to paying down all the input costs, both capital input costs and operating input costs, right?
Yes. I mean, compared to an annual cost of service where capital is there, like in the FERC example, it assigns that interest rate, that return on investment, keeps it separate, then it comes up with the operating expenses, it adds those together. So in that situation, there's a return on investment of the capital expenses, but not in the operating expenses.
So revenues typically exceed the operating cost in every year, right?
Hope so.
Right? And if the revenues are exceeding the operating costs would be paid off each year in the year incurred. True?
In a true cost of service annual model, but not in the Hess model because it's all the cost over all the time. And it assigns the net present value for all of those costs. The formula doesn't know any different of whatever that cost is, even though there's capital and operating in there. It assigns a return on that whole investment, not just operating or not just capital, the whole investment over the whole period of time.
Can you identify a year in which the operating costs were not paid off in the year incurred in the tariff model?
Maybe. I mean, do you already know, or you want to direct me to
Well,
it?
I think the answer is no.
Oh, okay.
Yeah,
Well,
and so,
then
I mean, I think you
okay.
told me earlier that the revenues exceed operating costs every year, right?
You hope so.
Right. And
I mean,
if
I'm not looking at that and categorically saying that, but that's what you're hoping for.
That's the idea. And if the revenues exceed the operating costs, then the operating costs would be paid off in the year incurred, right?
But if it doesn't, it's going to recalculate every year. And when it recalculates, it uses the whole time period. You can't pin it to 1 year. The formula is taking all 10 years. And it's assigning a net present value for all 10 years. That is both capital and operating. I don't know what other way you can say it.
Well, let me ask you this way. Is that an analysis that you've done to assess whether or not the operating costs were paid off in the year incurred?
I mean, it's a fact. It's just a fact that interest, the rate of return is computed on capital and operating expenses. It just is.
Okay. Okay, we'll come back to that. Now, so let me ask you this then. You offered some testimony about Hess's corporate structure and how much control one Hess entity has over another, right?
Yes.
And would you agree with me that you don't have much educational background on corporate structure?
That's okay. Fair.
Now, you've never offered expert opinion or testimony about the control that one company has over another, is that true?
No, but I've just justifiably relied on Hess, what they said in their filings and their websites.
Right.
And
If
their
you would-
investor relations.
If you would please, just listen to my question. It really will go much faster if you listen to my question. My question was, you've never offered testimony or expert opinion about the control that one company has over another, is that true?
That is true.
And you're familiar with the concept in the oil and gas industry where two or more companies make a joint investment in an asset, like a well or in a midstream infrastructure or anything like that, right?
Yes.
And in those instances where there's a joint investment in an asset, one party is designated as the operator, right?
Yes.
True of a well, true of a midstream processing plant also, right?
Yes. Excuse me.
Some entity needs to have operational control, right?
Yes.
That is not something that you're taking issue with, right? As a general matter,
Of who has operational control?
of somebody having to have operational control.
No. Somebody has to operate the property.
And in the midstream context, there's nothing unique about an upstream company using an affiliated entity to provide midstream or marketing services. Is that true?
I'm sorry. I lost focus there.
Yeah, I'll ask it again. There's nothing unique about an upstream company using an affiliated entity to provide midstream or marketing services. Is that true?
No, that's not unique.
Yeah, it's true.
Yes, I'm sorry. Yes, that's true.
It happens all the time. Right?
Yes.
Okay. In fact, happens all the time in North Dakota, to the best of your knowledge, right?
I'm not going to categorically say that it happens all the time in North Dakota.
Not something.
But I
you-
mean,
I'm sorry, go ahead.
I don't know if it happens all the time in North Dakota. I know in this situation it does, and I also know that I have seen it quite often.
You're not offering an opinion in this case, kind of as a blanket matter, that there's something inherently wrong about using an affiliate to provide midstream or marketing services?
No, the very reason that it is an affiliate isn't a problem. It's the additional data that the rates that aren't reasonable and actual and the resultant of that relationship.
Well, yeah, and the fact that a company is using a midstream affiliate doesn't automatically result in an unreasonable contract, true?
True,
The use of an affiliate can still result in a reasonable agreement, true?
true.
Now, you testified that the contracts at issue here were not competitively negotiated, right?
True.
In offering that opinion, you didn't actually study the negotiation process between Hess Trading Corporation or Hess Trading Company and the various Hess midstream entities. Is that true?
Correct. I was not there during negotiations.
And you didn't go back and try to find all those negotiations and understand the back and forth, right?
True.
The nitty-gritty of the negotiations between HTC and Hess Midstream is not something that you studied.
Would
right?
that have been provided if we asked?
It's one of those ones where I got to ask the questions, right? So my question is, the nitty-gritty of the negotiations between HTC and Hess Midstream is not something that you studied, true?
I am not aware of the nitty-gritty negotiations between the two wholly owned subsidiaries. Correct.
You talked a little bit in your direct about a company called GIP.
Gas Infrastructure Partners, yes.
I believe it's Global
I'm
Infrastructure
sorry.
Partners,
Yes.
right? And you would agree with me that you haven't done any kind of in-depth study of the relationship between Hess and Global Infrastructure Partners, right?
Other than what I read in the Hess filings.
Right. You read the Hess filings, which referenced GIP, but beyond that, you haven't studied what GIP does or how it structures its transactions or anything like that. Is that
I
fair?
have not studied GIP transactions.
You testified on direct that you believe that Hess can terminate the processing and gathering agreements in this case. Is that right?
I do believe they can.
Okay. You have not studied one way or another how much control GIP has over Hess Midstream. Is that true?
I think I've provided some examples that Hess states on what they have control of. So I've relied on Hess.
But you haven't looked to see what GIP has control over, right?
Isn't GIP Hess? Hold on. No. Hess Infrastructure Partners. I'm sorry. I was confused in HIP and GIP. Hess Infrastructure Partners is not Global Infrastructure Partners. Okay. I do believe I put something in there that shows that they don't have operational control of the assets, though.
I think we're on the same page on that. My question is, other than operational control, that operational control isn't the only kind of control, right?
I suppose.
And you remember in your deposition, I showed you some examples, like an S1. Do you remember looking at an S1 in your deposition?
Maybe vaguely.
And if it helps to refresh your recollection of this, I'm happy to point you to it, and you can read it for yourself, and I can ask you the question. But my question was, didn't you learn for the first time during your deposition that there are certain actions that Hess cannot take without the approval of GIP?
I do recall reading something, but it seemed like there was more board members from HESM or Hess Infrastructure Partners than there was GIP. And why would GIP not let Hess something do that's going to help them?
Were you aware in offering your opinions in this case that materially amending or modifying or terminating commercial agreements between Hess Midstream and the other Hess entities required the approval of GIP? Is that news to you?
Can you define approval of GIP?
A approval by a vote of one or more GIP board members.
I think that may have been in the S1 that you showed me.
You don't dispute that Hess requires GIP's approval to materially amend, modify, or terminate commercial agreements between Hess Midstream and the other Hess entities. Is that right?
But I think GIP would be on board if Hess had a better deal that they wanted to do. But repeat the question. Sorry.
My question is, you do not dispute that Hess cannot materially amend or modify or terminate the gathering agreements and processing agreements in this case without the approval of GIP?
I haven't studied enough to say yes or no.
Okay. You pointed earlier to a HESM 10K. in which, and I think what you read from that was that Hess dedicated all of its existing and future owned or controlled production in the Bakken to Hess Midstream. Do you remember that?
Possibly, is it in one of my reports, or?
I believe it is. It's in your first supplemental report. Well, let me ask it this way, because it'll probably actually just be faster. You're familiar with the concept of dedicating production to a single purchaser or gatherer, right?
Yes.
Happens all the time in the industry.
Yes,
Happens both in the affiliated and the unaffiliated contexts, right?
yes,
And again, I think we talked about the idea of minimum volume commitments earlier. These are good because it's good for producers because they know where to put their production, and good for the midstream companies because they know they have guaranteed
it
volume.
can be mutually beneficial, yes.
In offering your opinions in this case, one thing that you've not done is a general analysis of the gas gathering and processing infrastructure in North Dakota, true?
True,
And you also have not analyzed Hess's build-out of the gas gathering and processing infrastructure in North Dakota, true?
true.
And I think I covered this right at the very beginning, but you're not offering any opinions about the appropriateness of Hess's build-out of any given gas gathering system, compression facility, or processing plant in North Dakota, true?
True,
Hess's initial capital investment is one of the inputs that goes into the tariff model, right?
yes,
And we looked at some of the tariff models. I talked earlier about the 18,000 line spreadsheet that I couldn't print out. I did print out a copy of one of the tariff models. Can I show it to you?
I have tariff models,
You have incomplete ones, so let me give you a complete one
Oh.
from the binder.
okay.
And I'm happy to give one to the commission too, if it's helpful, since I think all the other ones are fixed up. May I distribute a copy? And just take a moment to orient yourself to that, Mr. Atala, and let me know when you're ready. And just for the record, this is a hard copy printout of HX 18.
Yes, so this looks to be oil and gas for Goliath, Hawkeye, Red Sky, Toyota, well, everything, right? That's what it looks like.
Yeah, and I'll represent to you, it's a, just a printout of the entirety of HX 18. We tried to make it fit on a piece of paper, so we put it on big paper. Some of the tables carry over. You can see there's some numbers on the very bottom. See those? I'm gonna point you to a couple of the numbers.
Okay,
And if you look, page 1 of this tariff rate summary, that's a summary of the tariffs across the systems, right?
looks to be, hold on one second. It only seems to start in 2018, though. I'm not sure why, because there's tariffs prior to that.
Well, this is the 2021 tariff model, and, well, this is just a printout.
It just looks incomplete, because they
Okay.
usually have all of them.
Well, we can look at the native later if we want, but I'm not gonna focus so much on this. I'm trying to get oriented on what this is. If you look at pages 2, 3, 4, and 5, does that look like a discussion of minimum volume commitments and volumes more generally?
Let's see. 2 is labeled minimum volume commitments and nominations. And 3 nominated throughputs. It looks to be a discussion on minimum volume commitments. Sure.
Okay, and then if you get to page 7, well, page 6 is something called input terms table And then page 7 is something called input actual, right?
Okay,
And there's a set of rows at the very top, and then there's a gray bar called consolidated midstream, right?
escalation index on top.
See the big gray bar with the blue text saying consolidated midstream?
Yes,
And then for each one of them, then there's a number of entries under that. And the first one is something called consolidated midstream initial capital, right?
yes, well, it might be in zeros, I'm not sure. But it reads as 1,838,564.
Yeah, and you see to the left of that, it says that it's in.
Oh, there you go, yes, sorry, I interrupted, my bad.
So this, at least according to this document, it reflects that in 2013, the consolidated midstream initial capital invested was $1.8 billion, right?
Yes, that's what this looks to represent.
And that's not a number that you're taking any issue with one way or another, true?
No, I don't believe so.
And I asked true and you said no, but so let me just ask it again. You are not taking an issue one way or another with that $1.8 billion initial capital number, is that right?
I haven't audited it, but, yeah, we've accepted the $1.8 billion.
And then if you look down below that, there's a series of entries for consolidated midstream. And then there's another gray bar where it says TGP LLC, right?
Yes,
And that also has a line for initial capital, right?
yes,
And do you understand TGP to be referring to Tioga Gas Plant?
yes,
And so this is essentially a subset of the consolidated midstream series of columns, right?
yeah, I believe so.
And so the initial capital line there indicates the initial capital into the Tioga Gas Plant, right?
Yes,
And so as of 2013, this reflects an investment of $992 million into the Tioga Gas Plant as of 2013, right?
yes,
And that's also not a number that you're taking an issue with one way or another, you just haven't examined it, right?
yes, I'm not taking issue, but I haven't examined it, yes.
That's all I have for now on this one.
A lot of trees died for that.
Oh, we'll come back to it. Don't worry,
Okay.
don't worry. It's not all for naught. You talked a little bit with Mr. Vivian about the rate that third parties pay on the Hess midstream systems, right?
Yes,
And I think you talked about the difference between a $2.87 charge versus a 62-cent charge, right?
yes,
And you would agree with me that you don't know any of the details of what services are actually being provided pursuant to that rate?
all I know is Hess represented as third-party costs to go through the system.
For gathering, for example, you don't know whether that's gathering from wellhead to plant or for a shorter distance, right?
Well, I don't know.
For processing, you don't know if the service third parties are receiving is the same as the services that Hess Bakken, the upstream company, is receiving,
I
right?
know they're processing through the Tioga plant so I'm not sure what you're asking. Is it not going through the Tioga plant?
Well, let me ask it this way. For all you know, that third-party cost is not the cost of processing from rich gas to residue gas, but rather is the cost of reprocessing gas that's already been processed elsewhere, like at Robinson Lake, right?
I don't know that.
Yeah, could be, right?
It could be.
You don't know if the rates, the difference in the rates has anything to do with whether or not the services are firm or interruptible, true?
I do not know.
Let's talk a little bit about the rate of return calculation in the tariff model. And I think we have some agreement on this already. Building any midstream infrastructure requires an investment of capital, right?
Yes,
To attract such investment, one needs to have a rate of return, right?
again, we kind of have semantics on the attracting an investment. If you already had the money, you would need to attract other people to invest, but if you're looking for investors, you would need to have a return on investment.
And the way investments work, and this isn't unique to the midstream infrastructure business, is that the riskier the proposition, the greater the rate of return, right?
Fair?
If something is really safe, like a bond, you might be willing to live with a pretty low interest rate. If something is really, really risky, like something in the pink slips, you might want a higher rate of return, right?
But yes.
Okay. You've offered the opinion that Hess's residual value calculation results in rates of return in excess of the 12 and 14% rates in the gathering and processing contracts, right?
Yes, the way that number is used in the tariff model.
You, Todd Atala, have never offered an expert opinion about the proper way to calculate a residual value.
No, I just did the math.
You've never offered an opinion saying this is the right way to do it and this is the wrong way to do it, right?
Not offered an expert opinion. I have calculated cost of service models though.
You've never done a net present value calculation in any case in which you've been retained, right?
I have not in a case that I've been retained.
I asked you at your deposition if you could think of a time that you'd done a net present value calculation in any of your audits and you couldn't remember anything. Do you
Yeah,
remember?
net present value is usually used to evaluate an asset if you plan on purchasing it. I haven't seen it used in cost of service.
Okay.
So, yes.
Have you ever done a net present value calculation in your professional work?
I have seen them, but I have not done one.
Part of the reason why you had to bring in Dr. Cronshaw, true?
Yes.
You don't know why Hess set up the residual value calculation the way it did, right?
Well, I wasn't there, but it's a plug number to get the 12% rate of return.
Let me just ask it again. What is your understanding of why Hess set up the residual value calculation the way it did?
So with that number representing the second time period, it makes the 12% rate of return happen.
Do you know what the party's intent was?
I wasn't there.
Is that a no?
Well, they intended on making money.
Do you know what the party's intent was?
I know they intended on making money.
Beyond that, you
You
don't know
told
why.
me that that's why they do this, to make money.
And I'm not trying to argue with you. I'm just trying to ask you, would you agree with me that you do not know the party's intent? Because
Well,
you
I
were
know the
there.
intent of the parties was to make money.
All right, the record will speak for itself on the responsiveness of that answer. I'll just move on. You do agree that the residual value is calculated in the tariff models in accordance with the contracts between HTC and HIBIC, right?
Yes, the residual value is calculated in accordance with the agreement between the two wholly owned subsidiaries.
Yeah. And by HTC and HIBIC, I actually meant HTC and Hessam, right?
Sorry, yes.
Okay. Hess is calculating everything in accordance with the contractual language itself, right?
There's a few errors in there.
And that, you're talking about the CPI and the
And
oil issue?
volumes, yeah.
And
Yes.
fair to say that if those were the only issues that you had, we probably wouldn't be here today?
No, well, I'm not sure.
Okay,
That was a very broad question.
let me ask you this. Sitting here today, the CPI caveat that you're giving, that may or may not have a material impact on rates, depending on what the CPI was, but you have not done that calculation, right?
I'm sorry. Can you repeat that?
I asked you the question, you would agree with me that the residual value is calculated in accordance with the contracts between HTC and HIBIC, and HTC and Hessam?
Okay,
And
and I said,
you said
yes.
Okay. And so maybe I'll just move on to the next one. To get to your conclusion that the returns exceed 12 and 14%, you need to use a different definition of residual value than what is set out in the contract. True?
You need to use Hess's projections.
So you recalculate the residual value in your reports and use a different definition of residual value than what is in the contract.
Because using residual value in an NPV formula is an incorrect application. You don't use residual value in NPV
If you would,
analysis.
my question really was just yes or no. You're recalculating the residual value and using a different definition of residual value than what is in the contract.
I'm not
right?
recalculating any residual value. I am looking at the cash that the system would generate for the next 10 years and calculating a rate of return based on the actuals and then the cash and then the projections.
Let me do it one more time. You recalculate the residual value and use a different definition of residual value then what is in the contract to calculate the tariffs?
I
right?
don't calculate a residual value. I calculate the net present value of the cash flow in the second term. That's not the residual value.
Second deposition, page 94, line 17, question, you recalculate the residual value and use a different definition of residual value than what is in the contract to calculate the tariffs, right? Answer.
I
You
miss-
got to stop interrupting me, Mr. Kala. You really do.
I think you thought you were done, Counsel.
Answer, yes. That's how you answer the question of your deposition, right?
I'm sorry, I need to hear the question again.
In your deposition, page 94, line 17, question, you recalculate the residual value and use a different definition of residual value than what is in the contract to calculate the tariffs, right? Answer, yes.
I incorrectly answered with the semantics. It's not residual value, it's the net present value of the cash flow in the second term.
To get
So
to
I
your,
stand corrected.
I'm sorry to interrupt. To get to your conclusion, you need to scrap the definition of residual value that's in the contract and to substitute in an entirely different concept, right?
I insert reality.
Well, you insert your reality, right?
The cash flows that Hess projected.
Now, this reality, this different concept, well, let me ask you this way. Would you agree that it's a different concept?
The cash flow of from Hess projections is what Hess is saying that this would flow through that time period, and I use that to calculate the internal rate of return.
Second deposition, page 101, line 7 to 13, question, am I understanding correctly? You basically have to scrap the whole definition of residual value. It's not like line edits to the definition of residual value. It would be a totally different concept. Answer, it's a different concept.
Yeah, it's a flawed calculation.
Now, this different concept that you're substituting in is not something that you came up with, true?
Mr. Cronshaw helped us.
Again, without Dr. Cronshaw, you would not have been able to do this on your own, right?
That's fair. That's why we got him.
And Dr. Cronshaw didn't provide you with any sort of treatise or authoritative text saying that his way to do it is the right way to do it and that Hess's way to do it is the wrong way to do it, right?
He's not doing it any different way. He's taking the data and calculating an internal rate of return. He's not doing anything different. It's the cash flow. It's the net present value and the internal rate of return. It just takes all the cash flows over the life of it and calculates what that is. So internal rate of return is very common. It's used all over.
Are you aware of any treatise or other authoritative text that says that the way that you say it should be done is the right way to do it as opposed to what it says in the contract?
I'm not aware of any treatise that does it the way Hess does it either.
Sitting here today, we've got the contract saying do it one way. We've got Dr. Cronshaw saying do it another way, right?
Again, I'm sorry, I'm not being obtuse, but Cronshaw didn't do it. He took the Hess data and calculated internal rate of return.
He did it by changing the definition of the contract, right?
No, he modeled the cash flow. He just took the cash flow. He didn't change he didn't say it. I guess we're just going to have to agree to disagree.
The way you get to the IRRs higher than 12 and 14% is by using a different definition of residual value than what is set out in the
We're
contract.
using
true?
the cash flows from the second period.
And that is a different definition than what is set out in the contract.
It's
true?
not a definition of residual value. It's the cash flows. They're two different things.
Second deposition, page 79, line 2, question, so the way you get to the IRRs higher than 12 and 14% is by using a different definition of residual value than what is set out in the contract, true? Answer, using the true value of the asset in 2024. Question, right. That's your opinion of the true value of the asset, but that would be different definition than what is set out in the contract. Answer, yes.
And I have stood corrected. It's so much different. It's hard to say it's a definition of residual value. It's a different concept. The tariff model's flawed in that it's going to automatically use that 12% with that plug residual value number.
It sounds like you're using a different definition of residual value for your calculations than what the contract says, right?
You reminded me what I said, and I understand that, but I'm standing corrected here.
So you're changing your testimony from your deposition, is that true?
I guess I was tripped up.
Okay, and I asked you 3 times at your deposition the exact same question. You answered it 3 times the same way, all under oath, true?
Yes, that was my understanding in the line of questioning at the time.
Okay, and now you're changing your deposition from your sworn testimony, your testimony from your sworn deposition, is that true?
Objection asked and answered.
I'll move on. Let's show.
I'm understanding something differently now.
Let's show the commission how this actually works. Take a look at your slides that you walked through with Mr. Vivian. Look at slide 12, please. This is the return on capital is not IRR slide, right?
Yes,
Bottom left is a table, right?
yes,
And it's got 4 columns. The far left one is just years, right?
it's years, it's the periods within the 2019 model.
Okay, and then the first column after that is called Hess model, right?
Yes,
And you're trying to describe how the Hess model works, right?
yes, what number it uses in each one of those year periods.
And you'd agree with me that the Hess model actually follows the contracts, right?
Yes,
And then the next one is tariff model reflected in table 5, right?
yes,
And that's referring to one of the tables in your second supplemental report, right?
yes,
And then the final one is referring to table 6, which is another table from your second supplemental report, right?
yes,
So for the 2013 to 2018 time periods, all 3 do it the same way. They use historical actuals, right?
yes,
And then in 2019, the Hess model in table 5 do it the same way, right?
yes,
But for table 6, you actually change what the contract says and calculate the numbers by changing the contract, right?
well, I want to see what table 6 is real quick.
Sure,
Don't mind.
take your time.
Let's see, that is in my second supplemental. Yes, table 6 was using the actual cash flows in the second term projected by Hess to come up with the rates, and each year is a standalone year.
Okay, so for table 6, in 2019, you do something different than what the contracts require, right?
Yes, we use the projected cash flow instead of the plug residual value.
And then just so that we're understanding, for 2020 to 2023, the entry is the same for all 3. It says projected asterisk, right?
I'm sorry, can you restate?
On slide 12 of your demonstrative in the table,
Oh, we're back, okay,
Yeah.
sorry.
it says projected in all 3 for Hess model, table 5 and table 6, right?
Yes, Hess assumptions,
Okay.
yes.
And then for 2024, it says depreciated book value for Hess model, right?
Yes, which is residual value.
Okay, so that's what the contracts refer to as residual value in your view?
That's what residual value is, yes.
And then for table 5 and table 6, you do something different than what the contracts provide, right?
We use Hess projected numbers that were already included in the tariff calculations.
Right, and that's different than what the contract provides, right?
It is different than the affiliate contract, yes.
And then for 2025 to 2033, again, your tables 5 and 6 do something different than what the contract provides, right?
Yes, we project what Hess did,
Okay, so let's, but again, that's different than what the contract provides, right?
yes,
Do you have table 6 in front of you still from your second supplemental report?
yes.
And I think you alluded to this on your direct exam. I just want to make sure that this is clear because it happened pretty quickly. You referred to the tariff model as a living model, right? Remember using that
Yes.
term? Yeah. And what you're talking about there is that the way the tariff model actually works is the tariff calculations for any given year take into account the tariff calculations from the prior year, right?
And the future years,
Right.
yes,
So they all work together, right?
yes,
And so just to illustrate that, say in year one, the tariff model generated a rate of $1 per MCF. And then in year plus one, so say in year two, that $1 per MCF rate would be an input into the year two tariff calculations, right?
Can I repeat just to make sure I got the question
Sure.
right? So in year one, it calculated $1. Year two, it would calculate the revenue attributable to that dollar, and that would be, yes.
Yeah, okay. So year one, the dollar from year one flows into the calculation for year two.
Yes.
Okay. And I think the way we talked about it in the deposition was, I use the word cumulative. It builds year on year as opposed to independent.
Yes.
And that's, you're comfortable with that concept?
I'm afraid to say yes to anything, but repeat that again?
You're okay with me? I'm looking for a word that we can agree on, and we use the word cumulative in the deposition back and forth, so to talk about the living model concept as opposed to doing each year in isolation.
Okay.
I'm just seeing if we can get agreement on a term.
So we'll say cumulative means it takes the whole time period into effect?
Right.
Okay.
So that dollar from year one would flow into year two.
Yes.
So let's look at table 6, and just to kind of illustrate what this issue is, in 2014, you show that the Hess model calculated tariff of 74 cents, right?
May I save us some time?
Well, this won't take very long, frankly. It's just a few questions, so if you would just follow along.
Okay.
Yeah.
Start over.
Okay. You show that Hess's calculation of the tariff was 74 cents, right?
Yes.
And you calculated it as 63 cents using the methodology that Dr. Cronshaw gave you, right?
Yes.
And so in real life, that 2015 tariff model would use the 63-cent tariff rate as an input rather than the 74 cents, right?
Yes.
But when you did the calculation for 2015, you used the 74 cents, not the 63 cents as an input, right?
That's correct. This table was just a demonstrative to show standalone what each year it would be without cascading, starting in 24 and changing it through the whole time period.
Yeah, and so even though in real life it's a living model that's cumulative, you calculated each year independently in isolation.
Yeah, we didn't calculate a damage model on this. This was just a demonstrative to show what each year would be if in that standalone year.
And the effect of that, you have this column called excess, right?
Yes.
But the effect of not carrying those through is that it overstates the excess, right?
Yes.
And so if you'd carried, so for example, if we start in 2014 and end in 2022, and for each one of those, you have the actual compared against your calculation, right? And then on the far right of those sets of columns, you have the column called excess, right?
Yes.
And so for 2014, you have an excess of 11 cents, right?
Yes.
And that's just the math of 74 cents minus 63 cents, right?
Yes.
And then in 2022, you've got the Hess model calculating 339 for Red Sky, right?
Yes.
And under your and Dr. Cronshaw's method, it's $1.38, right?
Yes. So if we kept everything the same and then calculated that cumulative living model in 2022, it would just return that $1.38 with the 201 excess.
Right. And so you're not suggesting to the commission that there's actually a $2.01 difference between the actual tariff model and your methodology had you actually applied the methodology to the living model itself, right?
Yes, I believe I addressed that in my direct as well.
Yeah. It would be substantially less of a difference.
It would be less.
Okay. You also testified that the 12% and 14% rates of return in the contract are themselves unreasonable, right?
Yes.
Objection, not sure you offer an opinion on that, but go ahead.
Are you offering an opinion that the 12 and 14% rates of return in the contract are themselves unreasonable?
The whole confluence of everything results in a much higher rate that we think is reasonable. We've shown the Deloitte article that shows the average for the midstream companies was around 7 to 8% after tax. So based on that, yes.
So you are offering an opinion in this case that the 12 and 14% rates of return are unreasonable?
Actually, my opinion is the rates are unreasonable.
Okay. Are you okay with the 12 and 14% numbers done on a pre-tax basis, like Hess's tariff model?
You know, it's hard to say because that's done in a negotiation between two parties, so it's hard to say. We've shown midstream, if you're using the WAC, the weighted average cost of capital, where that is much lower than this, based on Deloitte's study sourced by Bloomberg for 122 companies. It was lower than that. So based on FERC models and other models that use weighted average cost of capital, this is higher than what the average looks to be, but we've never gotten Hessam's weighted average cost of capital.
Yeah, and if you're offering the opinion that you think the 12 and 14% are too high, then I've got questions about it. And if you're not offering that opinion, then we could probably save time. And so I'm just trying to figure out, are you offering the opinion in this case that the 12 and 14% rates of return in the contract are themselves unreasonable?
I'm not offering that opinion in a vacuum. I'm offering an opinion that the rates are not reasonable or actual, where the 12 and 14% cost of capital return is part of that opinion.
Okay, well, I think we have to go through it then. You've never seen a contract that identifies a rate of return on midstream assets before, right?
Correct.
And you would agree with me that in assessing the reasonableness of a rate, there's a range of reasonableness, right?
Range of reasonable, yes.
And you've identified a couple of examples of what might be a reasonable rate of return, but you have not attempted to identify the full range of what is reasonable, true?
True.
You said this in your report, to determine a reasonable return when regulating non-competitive situations, FERC typically allows providers to realize a return equal to their weighted average cost of capital, right?
Yes.
And for the court reporter, that's WACC, W-A-C-C, right?
Yes.
Okay. So looking at the WACC to evaluate the reasonableness of a rate is what FERC has done in situations, including non-competitive situations, right?
Yes.
In other words, a company's WACC is a good indicator of a rate of return that's reasonable. Fair?
Yes, that's something that they use.
A WACC can be calculated on a pre-tax or post-tax basis, right?
Yes.
Hess's contract set out a 12% and 14% rate that is done on a pre-tax basis, right?
Yes.
Hess's whole tariff model is done on a pre-tax basis, right?
Yes. They call it the cost of capital of 12%.
And that's pre-tax.
Yes.
Okay. So if the commission wanted to study Hess's WACC, it should do it on a pre-tax basis, not a post-tax basis, right?
I mean, typically you see things done on an after-tax basis, but FERC, I believe, uses pre-tax to take the tax bracket out of that, so, yes.
Okay. So if the commission wanted to look at the reasonableness of Hess's rate and compare it to Hess's WACC, the relevant WACC to look at would be a pre-tax WACC, right?
As long as we have apples and apples.
Okay. And part of that apples to apples is that if you wanted to look at the right WACC, it shouldn't just be pre-tax, but it should be the WACC at the time the contracts were entered into. Fair?
Yes.
You talked a little bit with Mr. Vivian about a 9% number. Do you remember that?
Yes.
And I think we talked about that at your deposition, and I think you called it an experimental or hypothetical number, not an actual WACC calculation.
It
True?
was a Hess assumption. It was in the tariff models.
And that's just an assumption, not a calculated number, right?
Yes, it's a Hess assumption.
And you yourself have not calculated a pre-tax WACC for Hess Corp., Hessam, HTC, or any other Hess entity. True?
No, I have not seen any Hessam WAC.
Well, my question was, you have not calculated a pre-tax WACC for Hess Corporation, Hess Bakken, Hess Trading Company, or Hess Midstream. Is that true?
Correct. I have not calculated a Hess pre-tax WAC, pre-tax WAC for any of the Hess entities.
Now, you agreed with me at your deposition that if Hess's actual pre-tax WAC were 12 or 14%, then you suppose that would mean that the 12 to 14% rate in the contracts are in the range of reasonableness. Do you remember that?
I'm sure you have my deposition, so if that's what I said,
No reason to dispute that, right?
no.
You're familiar with an entity called the Texas Comptroller, right?
Yes,
And you've used their data in connection with some of your litigation and audit work, right?
I have.
And when you've used the Texas Comptroller data, you found it to be reliable, right?
And what I've used it, I've never used their WAC calculations before.
Yeah, well, that was my next question. You've never studied the Texas Comptroller's WAC calculations in depth, true?
True, but I do know that we had it in front of me, I'm not sure what exhibit it is. It was Hess as a whole WAC, it wasn't just Hess midstream WAC.
Yeah, and my question is much more targeted. My question is just, can we agree that when you've used Texas Comptroller data in your other work, you found it to be reliable? I understand it's not the WAC work, but generally as an entity, their data is something that you use in your work, right?
In the other times that I've used the comptroller data, it's usually just reported volumes, values from state of Texas producers. And so in that context, I have relied on it.
And you don't do that with remorse. You're okay relying on it, right?
For those specific instances, yes.
You looked at that Deloitte document earlier, right? It was A65.
Yes.
Grab that, would you, in front of you? You have it in front of you?
Yes.
Now, this is, if you look at the back, I think you testified, this is from 2018, right?
I think so. I saw that copyright, but I can't say for sure. I was looking at it, but it's kind of under the gun, so I just grabbed the first set I saw.
Yeah, and if you look at some of the graphs and whatnot, the data generally ends in 2018, right?
Fair?
This is a document that you could have cited in your first, second, or third reports, true?
Thought I had it. Yes.
And how'd you find it?
I'm not sure of the origin, either the attorneys or Dr. Cronshaw.
Okay, so you didn't find this yourself?
No, sir.
Somebody gave it to you?
Somebody on our team provided it, yes.
You could have Googled midstream WAC in 2021 or 22 and found this document, right?
Maybe. It's not titled WAC. Maybe. I don't know. Maybe.
Okay.
We could try it if you want to.
This document, A65, doesn't actually show how Deloitte did any of the calculations, does it?
Similar to the comptroller doesn't show. But no, I'm sorry. That was uncalled for. It does not.
Well, the comptroller data actually has lots of rows of data showing cost of equity and betas and things of that nature, right?
Yeah. For the whole Hess Corporation, yes.
Well, not just for the Hess Corporation, for any Texas producer, right?
Yeah. For the whole company, yes.
And we don't have that for any companies listed here, right?
No, we just have Deloitte saying they sourced it from Bloomberg.
In fact, we don't even know what the companies are.
We don't, but it's a big basket of them.
We don't know if any of them have any operations in North Dakota, do we?
We don't.
We don't know what assumptions went into this, do we?
We don't.
So we don't know the calculations, the assumptions, or the companies, right?
Right.
But we do know that this is a post-tax WAC, right?
Yes.
That's different than the pre-tax WAC that's in
Yes.
Hess's model.
Yes.
Okay. Did you, after you got this, did you ask anybody for the underlying data?
No. Deloitte's pretty reputable. We went with that.
Did you talk to anybody from Deloitte about this?
No.
Do you know the folks who are identified there at the back, Dwayne Dixon and Andrew Slaughter?
No. And I don't know any of the contributing authors either.
Do you know if this includes Hessen?
I do not.
FERC, you talked about that. It permits a rate of return on the pipelines that it regulates, right?
Yes.
And fair to say that the rates of return that FERC allows on the pipelines that it regulates are within the range of reasonableness?
Sorry, I missed the whole
Sure.
question.
Fair to say that the rates of return that FERC allows on the pipelines that it regulates are within the range of reasonableness?
Yes, but every situation might be different. We don't have all the different components and factors that they take into it. For instance, we haven't seen any rates. We've only seen WACC. And we haven't even seen how the WACC or how the internal rate of return is calculated. It's just a number. So we haven't gotten to peek behind the curtains on some of those.
Also haven't gotten to peek behind the curtains of the Deloitte analysis, right?
Correct.
We've actually seen more about the FERC ones because we can get a specific company and get their WACC, right?
Maybe, I'm not sure.
You could get, for example, the WACC for Northern Border if you wanted to, right?
If you tell me that.
And Northern Border is regulated by FERC, right?
I don't know that for a fact, but I have no reason to not believe you.
And you haven't studied the WACC or the rate of return allowed by FERC for the Northern Border pipeline, true?
Is it a transmission line or a midstream line?
It's an interstate line.
It's an interstate line, okay. I have not.
Now, another data point that you talked about is in the range of reasonableness is simply multiplying the prime interest rate by 1.5, right?
By the earlier case, yes.
And you got that from the NDIC order that your counsel read into the record earlier, right?
Yes.
In that case, the operator, Petro Harvester, testified that it had a WACC of about 15%, right?
Yes.
But in that case, there was no evidence in the record to show how that number was calculated. Do you remember that?
Yes.
Absent such evidence, what the commission did is it simply multiplied the prime interest rate by 1.5, right?
Yes, and the 1.5 had some significance. I don't remember. Let's see here. Do you know exhibit it is?
I don't think the actual order is an
Oh.
exhibit.
It's not. Sorry. I have it here somewhere.
You reference it in your report,
Yes.
your second supplemental report at
Oh.
page 16.
Second supplemental. Pardon me one second. Okay.
And so I think my question was, without evidence of Petro Harvester's WACC, the commission simply multiplied the prime interest rate by 1.58, right?
Yes.
And so here, the prime interest rate from the time the contracts were entered into would result in a calculation of about 5.135% is what you say in your report, right?
Yes, that's what the NDIC order says, yes.
And have you ever encountered a WACC, a pre-tax WACC as low as 5.135%?
Here it is. I may have, I don't know. I can't really say sitting here today.
Well, here, by here, you're referring to the NDIC order, right?
Yes.
That's not calculating a WACC, right? That's just a calculation of prime times 1.58, true?
Yes.
And in real life, have you ever encountered a WACC as low as 5.135% in all of your audit work?
We really haven't looked at wax that often, so I can't say I have or I haven't.
Sitting here today, you can't identify any company you've ever served as an expert on, audited, with a WACC, a pre-tax WACC of 5.135%, true?
That's fair.
I'll pass the witness.
We've been going for quite a while now, so let's take a short break, and then we'll come back and you can finish up, and then we can, staff can ask questions. 10 minutes.
And Mr. Hearing Examiner, and
Ready? Okay, we'll go back on the record.
And, Mr. Hearing Examiner, my understanding is the normal rule is that while sworn, a witness is not to discuss the substance of his testimony with counsel, and we'd ask that that admonishment be given here as well.
I think you're free to invoke that rule in this case, and
Fine by
so
us?
so during this break, you're instructed not to consult with counsel regarding the testimony that's taking place.
That's
here.
fine. I wouldn't mind just pushing through. Or we can go stand in our corners.
Take a break.
Okay, we'll
Stay
take a
right
break.
there, Mr.
Okay.
10 minutes, please. We'll go off the record. All right, it's 2:41. We'll go back on the record, and I'll just remind you, you continue to be under oath, sir, and you can begin your redirect.
Thank you. One housekeeping matter. I think I may not have offered Exhibit 44, which is the second amended and restated process and infractionation agreement.
No objection.
All right, exhibit is received.
Thank you. Mr. Attella, it seems like a while ago, but there was some discussion early on about requesting an audit of Hess and so forth. Do you remember that?
Yeah, I remember our discussion about it.
Yeah.
Yes.
After the application got filed, did anyone from Hess ever reach out and say, hey, wait a second, must be some mistake here, we're happy to let you audit?
Not that I'm aware of.
What is the industry standard on recalculating producing overhead once it's been set? Or not recalculating, escalating is a better word.
Well, there's not a standard for recalculating overhead, because I haven't seen it done. Escalating, you take, in April every year, COPUS issues a new escalation percentage. Sometimes it's a decrease, sometimes it's an increase, based on the indexes that it tracks. And then you just escalate it for April until the next April when another rate comes up.
With regard to what Hess did in 2017 with recalculating producing overhead, have you ever seen anyone else do that?
I have not.
You mentioned, and it may have been somewhat sarcastically, that Hess can just do whatever it wants. Do you remember that?
Yeah, I apologize. That's,
Are you suggesting Hess can do whatever it wants, subject to some control?
well, if they're allowed to recalculate their overhead, what would stop any operator from just recalculating your overhead every year if you want to? COPUS addressed that way back in 1962, realizing that was such a difficult task, and that's why they set that standard.
If you could look at your report, Exhibit 40, your second supplemental, it's Exhibit 41, Table 8, page 19.
Okay.
And again, this is a comparison of producing overhead rates.
Yes.
And there's a number of wells here, correct?
Yes.
And what county are the subject wells in?
Montreux.
And when you look at the other wells that are located in Montreal County, what is the smallest differential in producing overhead from the rate Hess is charging?
Let's see here. The smallest differential, in other words, the highest other Montreal County rate.
Yes.
I believe it's this, let's see, the Burr Federal 1126. There's a 321.39 difference. Let me just make sure. Yes, the Continental Burr Federal 1126. It's $1,810. That's the smallest difference.
And what's the lowest producing overhead rate among the Montreal County wells in Table 8?
Looks like 1,055 for the Oasis Healing Trust Fed 5494 41-22.
So in terms of a differential, you have a range of 321 on the low side to almost $1,100 on the high.
Yes.
Is the location of a well a factor in determining the producing overhead rate?
It can be.
If you could turn to Exhibit A38, please. This is another reading class exhibit.
Can you describe the exhibit so I know where some things are? I'm sorry.
Yeah, I believe it's the exhibit that Mr. Macbeth prepared with some additional wells comparison.
Okay. Let's see, this one starts at 39. I feel like I've seen it. Hold on.
I can just hand you my copy.
Okay, thank you.
And Mr. Naresh asked you some questions about an EOG well that had an initial producing overhead rate of $2,000. Do you remember that?
Yes,
And that's down at the bottom of Exhibit 838.
yes.
When was the first date of production on that EOG well?
Well, I have to assume it's after March of 2018 because there's no producing overhead charge at that time, but that's really all I can conclude. It was after March of 2018.
Can I take, I thought I saw September on there.
Oh, is it? Oh, does it say it over to the left? I didn't catch it.
Yeah, there's a column
Sorry.
called first production.
Sorry. Okay. Whew. I don't want to do it either.
Need the reading glasses and
I'm
the
sorry.
magnifying glass
Yeah,
for
well,
that.
I need a ruler. Yes, September 2018. So I was right on my after 318, I guess.
And when were the wells, the subject wells drilled? Remember which years?
I believe 14-ish, 2014-ish.
Is the date a well starts producing another consideration in determining the producing overhead rate?
Yeah, what's going on at that time, for sure. And it's negotiated at that time.
Are there some wells on the bottom there that did initially start producing in 14 and 15?
Yeah, I see some 13 and 14. And the bottom, let's see here. I see a 2012. I see some of them were overhead that's starting in 2013. I'm not sure.
And what were the overhead rates for those?
Range from 1,000 to 1,073.
1,000 to 1,073?
Yes.
Okay. Thank you. Mr. Naresh asked some questions about the quality, the type and quality of the services at Tioga. You remember those questions generally?
Yes.
Is it fair to say that working interest owners want to get as much value as possible from their oil and gas?
I think that's fair.
Are working interest owners particularly concerned about the nature of the gas molecule exiting the plant?
I mean, I suppose it could make a difference whether there's more NGLs or more residue, but that shifts between what the market factors are. They're concerned that they're going to get their best economic benefit at that settlement because they don't have control of it anymore, whatever happens after that tailgate.
Mr. Naresh asked some questions about contracts for other midstream assets, including whether those contracts were POP contracts or not. You recall?
Yes.
So the contracts in this case, exhibits 43 and 44, who decided whether those contracts would be POP contracts or include the tariff model that we've been talking about?
It's a negotiation between the parties. I would think the processor probably has more power in that situation.
Right. And I'm asking about the contracts on the subject wells.
Oh, well, I think it would still hold true. It's probably Hessam has more power because they have the infrastructure in the plant.
There were some questions about the necessity of building more plants, supply and demand. If Hessam were to build more gas plant capacity, what would happen to the tariffs?
Well, in the current contract, nothing would because it's just escalated by the price index. But if they did, well, I'd speculate. Sorry.
Would Hessam make more money?
Well, they'd make more money by having more capacity to process and gather.
And with regard to supply and demand, if the demand for processing was sufficient to require Hessam to build another gas plant or expand Tioga, what do you think would happen in reality?
I guess you're asking for my opinion.
Yes.
If they had to put a lot of capital infrastructure in, the secondary term of this agreement doesn't call for that, and that term So I would think if they had to spend a lot of money, they would probably renegotiate that agreement to get those capital costs in their return.
And Mr. Naresh also has some questions about the control of global infrastructure partners over HESM decisions. Do you remember that?
Yes.
Would global infrastructure have an incentive to seek termination of the contracts in this case if renegotiating would make HESM more money?
They would not.
GIP would not?
I'm sorry. GIP would not object if they were going to make more money.
Because they're a 38 or 41% owner of HESM, right?
I'm speculating, but I don't think GIP would object if they were going to make more money.
There were some comments about HESM and HES's corporate structure in your reports. What did you rely on in making those comments generally?
All HES data, investor relations, 10Ks, websites.
You and Mr. Naresh went back and forth for quite a while about residual value and recalculations and so forth and so on. In doing what you did in calculating the excess tariffs in your second supplemental, did you use any data other than information that HES provided?
No, the input data was all already included in the tariff, if that's what you're asking.
That's what
It was
I'm
all
asking.
included in the tariff spreadsheets.
Does the contractual definition of residual value in these agreements bear any relation to the actual value of the assets?
No. If you were to sell that asset now, it would be more than that residual value of what it says.
Mr. Naresh asked you some questions about, I think what you both described as a living model in Table 6 of your second supplemental report. And why don't we go there? It's on page 16, I believe.
Yes.
So there's a column called actual tariff rate, correct?
Yes.
And HESM actually got paid those tariff rates, correct?
Yes.
Has HESM paid any of the working interest owners back for the excess?
No.
I wanted to clarify something. Do you believe 12 to 14% to be HESM's cost of capital?
I'm not sure if I can answer that. Let's see. The contract states 12 or 14%.
Let me ask a different question. You don't know what HESM's weighted average cost of capital is, correct?
I do not. I'm sorry, I was confusing return on capital and cost of capital.
And you already answered that question. How would the distinction between pre and post-tax impact a WACC?
A WACC, an after-tax WACC would be lower because depending on what the taxing environment is at the time, it's more favorable now. It was higher back then. So I think a 35% was tax rate, corporate tax rate may have been used at that time. So the after-tax WACC would be lower than the pre-tax. Did I do it? I'm just thinking through the math if I understood that right. Yeah, pre-tax would be high. Yes.
And what would the math be, just so we know?
Okay, so let's use 10 for an example because it's easy math. And the tax rate was 35%. So pre-tax would be 10%, after-tax would be 6.5%. Just easy math.
Okay. There was discussion of FERC. FERC's a regulator of interstate pipelines.
Yes.
And if there's a rate case brought before FERC, FERC can approve the rate, right?
Yes, they believe they approve the rate, not necessarily what the WACC is or things like that, but the ultimate rate.
And to your understanding, for a non-FERC pipeline like the gathering system here, who's the agency that would approve the rate for this gathering system?
Well, I think that's up for some conflict right now. Obviously, in this case, it would be the NDIC.
I'll pass the witness back to whoever's taking the witness next.
Any additional questions?
Just three quick ones, if I may. Could you get, please, A38? That's the tiny font one.
Yes. That Mark took back.
I can go back.
Could you please, I just have one quick question.
It's somewhere. I mean, I could find it. Hold on one second.
Here you go, Todd.
I'll take it.
You were asked if the drilling date was a consideration, right?
Yeah,
And you
spud
said-
date.
And you said yes?
Yes.
And if you look down at the bottom, that's where Mr. Macbeth identified a number of other operators, right? And they're producing overhead rates?
Yes.
Do any of those have a spud date or first production date in the same year as the subject wells?
They have some before the subject wells.
Like, do
So
any
they're
of them-
older.
Do any of them have a first production date the same year as the subject wells?
Well, let's see. Oh, that's the Hess well. No, just earlier or after.
Okay. Now, you were asked what would happen if Hessam had to add capital and invest more in North Dakota midstream infrastructure, and I think you testified that they'd probably need to renegotiate, right?
I hypothetically, yes. If they spend a whole bunch of money, they might want to renegotiate to get returns of that money.
And I think you're heading the same direction as me. You're speculating, right?
Yeah, 100%.
Okay. And then finally, on your final report, your second supplemental, Mr. Vivian asked you about Table 6 and whether or not Hess had paid the excess back to non-working interest owners. Do you remember that question?
Yes.
Now, that excess column, that's what we talked about earlier. That's not a real number, right?
I guess it'd be real in 2014, but no, it's due to the cumulative effect that we talked about.
The only number that's real in here is the 11-cent number, right?
Yeah, we use that as an example. Yes, standalone for each year.
And real, that's under your methodology, not the contracts, right?
Fair.
Okay, no further questions?
Nope.
All right, staff members, any questions?
I forgot about this part.
Todd, I just had a couple of clarification. If I'm understanding there was obviously a lot of different ways for calculation and so on, but COPUS has referenced the last couple of days pretty much nonstop. But in your opinion, if COPUS was followed, does that meet what the standard is nationwide from what you've seen reviewing?
100%. I mean, the sun rises in the east, you escalate overhead in April.
Are you aware of any operators not following that besides Hess?
I am not aware of that. There's been mistakes where somebody might grab the wrong rate, or there could be some math problems or things like that. But I am not aware of somebody that's unilaterally just changed the overhead rate.
So overall, and I'm trying to think how to word that, but your opinion to the commission would be that that is what should be followed and used for the calculation?
Yes, it's the standard, and Hess did it until they didn't, and then they started doing it again.
Thank you.
Todd, on those same lines, what obligation does an operator have if you don't have a JOA, you don't have a contract, you can't do your initial evaluation to determine what that overhead's gonna be, right? I mean, if one company says, if the operator says, I'm not gonna negotiate what the overhead is with you, there's no contractual agreement that says that you have to, right?
No, but I think that non-operator can decide if he wants to participate in that well at the time that the rate is set. So yes, there may have been discussions at the beginning. I don't know, I wasn't there, but there was discussions, or there may have been discussions. And at that point, the non-operator, I think, has a decision to make. If they thought something that was not fair or not right, they might say no, they might say yes. But that would be the time where you could make that decision, in my opinion.
But it's already been shown that JOAs are not real common in the Bakken, right?
Correct.
So what obligation does a company have to even follow COPUS? I understand it might be the standard, operating procedure to do that, but what requirement is there that you follow it?
Good question. In my opinion, we have the actual and reasonable requirement. And I think that would be under the reasonable, or else, what is every operator gonna do? They're gonna raise their overhead rates, because they can. And then are you gonna audit that? That's already gone through that process many, many, many years ago with both operators and non-operators. It's not just operators in COPUS, it's non-operators as well. And it was a very complex mess, and so that's why they have carried through with the overhead as it is with the escalation each year. And, COPUS just isn't operators. It's many non-operators, and many of those companies are both operators and non-operators, Hess's. So that's a tried and true that's been going on for, 60 years.
Okay, so following COPUS may show a reasonableness of the calculation, but it doesn't exclude other ways to do it, right? You could be reasonable and not use it.
I think that would be, it's up for the commission to decide, but, I think, can I elaborate?
Sure.
If Hess is setting up their accounting system for billing labor and using, like COPUS issues a benefit limitation where it can't exceed 36%. So if you have 50% benefit rate, you can only charge 36%. I don't know this, but I've helped set up accounting systems or to bill partners. They probably use COPUS. Heck, they use COPUS on COPUS escalation rates. So I would think they follow those guidelines quite a bit.
What happens when you initially try to determine the overhead initially and you don't agree? Aren't you stuck with what the operator has, or is there COPUS guidelines that would address that?
There aren't guidelines that would address that. It's usually negotiated. So say if you want a higher overhead rate and the operator says, I want to go $10,000 just for grins. Well, there's other things in the accounting procedure that you could check or elect to maybe offset that. For instance, technical labor. There are options to directly charge off-site technical labor, engineers in the office. There's options to have that covered by overhead. So if you were to be able to charge that, you may have a lower overhead rate, for instance. So there is some give and take there, but I think ultimately, at the time of negotiations, the operator or the non-operator, they have to make a decision if they want to keep proceeding or if they want to try and fight and take over operator if they don't like what the operator is doing on a particular instance.
You talked about Order 30789, which was a petrol harvester case. They were involved in it anyway, where we talked about the WAC and what was going to be allowed for a percent. I just want to read paragraph 3 of the findings. It indicates the commission finds under Century Code 380808, the commission has jurisdiction and is required to decide disputes over proper costs for the drilling and operation of a well. Whether a gas processing fee is an operation cost is the question of fact, and the commission does not have sufficient information at this time to make that determination. So I just want to point out to both parties that just because somebody thinks that those processing fees are something under our jurisdiction, you're going to have to show it. Because in this case, the commission did not make that decision and said sufficient information was not there. So it's not a given. So we do need information to show why that is in operation of the well.
I think I understand what you're saying. You're saying that, we should see it has some whack to, weighted average cost of capital?
Well, I kind of shifted gears. I mean, I
I'm
wasn't
sorry.
talking about the WAC anymore. I'm talking
Okay.
now about the processing fees
Okay.
on the gas.
Okay,
So there's been a lot of discussion about all these fees, the tariffs and so forth. And just because you're putting it before us doesn't mean that we have jurisdiction over it. So at the end of the day, at the end of the post-hearing briefs or wherever, it has to be addressed.
so perhaps Sinclair and Hess could come together and negotiate a rate that everybody agrees with? I'm just speculating, or just,
Well, you're gonna
Throwing
have
out-
to convince us. We're not gonna tell you what to do.
okay, okay. But I understand.
Okay, thank you.
Todd, in your set of slides, let's jump to number 3. You use a term that we don't commonly use, producing overhead. And,
Okay.
you know, you express an opinion about that, producing overhead. So, series of questions. So I want to understand what you define producing overhead as. Is there overhead that's associated with drilling costs?
No, sir, so.
So
yeah.
that's not part of this. Go ahead.
Yeah, I'll just elaborate just a touch. You have drilling overhead and you have producing overhead.
Okay.
And drilling overhead is typically 10 times of what producing overhead. It's not always, it's a negotiated amount. And the way drilling overhead works is there's more stuff going on, more activity, more engineers, a lot of things. So that's a higher rate, but for a shorter period of time. Where drilling overhead, you literally break that, say we're just using 10,000 and 1,000, 10,000 for drilling and 1,000 for producing. The 10,000 drilling overhead, say they drilled, I'm going to be very simple, they drilled for 15 days. They drilled for half the month, on a 30-day month. So they would be, per the accounting procedures, they would be allowed to charge $5,000 for drilling overhead. They break drilling overhead down by days. But for producing overhead, it's just a monthly fee deemed to cover all of the additional administrative costs going on. So say if it's $1,000, yes, $1,000 isn't covering everything, but Hess might operate 1,600 wells. So they're going to get $1,000 times 1,600 times their net working, or the reciprocal of their net working interest, if that makes sense. So they're not getting all the 1,000 times 1,600, but they're getting the non-operated portion of that. Did I complicate that more than I needed to?
No, I'm tracking.
Okay. Did I answer your question?
We're getting there.
Okay. So,
So then, no drilling overhead in there. I think you showed us some jibs. Was that in your exhibits, or was that, maybe
that
that
may have been
was?
Mr. Macbeth.
That might have been in Mr. Macbeth's. But there was overhead on those joint interest buildings. Is that operating overhead?
Yes, sir.
And would that be part of producing overhead?
Yes, sir. Operating and producing would be synonymous.
Okay.
It's bad terminology on our part.
What about post-production overhead? Would that be in producing overhead? For example, overhead associated with gathering, compression, processing, marketing.
Are you asking where the marketer recoups post-production cost overhead?
Well, I'm asking, is that overhead included in what you're defining as producing overhead?
Okay, I think I can answer that. So, when you have, when you're building a gas plant or building a gathering system, typically there's another kind of overhead, to confuse matters even more, called MCO, or major construction overhead. And that is a percentage overhead based on the dollars that you spent. It's not just a set rate. So say in an agreement, I'm speaking with agreements that are common in the industry, and it has to be very familiar with this too. So if they spent $100,000, then they would get 3% times $100,000 is an additional cost that they would bill to their properties. As far as post-production cost overhead, Mr. Naresh did show me a very large sheet with millions of lines that had their capital expenses. I believe it was detail. Maybe I could look in there and to see if there was a major construction overhead charge where they're including it in there and they're recouping it. I haven't seen the operating expenses to know if there's a percentage overhead in there or not. So it could be in the operating expenses and it may not be. Can't say for sure.
Okay. Number 12. You're making a differential between return on capital and internal rate of return. So I'd like to know your definition of those two items.
Well, return on capital, it's not defined, so we don't know what that is. Typically, return of and return on capital in all the applications that I've seen in cost of service, it's a percentage of money that's returned on the capital expenses to build something, the installation of a fixed asset. That would be the return on capital. Return of capital would be the amortization each year that's included in the cost of service calculation, standalone 1 year at a time, cost of service calculation.
Okay. An internal rate of return?
It's a defined term. It's math. It just calculates if you show cash flows and you show the dates, and Excel calculates what that internal rate of return is. People look for the NP12 or NP14 or NP20 or NP8. They're buying an asset and they want to know what their return is going to be. They look for that to know if they want to make a decision to purchase that asset or not.
So, so what kind of things go into internal rate of return? Obviously, the capital does,
Yes,
correct?
capital and operating.
And operating?
Yes.
Okay. So that's really the distinction?
Yes.
Okay.
Well, I think the way that the math is done is a little bit different as well. But yes, internal rate of return, it shows that there is return on all the cash flows, all the net cash flows, which capital and operating are both part of.
And did I hear you correctly that you don't believe net present value should be applied to operating cost? Is that what you said?
In a cost of service model, I haven't seen net present value. That's usually used to evaluate a purchase or an asset or an acquisition. That's where I've seen net present value used.
We see it a lot on drilling costs and AFEs.
Yes, because they're deciding if they want to make an investment in that asset based on the return on that investment. So it's NPV 12 or NPV 14. The higher the number, the better. So if they see, they're guessing it's going to be an NPV 20, let's drill this well.
Okay. And then there's one here that I'm seeing for the first time, residual value.
Yeah, it's the way it's used, it's just the unamortized or undepreciated part of the capital expenses, and they use a unit of production method. So you could have straight line depreciation. Say we think this has a 20-year life, and so I'm going to depreciate that by 1/20th every year for taxes, for a cost of service calculation. So then you put that amount in your cost of service calculation because you can't get all 20 years back in the first year. And so that, I lost the question.
So are you
Oh, yeah,
saying that at
residual
the end
value,
of the
yes.
20 years, there's zero residual value?
Well, as defined by undepreciated book value there is, but the value of the asset is still much greater than that. And that's the crux of why the calculation shows a 12% return, because it has that residual value at the end of, on the 11th year, and that's included in their calculations. But it's really worth much more than that, and it's going to create much more positive cash flow for the next 10 years, which would increase it to a return of more than 12% or 14%.
So a good investor would hope to have residual value at the end of every year on their asset, right?
It's semantics, but calling it a residual value is literally just, so say if I spend $1,000 to build a gas plant, and I amortize it for 20 years, and I use straight line depreciation, so very one year at a time. At 10 years, the residual value of that asset would be $500, because I have taken 1/20th and depreciated it each year. So now I just have the residual value at the end of 10 years is $500. That's what the residual value, how it's calculated on the Hess model. Does that make sense?
Yeah, it does, but on page 14, you say Hess model defines it in a non-standard way.
Well,
So
no, I'm
there's
sorry.
a standard definition of residual value, and then
Well-
there's this other one, or what?
The residual value isn't typically used in with NPV, net present values. It's two different concepts. So it's not standard to use a residual value in a net present value analysis.
Okay. All right.
Any additional questions? Well, it doesn't look like staff have any additional questions. So I think, sir, unless council have anything else, I hope not.
That concludes applicant's case.
Okay. All right, thank you. Actually, before you get out of your chair, there was a request. I think Sinclair made a request. The request to the commission is to conduct an audit, or that's part of the relief they're requesting. Is that does Missouri River Royalty join in that request?
Yes.
Okay, just so we have the record clear on that. And your case,
We rest.
you rest. How many witnesses are you gonna?
We have 4 witnesses total.
Okay, you ready? Are you ready today to call your first witness?
We have just 2 minutes to rearrange.
Okay.
I think we're gonna,
Yep.
Maybe 5.
maybe 5, okay.
All right, it's 3:25. We'll go back on the record. You may begin with your first witness.
Yes, thank you. Hess is ready to begin its case, and our first witness is Mr. John Gatling.
Could you raise your right hand, sir? Sure. Do you solemnly swear or affirm under the penalties of perjury that the testimony you're about to give in this matter will be true and correct to the best of your knowledge and belief?
Yes, I do.
All right, thank you.
Thank you. Please introduce yourself.
Hi, my name is John Gatling. I'm the Vice President of the Bakken Asset, and I'm also the President and Chief Operating Officer for Hess Midstream.
Okay. And have you presented testimony to the commission before?
Yes, I was here about a month ago for the Vitesse case.
Okay. And did you participate in the development of slides to assist in your testimony today?
Yes, I did.
Okay. That's Hess 85. It should be in your binders, is the demonstratives. Hess 85. Make sure it's the right number. Okay, focusing on slide 2 of Exhibit 85, which are demonstratives, can you summarize for the commission what topics you're prepared to address in your testimony today?
Yes, I'm going to talk a little bit about Hess's time in the Bakken, its long history in the Bakken. I'm going to talk a little bit about the decision to invest in the Bakken. I'm going to also talk about Hess's production, marketing, and midstream services and how it provides material benefits to the operation, specifically around time to bring wells online, also the reliability of the system, enabling flow assurance, and then able to handle the full value stream of production, oil, gas, and water. And then I'll talk a little bit about Hess's future in the Bakken.
Okay. So let's start with slide 3 with the overview Hess in North Dakota today. Can you summarize Hess's presence and activities here in North Dakota?
Sure. The map on the left shows the Hess's acreage position and also the major infrastructure that we have in the Bakken. Hess has about 465,000 net acres, about 70 rig years of future development, has invested about $13.1 billion in assets. As I mentioned, Hess has been in North Dakota for a very long time. The Bakken is Hess's core largest priority onshore asset. Supports employees, contingent workers of more than 600, employees, additional 1,000 plus contractors in North Dakota, and has also been very involved in the community.
Okay. Let's turn to slide 4, and I want to talk about how the relationship began. And let's start in the beginning. I know this slide 4, Commission may have heard last month at Vitesse, but can you start in the beginning, Hess's original play here, and bring us up to 2010?
Sure. So Amerada Petroleum actually drilled the first wells in the Williston Basin, and then Hess acquired the Amerada's position. In 1954, the Tioga gas plant was built. Further acquisitions, additional facilities were built, and then in 2007, 2008 timeframe, Hess drills the first test wells in the Bakken. It was successful. Later in 2009, 2010, additional acreage positions were being negotiated and ultimately acquired in 2010 with the acquisition of Tracker Resources and American Oil and Gas. And then also Hess established its head office in North Dakota in Minot.
Okay. And what were the target hydrocarbons, the opportunity that Hess saw in the Bakken from a value perspective?
Yeah, from a value perspective, it's primarily oil. The gas is high-quality gas, but the primary economic hydrocarbon, the target hydrocarbon was oil.
Okay. And in or around this time, we're in 2010, was the midstream available here in North Dakota to handle the Bakken development that Hess envisioned?
No, I would say not just Hess, but the industry as a whole. I think the basin was a great opportunity. but really, nobody knew what the potential of the rock was, especially around handling gas. So no, the infrastructure wasn't there, and you really needed to understand the acreage position and the geology before you could really assess what the infrastructure requirements were going to be.
Okay, let's go to slide 5 and zoom in a little bit. On slide 5, and I know this is in and around 2010, what was Hess's kind of development and what infrastructure was available there?
So just to orient everybody to the slide, the green rectangles represent drilling space units for Hess. And then you can see the pipeline system, and then there's major infrastructure kind of sprinkled on the map. Just to, again, to remind everybody what the nomenclature is on the slide. C represents compressor stations, P represents processing, O represents oil, and then you can just see how that's kind of spread out across the system at that time.
Okay, and what investment was going to be required, again, back around this time, in order to develop this Bakken opportunity?
I mean, by 2010, there was quite a lot of production going on, and the ramp in the basin was quite aggressive, both on the oil and the gas side. So there was going to be significant infrastructure investment required, particularly around gas assets.
Okay. Let's turn to slide 6 and focus in on the state of Hess Midstream's, really an overview of their operations at the time. Can you summarize what those were, both for oil, gas, and water in or around 2010?
Yeah, it's about the 2010 timeframe, and again, the map shows kind of key infrastructure at the time in 2010. But on the oil gathering side, we had pipelines and the crude terminals. We had about 130,000 barrels of oil capacity at the time. On the gas side, we had just over 600 miles of pipelines. We had 5 compressor stations, 60 million cubic foot a day. And then we had the Tioga gas plant. The original Tioga gas plant was still in operation at that time. It was 120 million a day. And there was essentially no water systems that Hess was involved in at that time.
Okay. I want to pause here just for a minute before we proceed into the Bakken and the development of the midstream. You have before you applicant's Exhibit 9 that was used yesterday. This is A9 for the commission. And this is referring to an Ole Anderson well. First, when was this well that's referred to in Exhibit A9 drilled?
So I don't exactly have the drilling date, but the first production date for this well was June of 2007.
Okay. And what is this document from May of 2023 discussing related to a well that was drilled in June 2007?
So this was a notice of abandonment. It's an election essentially for the non-operator to either elect to participate in the plugging and an abandoning of a well or take over operatorship of the well.
Okay. And did you look at what Missouri River and affiliated entities' interest is in this well, at least an estimate of it?
Yeah, an estimate of it was about 3.5% of the gross of the well.
Okay. And after earning revenues since 2007 or so on this well, what was their what would be their estimated share if they choose to participate in the cost of plugging this well?
Yeah, so just to, again, I think reiterate, so there was 254,000 barrels of oil produced, 474 million cubic foot of gas produced. The share of the $678,000 would be about $23,000.
Okay, we can put that aside. So let's go back to your slides, and let's now move to the development of the Bakken that Hess did in slide 7. And let's start first with, I want to talk about the wells. What did the Bakken wells produce?
Again, I mentioned it earlier, but they produce oil, gas, and water. The Bakken is primarily, from an economic perspective, an oil play. Again, the gas is important. At the end of the day, you cannot produce the Bakken without taking the oil, water, and gas out of the reservoir, and you have to handle it.
Okay. So let's move forward then to the value chain that handles this, and this is slide 8. Can you first, I know we'll go through each of the streams, can you give an overview of what this slide 8 is illustrating?
Right. So if you see at the title on the large green bar that goes across the top, it's got the upstream kind of over the well pad. So this would be a drilling rig well pad location with multiple wells on them most likely, and a flare in this case on that pad. And then from that, then you go into the midstream system. So you have that custody transfer point that's on the well pad. where, where the actual ownership changes at that point, and the cost associated with that operation to take it off the pad is transferred there. And then you've got the midstream system, which is the pipeline systems going through, whether it's an oil terminal, gas processing, water, ultimately to the downstream, and that's to the far right.
Okay. And before we go through each stream, based on the volumes of production, do you need systems or systems like this in order to operate these well pads?
Yes, and in particular gas, and I can explain a little bit why on the gas side.
Okay, so let's start at the top from the three streams. Can you explain how the crude oil is handled from the well pad downstream, especially the midstream?
Yeah, sure. So from the well pad, on the crude oil side, you can take crude oil off of a well pad in two ways. You can truck it off, which is obviously not preferred. There's weather reasons and availability reasons why you don't want to have to rely on the roads to get the oil off the pad. Or you can preferably pipe it off the pad, and then either one of those can get you to a terminal storage. And then there's an export route there to an interstate pipeline, and that can go either to the pipeline or it can go through our rail terminal as well, and then ultimately get to the downstream market.
Okay. Let's deal with that center stream, what's labeled wellhead gas on slide 8.
Sure. So on wellhead gas, again, different from oil and water, you either have to take the gas off the pad, you have to flare the gas, or you have to curtail the production. So in this case, what you have is you have a pipeline system that's taking the gas off the pad, low pressure, goes to a compressor station where the pressure is increased so that you can actually aggregate and get more volume going through the high pressure pipeline system that then ultimately goes to a gas plant. At the gas plant, it's then separated between residue gas, and there's very different quality of residue gas. Generally, we refer to it as the BTU content of the gas in the residue stream. And then the liquids from that are separated, and they can go and be processed further into their purity products, ethane, propane, butane, natural gasoline, or it can be in a Y-grade form, so I'm still a mixed NGL form for further processing. From there, then it goes into pipelines or rail cars, depending on what the ultimate disposition and destination is for that system.
Okay. And finally, can you explain what the water system or water options are off the pad?
Sure. Similar to crude oil, you've got two options to take water off the pad. You can truck it, you can pipe it. Same constraints and issues around taking water off of a pad via truck. It's definitely doable, but it can cause challenges at different times of the year. Plus, you end up having quite a lot of trucks on the road. From there, either pipeline or trucking, you can take it to a disposal location where it's ultimately disposed of. Generally, water systems are regionally based, so rather than needing to aggregate and take it to one major facility for export, you're just trying to get to the nearest disposal well.
Okay. Let's turn to slide 9, and can you explain how Hess's footprint in the Bakken has changed, obviously, on slide 9 over time?
Sure. I mean, this starts in 2013, but as we talked about earlier, there was obviously initial Bakken drilling in 2007 and 8. But you can see from 2013 to 2022, we've added approximately 1,000 wells, and then you can kind of see how the pace of increase changes, generally depending on what's happening from a price perspective. And then in 2021, we ended up divesting our Dunn County acreage, primarily as a result of not being connected to the midstream system and then being further out in the development plan. And then you can see we bumped back up in 2022 as we added the new wells for 2022 in.
Okay. And I know we'll get in more detail, but who services the majority of these wells as shown on slide 9?
Sure. About 90% of the midstream services for the upstream in this case is handled by Hess Midstream. And then there's about 10% of it that's handled by other midstream providers in the basin.
Okay, let's turn to slide 10 and discuss the gas that's produced along with the valuable oil. At the start, can you explain what this slide is illustrating, and then we could get into the details of it?
Sure. So this is the North Dakota Pipeline Authority chart. Justin Krinstead, who leads the North Dakota Pipeline Authority, prepares this chart, and I think what it really shows in the red is the actual gas production. In particular, you can kind of see, just orient yourself to 2012 timeframe to 2017, just the pace of growth, and then again, probably in 2018 to, just pre-pandemic, you can see the pace of gas increase. The gray lines on this chart represent forecasts at different times. As I mentioned before, as the basin is being developed, the geology is being better understood. The expectation for what the oil, water, and gas will ultimately be, and especially the GOR, the gas to oil ratio, those forecasts have changed over time. The blue curve represents, as of this posting from the North Dakota Pipeline Authority, shows what the base forecast is for gas. So growing from about 3 BCF of total gas, growing up to potentially 6.5 BCF. But there's obviously a lot of uncertainty the further out you go.
Let's turn to the overall oil and gas production in North Dakota in slide 11 and kind of the ratio between them. How has the oil and gas ratio in the production in North Dakota here changed over time, as shown on slide 11?
Sure. Maybe I'll just orient this everybody on this slide. So oil's on the left, gas is on the right. Oil's in barrels per day, gas is in MCF per day, meaning 1,000 standard cubic feet of gas per day. And you can see just for the basin, it's somewhere between 1 million barrels a day and 1.2 million. It peaked in the pre-pandemic timeframe of just over 1.4, about 1.5 million barrels a day. But what you can see different from the oil to the gas is that gas has continued to grow. And this is gross gas, so you can actually see the amount of gas that was flared over that period of time. That's the black area plot on the chart on the right. And then you've got the green area plot that represents the total gross, essentially wellhead gas production at the time. So you can see the ratio is absolutely increasing. I mean, when you look at the gas or the oil at about 1 million barrels a day and gas growing from 500 million cubic foot a day to, close to 3 BCF of gas, you can really see that ratio is increasing.
And by ratio, I take it that's increasing is the ratio of gas to oil.
Yes, that's correct. So as you produce a barrel of oil, you expect to get a certain amount of gas with that. So as the basin, in particular, as wells mature, the gas that comes back with that oil increases over time.
Okay. And my bet is the commission knows, but we have a dip on both oil and gas. What's that representative of on slide 11?
Yeah, both of those are, obviously on oil and gas, they're related. As we mentioned, you can't produce one without the other. But it's the pandemic, essentially, that caused that to happen. And I think, as we all know, it was some pretty challenging times there from a price perspective. Many operators, I would say most operators in the basin, actually stopped drilling activity altogether. Hess continued to run at least one rig. We wanted to keep the capability in the basin. Again, the Bakken is our key operated asset. It's very important to us. So we wanted to keep that capability in the basin. Other producers also, again, which Hess did not do, is actually shut in production over that period of time when prices were so low. So even the actual producing wells, they ended up ceasing production for a period of time as a result of the low oil price at that time.
Okay, let's go to slide 12 and look at Hess in North Dakota rather than everyone. Can you explain what these statistics look like for Hess?
Sure. So again, not to repeat the slide, it's the same exact format as the slide we just looked at. Same time frame, same units of measure, everything is the same, including the gas plot on the right, showing gross wellhead gas and then the amount of gas that was flared at the time. Again, you kind of see a very similar shape to the curves, oil being relatively flat with the exception of that kind of pre-pandemic time frame, and then you actually see we peaked just shortly after the pandemic. We were running 6 rigs at the time, but we ended up reducing down to 1 rig, as I mentioned, to maintain that capability. But as you can see on the plot on the right, even with the reduction in total oil, gas continued to grow for us. So.
Okay. And how about the Hess flaring, the black lines at the bottom on the right? Right.
So similar to the prior plot, which I think the industry has done a great job in the basin, really focusing on gas capture. So, this obviously is a priority for Hess just from a sustainability perspective. But, obviously the commission has been very involved in trying to increase gas capture. So that's been a focus for us. So from that peak gas period, gas time frame, and in fact, in 2020, we expanded the Tioga gas plant, and then unfortunately, because of the pandemic, we had to delay the actual turnaround activity that enabled the additional capacity of the plant till 2021. But you can see as we installed more infrastructure, as we installed more made additional processing capacity available, we were able to drive the flaring down significantly. And I think we've done a pretty good job trying to manage our flaring in the basin.
And specifically, what kind of infrastructure is required to handle this additional growth in gas as a ratio to oil?
I mean, again, the oil system has been relatively flat. The gas system has continued to grow. So this has required a substantial increase in investment in pipelines, compressor stations, and ultimately additional processing to be able to produce the wells and still continue to capture the gas, which has been an objective for us.
Okay, let's turn to slide 13. And let's now discuss the entities involved in the Hess production and marketing. And let's start on the left. Who or what is Hess Bakken Investments or HIBIC, and what's their role in the production process?
Sure. So Hess Bakken Investments holds the leases, produces the oil and gas. It sells, again, as I mentioned before, it sells at the custody transfer point to HTC, so it effectively gets that netback price at the well pad at that custody transfer point. It manages all of the production, so 100% of the gross production, oil, water, gas on the location, including the non-operated working interest owners, and then ultimately distributes the net proceeds for that back to the working interest owners.
Okay, and HIBIC is a wholly owned subsidiary of Hess Corporation, correct?
Yes, it is.
Okay, let's go to the middle. Hess Trading Corporation, what are they and what is their role in the process?
So Hess Trading Corporation is an entity that's been around for a long time. It's handled all of Hess's domestic U.S. Production. It is basically a small team of individuals that have relationships with the downstream with key markets. They specialize in selling our hydrocarbon from our well pads and ultimately getting it to the downstream. They also contract with midstream service providers, including Hess Midstream, to make sure that those services are available and can get the production from the well pad to the point at which you can actually sell the hydrocarbons.
Okay, let's go to the right. What is Hess Midstream, or HESM it's been referred to, and what's its role in the process?
Sure. So Hess Midstream, on behalf of Hess Trading Corporation, provides the midstream services to Hess Bakken Investments. So essentially, Hess Midstream takes all of the hydrocarbon off of the well pad at the well pad and ensures that it's properly handled, whether it's water being disposed of in saltwater disposal wells, it's going through an oil system that ultimately gets to an oil terminal that ultimately gets exported out of the basin, goes to the low-pressure gathering system on the gas side, to a compressor station, and then ultimately to a gas plant that gets processed, and then the tailgate products ultimately get sold.
Okay, and who are the owners of HESM, or Hess Midstream?
So it's split between Hess Global Infrastructure Partners and the public. It's 38% split evenly between Hess Corporation and Global Infrastructure Partners, and then it's 24% public.
Okay, and let's take one step back. Why was Hess Midstream created?
Two key reasons for creating the midstream. One is from the time that Hess essentially entered the Bakken. I mean, Hess has been in North Dakota for a very long time, but started to develop the Bakken. It had been making direct investment in infrastructure. So it was building pipelines, it was building gas plants, it was building compressor stations at the time. There was a significant amount of capital deployed into the basin for the infrastructure necessary to successfully produce the oil and gas wells. In the 2014 timeframe, Hess Midstream was created essentially to try and get proceeds back for that capital investment so they could then take the proceeds and reinvest that back into the wells and drill more wells. That's reason number one. Second reason is there's strength and capability in Hess Midstream around just being able to build assets, operate them, making them reliable. So it's about an infrastructure and operating discipline and being able to actually build and operate midstream assets.
Okay, let's talk about who is GIP, or Global Infrastructure Partners?
So Global Infrastructure Partners is a private equity company that specializes in low risk, generally lower return infrastructure investments. So transportation, rail, energy obviously is a key component of that. And it's been a good partnership with them. They bring operating capability as well. There's some folks part of that entity that have GE backgrounds. So, generally, we have not needed it. Fortunately, we're actually a pretty good operation, but they do have some operating experience as well. But primarily just a infrastructure investment company.
Okay. So let's address how Hess Upstream and Hess Midstream work together. Can you explain to the commission how Hess Upstream and Midstream work together on development plans and siting midstream?
Sure. I mean, again, like I think we've talked about quite a lot over the last couple of days. Developing the Bakken is an integrated activity. You have to have for the well planning, you have to have the necessary infrastructure to be able to produce the wells properly and capture the gas and all the things that go into that. So what happens is the upstream team and the midstream teams work together to focus on the well development along with the fit for purpose necessary midstream infrastructure assets to ensure that those wells come online quickly. The upstream has been very focused on trying to reduce cycle time from the time that the well is drilled to the time that those wells are capable of producing. The midstream wants to be there the day that those wells are capable of producing. So that is a big priority, and I think it's a unique component of the relationship between the upstream and midstream, and that it is truly an integrated development plan, meaning the field development plan for the wells and pads integrates in with the infrastructure development plan that supports that field development, such that, and I think we all experienced this back in the heyday when growth was very aggressive, was the pipe following the drill bit. Now it's a little bit more like we've got the pipe in place, the drill bit comes, production comes online, and the infrastructure can handle it and take it.
Let's talk a little bit, what is Hess's and GIP's roles with respect to Hessam?
Right, so again, I think, when we talk about control or operating control of Hess Midstream, what essentially happens is the upstream submits a field development plan for the wells, and then midstream is obligated to build a system plan to support that development. So essentially, from an infrastructure perspective, when you're adding new infrastructure, it's all based on the upstream development plan. So if you don't have the wells, you don't build the infrastructure. It's a necessary step in the process of identify the wells. The production forecast comes to the midstream is asked to build a system plan that is capable of handling that, and then those two things kind of go together, and then they formalize the plans. They formalize the well development plan, and they formalize the midstream infrastructure plan. So again, it's a very very close relationship from that perspective. So essentially, in that case, the wells, Hess Bakken is leading the need for the infrastructure to be built. From a relationship perspective, whether it Hess, GIP, and the public, there are components because of the relationship between the entities. There's governance around things that cannot be done by Hess. So as an example, Hess does have a disproportionate number of board members, but for transactions that relate to affiliates, Hess does not get a say in those decisions. GIP, Global Infrastructure Partners, and the public ultimately make the decision, not Hess.
Hess is out of the room for that.
Hess is essentially, it does not participate in the voting for those decisions.
Now, I know the next witness, probably tomorrow, Mr. Fraley will address this in detail, but I do want to introduce and hit a few points with you on the cost of service agreements. How are the rates under the cost of service agreements between Hess and Hess Midstream at a high level generated?
Sure. I mean, it's basically, it's a cost of service model with essentially two terms. There's a true cost of service period, the first 10 years, and then there's a fixed fee period in the second 10 years. And so you look at the total capital and operating costs over that 20-year period, you look at the total volumes over that 20-year period, and you essentially calculate a rate of return over that 20-year period. So, I mean, that's essentially how it works.
Okay. And what is, we've mentioned it, but what are the return on capital rates in primarily the gathering and processing agreements?
Right, so the gathering agreements are 12%, the processing agreements are 14% rate of return.
Okay. And why did Hess set the rates at those levels when these were done back in the 2014 timeframe?
Again, Hess had always, or, as I mentioned, Hess was looking for a way to basically redeploy capital, take capital out of the midstream infrastructure and deploy that capital to wells. So part of that structure, and this is way before GIP was ever in the picture, Hess was looking to set up that structure, and the intent was to create a rate of return as low as possible, but that would create an attractive investment for private and public investors. So something that ultimately, with the intent, Hess had the intent of taking the company public. In fact, in 2014, and 15, there were pre-GIP, there were a number of S1s, that's the pre-filing necessary to take a company public. But again, I think everybody knows what was going on with the oil price at that time, and unfortunately, it just wasn't successful. And so it's essentially that's the structure for it.
Okay. So let's move to slide 15, and let's talk about what investment was required to support this development. And first, can you explain what this slide is? Then we'll walk through some of the items here on slide 15.
Sure. The commission has seen the slide before, but I'll just orient everybody to the slide. So that there's a timeline across the top with, I would say, just key infrastructure callouts, and then on the bottom it's showing key capacities at two different periods of time, 2014 and 2022. And the 2014 timeframe would be pre-Tioga gas plant expansion. So maybe I'll just go across the top here. So in 2011, we did built the dual loop track at the Tioga Rail Terminal. This was the capability of, and actually was extremely necessary shortly thereafter to get crude oil out of the basin. Without that, the crude for Hess would have been constrained. 2014, as we've talked about, we expanded the Tioga gas plant in 2014. Also, the NDIC flaring order was put in place in about the same time. In 2015, Hess, GIP approached Hess through the S1s, actually, the S1 SEC filings for the pre-public offering, used that information to come and make an unsolicited bid to purchase 50% of Hess Midstream, which it did. We built other infrastructure, Ramberg Terminal, the Hawkeye Gas Facility, Johnson's Corner. We did the partnership with Targa at LM4, Little Missouri 4, and then we expanded the Tioga Gas Plant again in 2021. One other thing that's not really shown here, although it's on the graphic on the bottom, is throughout this entire time frame, we've been installing pipelines, compressor stations, things that aren't significant enough to call out on this chart, but there was substantial investment throughout the duration of this period of time that basically was able to bring our processing capacity from 120 million a day up to 500 million a day, and our compression capacity from 151 million cubic foot a day up to 410 million cubic foot a day. And I don't think so it's 120 million cubic foot of processing, 500 million cubic foot of processing in 2022, and then in 2014, 150-ish million cubic foot of gas compression in 2014, and then in 2022, about 410 million cubic foot a day of compression.
Okay. And during this time, all of this, both the icons that we showed, the big and the others, who funded all of this midstream infrastructure on slide 15?
Yeah, pre-2015, or, when the formation of Hess Midstream, 2014, 2015 timeframe, that was all Hess. Post that, then it would have come out of the Hess Midstream entities at that time. And again, up till the GIP acquisition and taking the company public, it was all Hess that made those investments.
And I know we're going to get to future development, but does Hess Midstream envision having to continue to build, whether it's pipe, compressors, or additional investment to support the Bakken development?
Yes, absolutely. I mean, and as a matter of fact, we are in the process right now of constructing another 100 million cubic foot a day of gas compression capacity. There will be additional compressor stations needed. There may be additional processing needed. I think as we look at where the basin is going and what the total processing capacity is, that's definitely appears to be lacking. The other piece of this that's pretty important, that's kind of staring us all in the face, I think, a little bit right now is also some regulatory constraints as well. So in December of 2022, the EPA issued some additional, more restrictive Quad O requirements that are going to, cause especially on the gas methane side, from 2022 on, or 2023 on, will require additional infrastructure investment. And just to be clear, as we've interpreted the new rule from the Hess Midstream perspective, we don't believe that there will be a material impact to Hess Midstream as a result of that new rule as currently drafted.
Based on what's been built in the bottom.
Based on what's been built and what we anticipate to build in the future.
Okay. Now, if these midstream assets were built or expanded, could Hess have developed and drilled all the wells we went through here in the Bakken?
No, not with the requirements to capture the gas and get to where we needed to get to. So to produce the wells the way that we've been able to produce them, to accelerate the production as quickly as we've been able to do, especially as we bring new wells online very quickly, we've been able to have the infrastructure in place to enable that development and meet the compliance of the state, exceed the compliance, and the same with the federal requirements as well.
Okay. We heard today from Mr. Atala, he either said the system he thinks there's an incentive to overbuild the system, in essence. Do you agree with that?
No, I do not agree with that.
Why not?
At the end of the day, the midstream, I mentioned the relationship between the midstream and the upstream. The midstream is not incentivized by making the upstream unprofitable. The midstream is absolutely incentivized to help the upstream make its production as economic as possible, especially when you get further out in the development and wells become more marginal because you've gone from the best rock to maybe not as good of quality of rock out there. The midstream is always looking to optimize the system. And in fact, from a development perspective, and I mentioned the relationship between the upstream and the midstream, there are times where we will get and when I say we, I'm going to say on the Hess Midstream side, that the Hess Midstream team gets a volume forecast that places a well somewhere where there's not infrastructure. However, there are potential well locations in areas where there is infrastructure and there is capacity. And those decisions and that process actually happens regularly, a quarterly basis. And we're not just looking at next quarter, next year, 2 years from now. We're looking at 5, 10, 20 years from now on exactly how to place that infrastructure in the optimal way as best we can. Again, because we are absolutely incentivized to help our upstream partner make those wells economic and successful to produce them.
And can you explain, how does having the midstream, either their cost or otherwise, support or make upstream potentially drill additional wells that you said might be on the margin?
Again, it's the optimization. It's the ability to produce the wells as quickly as you possibly can, meeting all of our obligations from a state and federal perspective, and be able to deliver the system that they need to produce those wells.
Okay, let's turn to slide 16, and you've hit on some of these, but can you address, what are the key benefits from your perspective for Hess, the upstream developer, of having Hess Midstream as the midstream provider?
Yeah, I mean, I think I hit the integrated and optimized field development pretty good on the prior one. But again, I think these are two separate teams that specialize. We've got, subsurface and drilling and completions teams that are focused on optimizing the wells, drilling them for as low cost as they can, for as short a cycle time as possible, trying to get wells on as quickly as we possibly can. The midstream infrastructure is trying to optimize that well development plan and build only the infrastructure that's necessary to meet that requirement. So that integrated and relationship between the upstream midstream is absolutely critical. Yeah, and I would say that on the reliable takeaway and minimal interruption, it really comes back to, in addition to building the system, hopefully in a very in an optimized way that provides a high quality system to the producer. in addition, we want to operate that infrastructure and make sure that it's regularly available, and that when the production is capable of flowing, that it is able to flow on the midstream system. And then finally, just the operational synergies. So we're actually able to communicate between the midstream and the upstream, and in fact, in some cases, which I think benefits us all, our maintenance activities, for example, there's shared crafts between the upstream and the midstream. You know, they do work specific for the upstream and midstream, but some of the people are the same, so that we're actually able to utilize those skills and resources between the upstream locations and the midstream locations to make sure that we're actually able to keep those systems operating efficiently as they possibly can. And again, I think it enables that communication similar to the development side. On the operational side, when you have, you know, we call them reliability operators, but when you have pumpers on well pads and you've got midstream operators running the midstream system, those guys, they're always in constant communication with each other to absolutely maximize the full capacity. I mean, the upstream guys will say, hey, you know, pressure on this well pad is going up, what's going on? They'll call their midstream, you know, operations partner and say, what's going on? They may need a pig a line, there may be a constraint down the system, and they're having those conversations constantly. And I would argue the relationship with the midstream and upstream together enables that. So the operational synergies are key. And then ultimately, at the end of the day, the alignment of values are very strong.
Okay. And what are the financial benefits associated with these operational, either the optimization or otherwise here?
Yeah, again, I think I've said it a couple times, but the accelerated time to bring wells online is a key piece of that. Flow assurance, the capability to be able to produce the maximum capacity of the wells, oil, water, and gas, and be able to handle that and make sure that it's compliant.
Okay. Well, speaking of that, let's go to slide 17 and talk about what those investments have allowed Hess to do for itself and the working interest owners. Can you explain what slide 17 is showing?
Sure. So slide 17, maybe I'll just I'll define what the chart is,
Okay.
and then I'll come back and talk a little bit about the chart itself. So what this represents is the number of days, the average number of days from the time that a rig is on location and the drill bit starts spinning to actually drill the well to the time that the well is capable of first production. So basically when the revenue starts flowing from that production off that well. So you can see here, and I think we've picked, you know, reputable peers of Hess. What this represents is the number of days from the time that the drill bit first starts spinning to the time that well is capable of producing. All the activity, the drilling, completion, flow back, handover to operations, well facilities, midstream infrastructure, all of that stuff is in place, that within 177 days on average from 2018 to 2021, we were actually able to do that in 177 days. And then you can see Marathon, Whiting, now Cord, Continental Resources, and then Sinclair, what the time to bring wells online would be.
Okay,
as a comparison.
Yeah, and there's one more line of numbers underneath the
Oh,
charts.
yeah,
What do
yeah.
those represent?
Yeah, sorry. So the numbers below it represent the number of wells we're talking about here. So from January 2018 to December of 2021, that's the number of wells that were drilled and brought online at that period of time.
And is this referencing, I think, what you talked about before, getting these wells online means starting sales and revenue sooner?
Yes, absolutely. I mean, I think at the end of the day, the better utilization of the capital that you've got invested in everything, whether you're talking about drilling and completion, well facilities, midstream infrastructure, all of those things, the faster you can start utilizing them, you get the revenue back and you start earning on that investment.
Okay, let's turn to slide 18. We're going to go through some data now. This is entitled Gathering System Reliability, slide 18. And there's both lines and data on the right. So can you take it piece by piece and tell us what we're looking at in slide 18?
Sure. So this is gathering system reliability. So it's a percent of production downtime related to the gathering. So what this chart essentially is, and I'll just orient everybody to the lines first. So the green line represents Hess Midstream. The purplish line represents third parties. And what this is 100% of Hess operated gas that is either gathered by Hess Midstream or gathered by any other provider other than Hess Midstream. So it could be a One Oak, Kinder Morgan, could be anybody, essentially. And what you're seeing here is you're seeing the performance of Hess Midstream as it compares to third-party midstream service providers. And you can see the performance in that kind of challenging time frame was pretty rough for our third parties. The other thing that Hess Upstream decided to do at this time as well is to limit the exposure to the performance, and that's actually why you see the third parties coming back into line with Hess Midstream, is we actually didn't drill any wells in those areas in 2021 and 2022. We solely drilled in locations where Hess Midstream was the gatherer for that exact reason. The other thing that you doesn't really come out in the chart, but was actually happening at the same time, again, the operational synergies and the value that the midstream sees for the upstream, this kind of integrated nature of making the upstream successful. Hess Midstream was also doing things like we put in a 16-inch debottleneck pipeline in our Stony Creek field, which is gathered by Kinder Morgan, to try and debottleneck their system to enable Hess to actually get more production into pipe and actually produce that. The other thing that we do, that Hess Midstream does in conjunction and in support of Hess, is also work with those third-party midstream providers to try and help them, if there's anything that we can do to make them more successful, including adjusting our system to make their systems operate more efficiently. We've been aggressively working with them both across the upstream and midstream to support them.
Okay, let's look at some different cuts of data. Slide 19, what does this graphic represent, titled Total Downtime between Hess and Sinclair?
Right. So, I think this is a similar situation, but now you're just looking at the impact to the producer side. So you can see that the average number of days downtime, all wells, Hess versus Sinclair. Again, Hess is the green line, Sinclair is the red line, and you can just see the average number of down days percentage associated with the production over that period of time. All wells, all Hess, all Sinclair.
Okay, so let's turn to slide 20, and then we next have a data chart showing total flaring. Can you explain both the lines and then on the right what the data in the charts show?
Sure. So the charts represent the total Hess and Sinclair flaring through December of 2022, the percentage of gas that was flared from total operated volume for Hess and Sinclair. The charts on the right show those percentages by year. The table on the right shows the percentages by year. The table on the bottom shows the total number of wells. Again, it's a repeat of the well count that we showed previously. But you can again see kind of, I think, the focus that we've been trying to manage on the flaring side for the Hess production. We had a little bit of a tick up there in 2022. It was a pretty challenging season there in the kind of May timeframe, and then towards the end of the year was challenging. But overall, I think performance has been really good. And you can kind of see there, Hess's flaring was down to 5%, and in fact, we had historically been lower than 5% from a flaring, so gas capture of greater than 95% for a period of time, and that's continuing today.
Okay, let's turn to slide 21 and talk about what that has enabled on the valuable oil production. How has Hess's oil production changed over the last 10 years in the Bakken?
Yeah, I think this is a similar chart to the one we looked at before. It shows 2013 through 2022, the production per year. It's about 100,000 barrels a day of production over that period of time.
Okay, that's the oil, and I know we have two slides, Hess Bakken and then Sinclair. If you could talk through us on similar format on slide 22 and then slide 23.
Sure. Again, this is similar here. Now, instead of having flaring at the bottom, we have flaring at the top. So this represents gross gas production between sold and flared for both Hess and Sinclair.
Okay, and that's Sinclair then is slide 23.
Yes,
we show
yes,
the NDIC data.
Yes, sir.
Okay, so look, we started back in 2010 when there was no infrastructure. Midstream paid and built all this infrastructure. Let's talk about now where we're at today in slide 24. Can you give the bird's eye view of infrastructure, and then the next slide we'll zoom in?
Sure. So again, just to orient everybody, this slide, this one's a little busier than the previous one. There's a a lot more drilling spacing units here. There's a lot more compressor stations. There's additional processing, this particular, the one in the south, the Little Missouri 4 gas plant. And then you've got the oil system that has been expanded. And then it's not reflected on this chart, but we also have water systems that are also supporting this infrastructure.
Okay, let's zoom in to slide 25, which kind of similar format to what we had in 2010. Can you tell the commission what's changed over this kind of 10 to 13-year period?
Sure. So on the chart on the right, you can see now there's obviously more critical infrastructure that's on the chart. On the left, you see the oil gathering export. Remember, it was 130,000 barrels of oil a day. Now it's 385,000 barrels of oil a day plus a rail terminal and rail cars. The gas system, and on the oil side, the pipeline system has grown substantially as well. On the gas gathering and processing, much more pipe. Again, we went from about 60 million cubic foot a day of total compression to 410 plus the 100 we're adding this year, million cubic foot a day of gas. The Tioga gas plant is now 400 million cubic foot a day, and then we added another 100 million, which is, it's a 200 million a day plant for the Little Missouri 4 gas plant Targa's operating. 50% of that is Hess Midstream, so it's 100 million a day, and then we've added a water system in.
Okay, and what would have happened if Hess and Hessen had not developed this midstream with respect to Hess's wells?
Again, I mean, I think the way Hess has developed and the benefit of that relationship between Hess Midstream and Hess Upstream, it's been able to optimize the development.
Okay. And if Hess cannot recover its reasonable actual cost of the midstream from working interest owners or their share, how will that impact future field development?
Yeah, I mean, I think if there's, it would affect the economics of the development of the field. So I think at the end of the day, if Hess has to bear 100% of that cost, it's going to put that burden on those wells and ultimately will impact the amount of wells that will be able to be developed.
Okay. Let's turn to slide 26 and look towards the future. What is Hess's plans for the future here in the Bakken?
Right, so in 2022, we added a 4th rig, and we're planning to keep 4 rigs running for a long time. That enables us to drill about 120 wells per year. In 2023, between the upstream and the midstream, we're investing about $1.3 billion to fund that 4 rig program. We're planning to grow Hess production to 200,000 barrels of oil per day net by 2025, and then we plan to have that maintained for at least a decade plus. Planning to add another 2,000 wells over the next 2 decades. Again, I mentioned the gas infrastructure. That's going to continue to be able to manage our gas capture obligations and our preference, just from a sustainability perspective. And then kind of along the same lines, you know, one of the commitments that Hess made was to beat the World Bank flaring initiative, which is zero routine flaring by 2030. Our objective is to eliminate routine flaring by the end of 2025.
Thank you very much. Pass the witness.
Good afternoon, Mr. Galley.
Good afternoon.
We've not actually met, but I
No.
think you've been here for all the testimony, right?
I have, yes, sir.
And there were some questions of Mr. Attella regarding audit request. Are you aware of Hess at any point after this application was filed, letting the applicants know that they were free to do an audit of Hess?
No.
Has Hess decided whether to proceed with a secondary term of the gathering and processing agreements?
I'm not sure I can answer that. At the end of the day, Hess will, if it has not already done that.
But it hasn't made an election?
If Mr. Fraley will be able to confirm that. I don't want to misspeak.
If you could look at applicant's exhibit 13, please.
I think I have 13.
Do you have one now? You need one?
Please. Yeah. No, it's
those are ours.
it's
Do you have another set for him?
Yeah.
Maybe there's a set over there. Wait. Oh, you're covering the box. Backwards. You got one, John?
Not yet, no. You said 13?
Yeah, 13.
Okay, yes, I've got it here.
And this was something that Mr. Copsing put together?
I believe so.
Okay. And there's some questions asked to Mr. Copsing that indicated that Hess didn't believe the numbers on here. Do you remember that?
I do.
And I just want to ask you about the Hess number of $10.17 of natural gas deducts per MCF. Do you see that?
I do.
Does Hess have a different calculation of that number?
Well, I'm assuming we would have that calculation.
You don't know what it is?
I do not.
You mentioned on direct that Hess, about 10% of Hess's wells use midstream providers other than Hessam.
No, it's 10% of Hess's gross production is handled by third-party midstream provider, approximately.
So Hess has access to plenty of post-production cost and producing overhead information from other midstream providers in the Bakken.
It has information from the ones that provide the service.
And I think you would agree, and you may have testified, that Hessam and Hibbik are tightly integrated, right?
They are tightly integrated.
And you run them both,
I am responsible for both, yes.
in the same way that John Hess is CEO of Hess Corp. And also Hessam, you're running both Hibbik and Hessam's operations here in North Dakota.
I'm responsible for both operations.
And Hibbik and Hessam personnel work on the same floors and the same offices here, right?
Yeah, we only have one floor, but yes.
Same floor in the same
Yeah, same
office.
floor, yes.
No stairs, no elevator.
Well, there's apartments upstairs the building, and some people live up there.
And it was critical for Hess Corp to maintain control of Hessam, right?
Maintain operating control.
Okay. And Hess wouldn't have spun off Hessam without being able to maintain that operational control, right?
Yes, again, to produce the oil and gas, you have to have the midstream infrastructure. So I think, again, that's why the agreements are structured the way they are, so that when Hess decides to drill wells, the midstream is obligated to build the infrastructure necessary to support that.
And the contracts at issue here, the gas gathering and processing and fractionation agreements, they were originally entered into in 2014, right?
Yes, that's correct.
And that was before the sale, Hess Corp's sale of an interest in Hessam to GIP, right?
Yes, that's correct.
So you testified on direct that, I think your term was that Hess is out of the room when decisions are made regarding affiliate agreements, right?
No, what I said was, for the structure that we have in place, when there's any kind of affiliate transaction, Hess does not have a voice in that decision.
And that's now, right?
That is now, yes.
So back in 2014, when these contracts were entered into, not only was Hess not out of the room, there was only one room, right?
I mean, there were two teams looking at the transaction. Again, the intent was to generate a rate of return that would attract private and public investors in the entity. I mean, the intent was never to, I mean, it happened where GIP came forward and offered to purchase. The intent was to take the midstream public at the time.
Okay. But back to my question about rooms, there were two teams in one room, right?
I wasn't there in 2014. I can't tell you what the structure of the setup was.
And you anticipated my next question. In 2013, Hess Corp was planning to monetize its midstream assets, right?
I can't remember exactly when that was, but if it happened in 14, probably the concept was being discussed before that.
And having the long-term contracts in place was an important part of that plan, right?
Yeah, again, trying to create a structure that had a reasonable rate of return that would attract private and public investors.
Okay. And the public, I guess the private investor that it attracted was Global Infrastructure Partners, right?
Yes.
So Hess creates Hess Infrastructure Partners and then sells its interest in that to Global Infrastructure Partners, right?
Can you say that again? I'm sorry. I didn't-
Sure. And maybe I'll just ask it
Yeah,
more
go ahead.
colloquially, and maybe you'll know what I'm saying. Hess sold its interest in Hessam to Global Infrastructure Partners for about $2.7 billion, right?
Hess sold 50% of its interest.
Yeah, thank you. Sold half of its interest to GIP for $2.7 billion. And Hess Corp realized a gain on that deal of over $700 million, right?
Again, you're asking an accounting question. I'm not an accounting person, so I can't really tell you the gain loss on transactions like that. But again, that transaction has nothing to do with the tariff agreements.
Okay. And I was just asking about the number. And
Sure.
I understand that Mr. Donovan is going to be able to ask you lots of redirect questions. I was
Sure,
just
sure.
asking about the number.
None so far.
You haven't yet, but you will. But if I tell you in the 2710K of Hess Corp that it talks about a gain of over $700 million, you wouldn't dispute that, right?
I mean, I don't have the 10K, but there's no reason for me to dispute that.
And it's Exhibit A50, it's in evidence, and we can read. Okay.
I trust you.
Do you remember giving a fireside chat?
I probably have done more than one fireside chat. Yeah.
Okay, if you could look at applicant's Exhibit 52, please.
Okay, I needed the other book.
Oh, here we go. Oh, I got another one for you. There you go.
This one starts at 63. I'm still
okay.
missing.
It's right here. We have too many books.
Yeah, I know, right? 52, you said?
52.
52.
Yes.
And I'm familiar with FDR's fireside chats, but what kind of fireside chats do you give?
No, I mean, it's, whether it's, this particular one or, other conversations with analysts.
Okay. And is it to attract investors?
It's generally to explain the investment opportunity to, attract investors.
Okay. And this document was prepared by something called Illyrian, and it's dated March 1st, 2022. And in the summary, it says, last week, management from Hess Midstream, including John Gatling, President and Chief Operating Officer, and Jonathan Stein, Chief Financial Officer, participated in a fireside chat call series co-hosted by Morgan Stanley and Illyrian. Do you remember participating in that fireside chat? I guess it would have been end of February.
Yeah, vaguely, yes.
Okay. And I'm going to read you some statements that are attributed to either you or to Mr. Stein, and I just want you to let me know if you agree or if you think you're misquoted. And the first one is in the section right after the heading contracts provide built-in stability and growth, supporting returns to investors. And Ms. Morris writes, management highlighted the built-in stability and growth afforded by Hessam's one-of-a-kind contract structure with Hess Corporation, a global exploration and production company and one of the largest producers in the Bakken. Do you agree with everything in that sentence?
I mean, they're not my words, but again, I think the relationship I described before, I think the reasonable rate of return, I kind of described the components to it. I think it is I think the relationship is important, so I do think it's, one of a kind. I don't know. It's definitely an important relationship.
Do you know any other contracts like it?
I'm not out shopping these kind of contracts, so no, I'm not familiar.
And the next sentence reads, the agreements extend through 2033 and are designed to achieve a certain return on capital deployed, which is maintained through an annual fee reallocation, or recalculation, sorry. Is that right?
Yes, that's correct.
And minimum volume commitments are set on a rolling 3-year basis and currently extend through 2024. That's also correct, right?
Yes, that's correct.
And the next sentence sort of touts how well this is working. It reads, look no further than 2020 for evidence of the bulletproof nature of these contracts. Even as Hess Corporation's activity in the Bakken fell from 6 rigs running at the end of 2019 to just 1 rig in mid-2020, Hessam's adjusted EBITDA grew by 36% for the year. Is the information in those 2 sentences correct?
There's no reason to dispute them.
Okay. And the next sentence starts off, underwritten by its unique contract structure, Hessam has consistently grown its annual adjusted EBITDA. Do you agree with that?
Yes, I mean, I think that plus the prior reference you made is primarily related to the volume, minimum volume commitments associated with that, which is paid for 100% by Hess Corporation. So yeah, I mean, I think that's, the MVC, the minimum volume commitment, provides the floor by which those returns are based on.
So there's nothing in there that I read that's wrong, right?
Well, again, there's nothing that would tell me that the person that wrote this didn't have their facts correct.
Okay. In response to some questions from Mr. Donovan on direct, you said that it's important to keep the pipe ahead of the drill bit, right?
Well, I think what I was talking about is keeping that optimum, the sweet spot between the drilling activity and the infrastructure necessary to enable its production as quickly as possible.
Right. Because keeping that infrastructure in place allows Hess to drill more wells, right?
It allows Hess to drill more wells, bring wells on faster, realize revenues faster, all of the things that go to that.
And that's profitable for Hess.
It's profitable for everybody that participates in those wells.
Is it more profitable for Hess than the working interest owners that are non-ops?
I don't think it's more profitable for Hess.
The Hess way is to reduce flaring, right?
The Hess way is to comply and do everything we can to be a sustainably responsible operator.
Well, it's not only just to comply, right? You want to eliminate flaring by
Yes.
2 years from now.
Yes.
And reducing flaring allows Hess to attract capital, right?
Yes, it does.
Okay. Which allows Hess to drill more.
It allows everybody to participate in the opportunity to develop those wells.
Was there something incorrect about what I said? It allows
No,
Hess
I
to
was just
drill more?
clarifying that it's Hess plus.
Now, one of your slides, page 18. Actually, I think it's page 19, though, what I wanted to ask.
This one?
Yeah.
Which one?
I'll ask total downtime first and then go gathering system reliability.
So 19, Joe.
The upward spike for Sinclair is in the spring of 2020. Do you see that?
I do.
Were there many oil companies that were particularly concerned about downtime in the spring of 2020?
I don't know. I can't speak for other oil companies.
What was the price of oil in 2020 spring? You
It
remember?
was low.
So
But,
there's a-
I mean, you can see Hess didn't take that position, continued to keep the production on. Because again, I mean, Hess is looking to the long term. We're not focused on 1 month, we're not focused on 1 day, 1 month, 1 year. We're focused on the long term, which is where the returns come from.
And the returns based on the contracts that you have. in
I'm not
place.
talking about the contracts, I'm talking about the economics of the wells. I'm talking about the actual development of the wells.
Okay. Well, I'm not talking about that. So
Okay.
I'll ask questions and we'll focus on
Sure,
that.
of course.
Slide 18,
Yes.
gathering system reliability. So the third parties actually had better reliability in 2020 than Hess, correct? 2022, I'm sorry.
No, again, I mean, I think I described what was going on there. We didn't do any development in those areas because of their performance was so poor.
Okay, but my only question is, in 2022, third parties had better gathering system reliability than Hess.
Yeah,
True or false?
I could shut my production in and it would be 100%. They would be,
True or false?
I think he answered.
I answered your question.
Okay. On the flaring point, you're not suggesting that SOGC has violated any flaring
No.
laws or regulations, are you?
Absolutely not.
Just thinking back to Mr. Attella's testimony about producing overhead and how it's hard to audit it. And one of the categories expenses is management salaries, right?
I'm not sure if yeah, I'm not sure, but what he's looked at.
Okay. But overhead would include salaries?
Overhead would include salaries, yes.
Okay. So in essence, applicants in this case are paying at least part of your compensation, right?
I'm not exactly sure what goes into the calculation for overhead.
If Hess had not created HESM, would it have been possible for Hess to produce the same volumes of infrastructure?
I'm sorry, ask the question again?
Sure. If Hess had not created HESM, would it have been possible to produce the same volume of infrastructure?
Same volume of infrastructure. Sorry, ask the question one more time. Apologies.
I think it's the volume.
And I could be wrong.
No. Just-
I'm actually going to look at what you told the commission in May.
Okay.
And we'll go from there.
What page?
I think it's on 97.
Yeah, it's a little different.
Would it have been possible for Hess to produce the same volumes and operate the wells that it operates today without the building of this infrastructure?
Yeah, okay, so you were asking volumes of infrastructure, not volumes of production.
I misspoke.
So again, no, I think that Hess wouldn't have been able to develop the wells it developed. Hess wouldn't have had the infrastructure available to it. So I think the answer, I think the way I responded is correct.
And the way you responded was that you could have used third parties, but didn't want to because Hibbik and Hessam work together hand in hand. Fair?
No, not exactly. What I'm saying is, at the time, Hess and Hess Midstream had an integrated development plan that allowed us to optimize the production. I have no idea what would have happened if we had approached third parties to provide those services. I don't know that those services would have been available.
Okay. Would it have been possible for you to have contracted with third parties to provide those services?
You're asking me that question?
Yeah.
Again, you're asking me to speculate on a period of time that is in the past where the field was being very aggressively produced and there was not spare capacity. So I can't really answer your question.
Okay. And you were here on May 8th and you gave testimony to the commission, correct?
Yes?
Okay. And you were asked the question, would it have been possible for Hess to produce the same volumes and operate the wells that it operates today without the building of this infrastructure? And your answer was no. From the standpoint of the development, again, we could have contracted with third parties to provide those services, but it would have been in a non-coordinated way. And then you continued on, correct?
For the record, please continue to finish the answer for
Sure.
your question.
Again, the upstream team, the Bakken team, the Hess Bakken team and the midstream team, they work together. They work on the same floors in Houston. They work out of the same office in Minot, North Dakota. Had those teams not been working hand in hand, there's no way that Hess would have been able to develop the field the way it's been able to develop it.
I think
That's what you
that's,
said, right?
yes.
You mentioned that Hess is planning to add 2,000 new wells in the next 10 years,
Approximately.
which will essentially double Hess's well count in the next 20,
A little more, yeah.
a little bit more, okay. And applicants will be paying for a portion of the midstream infrastructure to make that possible, correct?
Through their participation in the wells, they will pay a portion of the cost to get the production, oil, water, gas, off of the pad to its final destination.
And a return on investment for Hessam is built into the tariff calculation, correct?
Yes.
Hess has assets in Guyana, correct?
Yes, it does.
If Conoco was operating a well in Guyana that Hess had an interest in and used its own midstream company and charged Hess more than prevailing rates, would Hess be okay with that?
Sorry.
Yeah.
Please ask that question
It
again.
really could be anywhere. If Hess had a non-operating interest in a well, and the operator was contracting with affiliated entities and charging more than prevailing rates, would Hess be okay with that?
Well, again, I think the definition of prevailing rate, there's a benefit associated with in the service that's being offered for that that service offering. There's a quality of service being offered for that service offering.
So your answer is it would depend on the quality of the service?
I think it would, again, come back to capacity, priority, the service that's ultimately being provided. I think those are all factors in that decision.
And you'd agree with me that whether the wells pay out or not will not change the tariff calculation in this case, right?
Individual well economics will not change the tariff calculation. Well, let me back up. At the end of the day, if the midstream makes wells uneconomic, then it will eliminate the number of wells that can be fully developed.
Okay. Did you tell the commission when you were here in May that the tariff won't change whether or not wells have paid out?
I don't know if he was asked.
Sorry, say that again?
Sure. I'll just look at the testimony.
Just give me the page.
126. Let me ask a slightly different question. It's a slightly different question I asked them. You used the phrase "at the end of the day." Is it fair to say at the end of the day that the tariff is not going away?
No, what I meant by the end of the day is that I'm back to the comment I was mentioning before about the aligned incentives between the midstream and the upstream, that the midstream is incentivized to help the upstream be as economic as it can be.
Okay. When you were here in May, Mr. Hicks asked you a question on page 127, line 17. Question, okay, so what you're saying is a tariff will never go away then? Your answer, no, the tariff will never go away.
I'm sorry.
127, line 17.
You can look. That's 127, sorry. 127.
And I'll read the question.
Sorry, what was the line again?
Yeah, 17. I'll read
17.
the question, and if you could read your answer, that'd be great.
Okay.
Are you with me?
Yes, sir.
Question, okay. So what you're saying is a tariff will never go away then? What was your answer?
I said, yep.
That's not exactly what you said, but can you read your answer, please?
Oh, I'm sorry, yeah. No, sorry.
Oh, you were
Apologies for
skipping
that.
down one.
I missed the line there, apologies. No, the tariff will never go away.
No further questions.
Excuse me, any redirect?
There might be one question, just for clarification. You were asked in the fireside chat about minimum volume commitments, and I know that's in some other of the investor presentations. First, at a high level, what is the minimum volume commitment?
So the minimum volume commitment is a floor that's set on a rolling 3-year basis that prevents there to be short-term volatility associated with the volume essentially coming through the system, realizing that activity changes and volumes go up and down and that. So it's to provide that floor over a period of time where activity could drop.
Okay. And if Hess Upstream doesn't meet that minimum volume commitment, who pays that minimum volume commitment?
Hess Corporation, 100%.
Okay. And has Hess ever tried, or withdrawn, has Hess charged any of that minimum volume commitment it pays to any working interest owner?
No,
It eats it all itself?
100%.
Nothing further.
One question. Has HIPIC ever not met the minimum volume commitment?
Yes, absolutely.
In what years?
You can ask Mr. Fraley, but a number of years.
Nothing further.
Nothing further.
Any staff questions?
John, you were asked the question if an audit was requested or turned down. I didn't catch exactly what you said. My question is, has Sinclair, SOGC, or Missouri River, or one of their representatives asked Hess to audit the wells and the subject wells in this matter?
My understanding is only after the application, after the complaint was brought forward.
Okay, and
I'm not exactly sure what the answer is. We'll have, Rom, will be able to speak to that.
okay, thank you.
John, in your gathering system reliability as well as, I guess, page 19, so that'd be page 18 and 19, where it indicates that Sinclair had higher flare volumes, I guess, mainly on page 19. Does Hess midstream have an automatic contract or agreement with Hess Production that the third parties would be booted off the line if capacity had constraint issues?
Yes, so let me just make sure I understand your question. So in a system where Hess is in a system and a third party's also in that system, does Hess have priority over that third party? Yes, absolutely, 100%.
Has Hess ever done an audit of the third party and where there was questions as far as payments or charge that Hess got that they were wondering about?
Not to my knowledge, but I'm probably not, I don't know.
And you kind of touched on this, but you would concur that if Hess didn't have the midstream and the capacity that the Hess production itself, if it wasn't able to get onto third-party lines, would possibly have production restrictions and due to flaring and so on and so forth. I mean, really, Hess's production is able to maintain the level it does due to the midstream it has, correct?
Yes, that's correct.
Thank you.
Any additional questions? All right, doesn't look like there are any additional questions. Thank you, Mr. Gatling.
Thank you very much.
Can I raise one housekeeping matter? I know you probably have to
You
go.
may.
But we'll need to confer because based on the pace, I'm not sure we finish tomorrow. I know that disappoints you all. But we'll confer. I don't know if there's any opportunity. There might be a chance if we start a little early tomorrow, but I don't know what everyone's schedule is. I think we'd be willing to start earlier, but don't want to impose, and we're also happy to confer.
I can start earlier. I don't know. If the,
My only comment I was gonna state on that is that it states in our notice to the public that it starts at 9 o'clock. So if there is somebody that wanted to come testify tomorrow or provide, that could be an issue.
It's easier to go late than start early, but.
well, I think that's a good point. On the other hand, we're going to be here probably all day. So if there was an opportunity for someone that wanted to provide testimony, I think that they would still have that opportunity even if we started early. Plus, the hearing is being streamed, so if they wanted an opportunity to listen to the part of the hearing that they would miss, if they came late, they could go back and listen to it, at least during the break in the early part of the morning, to see what they missed. So, any comment from
We're
the?
fine with starting early.
Okay.
If we're not gonna finish tomorrow, I just would wanna get a date on the calendar
Yeah,
ASAP.
for sure, to finish.
Before memories fade, et cetera.
Sure.
Agreed.
So when we say earlier, we're talking 8 o'clock.
That's fine with Hess. It's up to the commission.
Is that okay with you guys?
We can jointly share in the cost of coffee for everyone.
I'm sure there might be some donut eaters as well. Well, let's shoot for 8 around that time, if that's okay for the
That'd be great.
reporter, and we'll
Thank
see what we can get done.
Okay. We appreciate it. Thank
All right,
you.
Thanks, and we'll be off the record.